Welcome back. So it promises to be a good morning, at least the opening, because we have all the positive, global cues coming in. We have the implied open suggesting anyway we'll start 80 points higher, and the bulls are revved up, charged up. They have momentum on their side. So let's see if they'll take aim at higher levels today. Time to boil this down to individual stocks as well. As always, we have a team standing by with the CNBC TV18 list of top stocks to watch. I think we have everybody here. No, we do have everybody here. Good morning, guys. I'm going to start with the lady first. Ria, what stocks are you watching out for this morning?
Well, good morning, sir. First, starting up with Cochin Shipyard. They have signed a contract with ONGC for dry docks and major layup repairs of one of its jackup rigs. The contract value is rupees 200 crores and it is estimated to be completed within the next 12 months. Moving on to MOIL, they have exported the first shipment of manganese ore as a state trading enterprise. This shipment was of 54,600 tons and this has been exported to Indonesia. And the last stock that we're watching out for is Go Digit. CRISIL has upgraded its rating on the stock to AA- rating with a stable outlook from its earlier A positive rating with a positive outlook. All of these stocks expected to open in the green today.
Absolutely. Thanks very much, Ria, for that. Biocon is what we're going to focus on next. Ekta is here to tell us why. Ekta, morning.
Morning. Well, Biocon has secured US FDA approval for biosimilars Prolia and Xgeva, which is basically denosumab. The combined market size of both of these biosimilars is $4.5 billion to $5 billion in the US. Now, the revenue potential, however, for Biocon, according to analysts, should be around $100 to $150 million because it is expected to be an 8-player market, and Biocon is the 5th company to receive approval for this particular biosimilar. 3 players have launched and 3 more are still awaiting clearance. Analysts say that the Biocon's fact that they've got interchangeability designation strengthens their ability to capture market share. Amgen has it's in litigation with a couple of players. They've settled with 3 launched players already, and they have a litigation ongoing since June 2025 with Biocon with regards to these biosimilars, and the launch is expected only post the settlement. So yes, it's a big biosimilar, but nonetheless, the opportunity for Biocon, according to analysts, is expected to not be as much as anticipated.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go across to Vivek. He's tracking some more stocks in the news. Morning, Vivek.
Well, good morning. Quite a few stocks in focus on the back of developments. First on the list is listed CDMO player Cohance Life Sciences. Now remember, private equity Advent International actually went ahead and consolidated all of the Indian CDMO players into Cohance Life Sciences. And today what we understand from the term sheet that we managed to access last evening is that Advent is looking to offload close to 5.1% of the total equity of Cohance Life Sciences. This particular deal has been done through the affiliate Jasmiral Holdings. The offer floor price is at 900 rupees a share, indicating a close to 7% discount to yesterday's closing price. So total size of the block at that particular rate works out to around 1756 crore. There is a lockup on stake sale of residual stake of almost 210 days on the seller. Now, after that, what we need to watch out for is whether they look to go ahead and further pare their stake lower. The other 2 stocks in focus first will be Waaree Energies and their subsidiary, which is Indo Solar. Now, what we understand is that according to filing to the exchanges, Waaree Energy is looking to sell close to 61 lakh shares, almost 15% of the total equity within Indo Solar. Remember, they hold close to 95% stake. So this particular stake sale will help the company go ahead and meet the minimum public shareholding norms. One thing to note as far as our viewers are concerned, Indo Solar, as per BSE, has a trading restricted status on account of IRP as per IBC. And keep an eye out for Vikram Solar, an interesting development, something that the street may be wary of. 3 promoter entities have gone ahead and created a total pledge of a little over 30% of the total equity. Vikram Capital Management has created a pledge of 6%. Gyanesh Chaudhary Family Trust has created a pledge of 20%. And VSL Ventures has created a pledge of 4%. This particular pledge, as per the filing, is created for a borrowing amount to utilize mainly for working capital purposes. It'll be interesting to see how this particular stocks reacts today.
Okay, all right. So we will keep a lot of these names on our radar. Thanks for that, Vivek. Let's get to Sudarshan. He's watching out for 2 auto stocks, Escorts Kubota and TVS Motors. Morning, sir.
Good morning, Surabhi. So it's an interesting launch that Escorts Kubota has made. So if you ever been to villages, you would be knowing that what the issues farmers face in conventional threshing. So when they do conventional threshing, major part of your crop gets wasted while threshing. So now to resolve that issue, Escorts Kubota has launched new combine harvester, and it has used the technology of Kubota. So what it does, it basically cuts the straw from very base, and it reduces the breakage of any like crop, especially basmati grain rice, and now that can be reused. So it would help not only resolve that issue, but also companies saying that stubble burning issue that North India faces, it might be resolved. Now, the second launch that made by TVS Motor, it has launched King Deluxe Plus CNG three-wheeler in the market of Tanzania. It's going to target fleet owners and commercial use, and it will have 5 kg CNG tank with 8-liter petrol fuel tank as well.
Okay, so I can tell you that that issue, I think not only people who've been to villages in India, anybody who's been to North India knows the massive stubble burning issue. So yeah, I mean, hopefully this offers some sort of a solution. Thank you very much for that. With that, let's quickly recap our list of stocks to watch. The ones that have positive news flow around them this morning are Biocon, Vari Energies, Cochin Shipyard, Moil, Go Digit, Escorts Kubota and TVS Motors. Stocks with negative news flow today would be Cohance Life Sciences, Indo Solar and Vikram Solar.
Okay, all right. Well, those are all the stocks that we're looking at, but plenty of action with the commodity space. Manisha Gupta joins in to tell us more about that. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, after that huge run-up that we saw in many of these commodities to the run-up to the U.S. Fed meeting and 25 basis point rate cut delivered on expected lines, we're looking at some profit-taking coming in right now. So the gold prices to begin with, after hitting a high, all-time high of $3,704 an ounce, is trading at $36.60 right now. We've seen more than a percentage point of decline in the overnight markets. Not just gold, many metals went for profit-taking as well. You had silver come down by 2%, platinum fell 2.5%, palladium fell 2%, copper was down 1.5% as well. So very sharp declines coming in for many of these. In the Asian markets, while we've seen gold and silver kind of stabilize, copper, zinc continue to see further declines right now. Jeremy Powell said that Fed is in a meeting-by-meeting situation regarding outlook for interest rates, so markets trying to read between the lines onto that one. Not just metals, if you look at the crude oil prices, we seem to be extending declines onto this one as well for a second straight day. While the U.S. crude inventories saw a decline, but the distillate stocks have run to a Jan highs, and that's weighing onto the markets, anticipating that now with the summer demand season done with, it really could be about refinery maintenances, higher supplies going forward. And the street is also looking at the OPEC Plus meeting now, where there would be a discussion on the production and consumption numbers and capacity as well for the rest of this year and the next as well. So the next cues for the crude oil prices will coming from that.
Okay, all right, Manisha, thank you very much for that. So it's overall commodities picture more in detail a little later. But brokerage calls of the day, what do we have? Sud is back with exactly that. Sud, morning.
Morning, Prashant. So first one is Sun Pharma. Citi has added the company to Pan-Asia focus list, and it maintains buy call with a target price of $21.80 per share. It expects revenue for innovation business to rise to $3.2 billion by FY30 from current level of $1.2 billion. Also, it's expecting revenue growth to be backed by first, comprehensive formulary coverage. Second, company has a clear edge in clinical profile, especially in safety. And third, Illumia's potential approval and expansion. And on the valuations front, also company Citi believes that post-correction, it has become very reasonable. Next one, HSBC on telecom. It's saying that tariff hike potential in 2026 has increased considerably. Also, growth drivers remain intact for both Jio as well as Bharti Airtel, and ARPU growth is expected to increase further. Home broadband subscribers may surge going ahead, and also free cash flow and dividends are expected to grow as well. So it has a buy call on Bharti Airtel with a target price of 2200, buy call on Reliance, and target is increased to 1750, maintains reduced call on Vodafone Idea with a target price of rupees 5.80. Last one is Minda Corporation. MK has initiated coverage with a buy call and target here is rupees 600. It's saying that it's a spark for structural outperformance, and talking about the past performance, it's saying that accelerated R&D spends, market acumen have helped company perform very strongly in the last few years.
Okay, all right, Sid. Thanks a lot for joining in and giving us all of those details. Well, time to slip into a short break, but on the other side, we'll connect with the management of Apollo Tyres and talk to them about their big endorsement deal with the BCCI, as well as the outlook for the rest of the fiscal year. Stay tuned.
Okay, welcome back. There's 35 minutes to go for the pre-open session to kick off. Conrad Saldana is with us, Managing Director and Portfolio Manager at New Berger Berman. Conrad, great to have you with us here. I think we've been having some troubles on both ends connecting, but finally can see you clearly. Hopefully can hear you clearly as well. I hope you can hear me. Just a quick word on the Fed in terms of whether the question was whether we'll get a sense of whether this is the start of a bigger easing cycle. Do we have that clarity? Because that is meaningful for dollar downside views and EM flows, etc.
Prashant, hopefully you can hear me. Good to connect again. Obviously, it's a 25 basis point cut. If you ask most economists in the US, this should be in a string of cuts coming through. I feel that Chairman Powell, while he's opened the door, hasn't given a super dovish view or max dovish view on this. And so he's trying to calibrate. Obviously, the labor markets are softer, and he's trying to preempt that. And inflation doesn't seem to be a concern. However, I would just caution that, with the tariffs, price increases, given how much that was pre-bought in terms of inventory, we haven't seen that yet. You saw a PPI figure that was strong, and in certain areas, you could see 50 basis points a month, which could be 5 to 6% in terms of inflation. So we haven't really seen that. So it might be super premature to think that this is onward and beyond. And I think we'll have to see how earnings also come through. But given that the dollar has started to weaken, it does give a positive backdrop to emerging markets and a lot more policy relief from an external source to countries such as India in their policy-making stance.
All right. Hi, Conrad. Good to have you on the show. But what about the state of the economy with regard to the United States? Because you're getting mixed signals. As you said, the negative impact of tariffs will come in the next quarter. The dollar index as well has weakened, which in turn, for consumers out there, will make things a little bit more difficult. But looking at some data from US commercial banks, out there, the loan growth actually has gone up. So how are you reading the US economy? Because, you want that not to fall apart. Your take on that?
Yeah, I think generally the US economy is super resilient, right? And none of us would expect it coming through here, whether it's inflation, whether it's growth, has really been strong. I think earnings are coming through reasonably well. I would say it's a divergent economy. The higher end spending in the US continues to do well. I think it's going to be how the mass market in terms of consumption holds up. We don't know that yet. And I think that's already seen some pain points. But I would say the economy is very resilient in the US. I do not see the wheels falling off here as much as people expect that. The bigger question becomes longer term is, how does the fiscal environment look, and what does that mean really for the long dated bonds versus what the Fed does on the short term? Because really nobody finances on the short end. So given we want to see that softness in the mortgage rates, et cetera, that could help with consumption and affordability. That's going to be the bigger picture and the bigger question rather than what the Fed does on the shorter term basis. So it's about fiscal discipline. It's about how much can be done in terms of tariffs and the raising of it. But the question becomes is who really finances that, and what's the actual inflationary impact of that once it starts to roll out and come through? And that we won't see for another couple of months at least.
Conrad, let's talk about India now. I've started to hear this view increasingly that new highs by Diwali. All right. So, but that's about 4-5% from where we are now, right? But that's okay. And more than one, 10-12% by the end of the year, this year, remaining year. Now that's the bigger view. And I don't know if you have any thoughts. Sometimes these things are self-fulfilling prophecies, right? I mean, somebody says, and you got, and reasons are same old. FI positioning is very low. It's not as if anything great has changed, but maybe at the margin that consumption will pick up because people will spend more. 22nd is when these cuts go into effect, which is next week. Your thoughts on the market, this market view which is emerging?
Maybe it's wishful thinking and maybe it's self-fulfilling, Prashant. We'd like to think so. Listen, earnings haven't been strong, right? We've seen that. And consumption has been weak. Maybe the GST does help. I think if you get more of these, you look at them across markets. if you start to see more in terms of appliances, rebates, things like that, that stimulate consumption, I think that's a huge positive for the economy, and especially for the consumption stocks that haven't really done much. And so I think that's an important point to watch out for. I think you still got some pain over the next couple of months, potentially this quarter, and maybe into the end of the year with the Diwali season that starts to bottom out and starts to turn again. I think that is probably more structural for me versus trying to pick, do people rush out and try to consume? It comes down to job creation and, importantly, wages. I don't see that structurally turning. It does help in terms of the stimulus, but we'll have to wait and see. I would think into the festival season, that's going to be much more a bigger driver than seeing that people rush out on GST and any of these cuts and start to spend. That's my view from afar. It's just practical looking through markets, different markets and cycles. But it comes down to, can you see that in the revenues? And importantly, can you see that in earnings? Because the market is not cheap as much as it might have underperformed. You're not looking cheap particularly, and I think you need to see that earnings growth come through.
All right, Conrad, let's get to stocks then. Here in the Indian markets, maybe the headline index doesn't do, what the most bullish views on the street are. But always, y'all are, on the hunt for some good bargain buys. In the past, you've mentioned a couple of stocks. I think Shyam Metallics, Jyoti CNC, Orient Pro, some of those stocks you like from the broader markets. Tell us, what's new?
Nigel, we don't change our portfolio a whole bunch. So I would say that when there's opportunities, when these stocks underperform, partly because of liquidity, right? And as you mentioned, foreigners selling, part of it is because EM as an asset class so outflows. Now you're starting to see that reverse, where you're starting to see, thanks to the weaker dollar, you're starting to see money coming back into EM. And partly people made that switch from India to other markets. The tariff noise did not help in that regard. But for us, I think, where I think the structural growth going to come through in manufacturing. That's what is needed. And I do think whether it's a NetWeb that we've owned for a long period of time, I think that continues to do well. I think the power infrastructure side, you've seen softness in names more recently, like Voltamp. It's still a good business. Yes, there was some selling pressure and news flow that dominated that name. I would say CG Power, they are fairly open to tap into the export market. And this is part of the old group and some of the leftovers of that in Europe. So you've got a good runway for those businesses that I do think are structural and not really dependent as much on shorter term consumption either. I do think that that's a structural growth area for the Indian market. And these are the companies that will facilitate that.
It's always great speaking with you, Conrad. Bunch of more questions, but we're on a treadmill all the way to market open. So got to cover more stuff. Thank you very much for coming on. And next time, thank you.
Makes sense.
All right, well, Apollo Tyres is what we want to address next, right? This week signed a 3-year deal to become the lead sponsor of the Indian cricket team's jersey. Joining us today is Neeraj Kanwar, Vice Chairman and Managing Director of Apollo Tyres, to discuss this partnership with BCCI and share insights on the tyre industry outlook as well, especially in the wake of the recent GST cut. Mr. Kanwar, thanks very much for joining us. What made Apollo Tyres go in for this big move with Team India's jersey sponsorship, sir? Let's start with the basics. And what does it mean for the brand?
As you know, India's heartbeat is really cricket, and it really unites our whole nation together, from the streets, from every home, from every human being. And we all are grown up to this sport. I mean, Sachin is a god of cricket, who's also a brand ambassador, and he's done a lot for us. I myself am a diehard cricket fan. It's a national pride for us, and that is what Apollo is also. It's the core of India, and Apollo also is the core of India. And that's what's highly motivating for me, to see that finally we have entered this sport and we've gone right to the apex of the sport. We've not gone down the line. We've gone right to the top to represent ourselves as being Indian on the Indian national team, which gives us a lot of pride because we are a high performance car tire manufacturer. India is a very high performance cricket playing nation. And so we saw a very good synergy between us and the Indian cricket team. And we hope we go the long distance with this. And we really would like to say that we are very happy, we are very passionate about this, and we hope all success in our long-term journey with BCCI.
All right, good to have you on the show, Mr. Conrad. Well, you've mentioned that this is a 3-year partnership, right? Could you also give us a sense of the size of the deal and what level of investment Apollo Tyres is making in this association?
It's around 579 crores.
Do you see, Neeraj, do you see this partnership as a long-term association beyond the initial 3-year deal? And what are the key objectives that you're trying to achieve through this collaboration with Team India?
Well, firstly, yes, we are in it for a long term. So I don't look at a 3-year span, I look at it a much longer term, because whenever Apollo has tied up with someone, for instance, and the writing is on the wall with Man United, this is our 13th year with United. So it's been a long journey with Manchester United. So that's a real live example to tell you that once Apollo collaborates with such a big brand, which gets a nation the pride, Apollo will stay. It's a long term, it's a century and centuries to come. What it does to us, as you know, we are available in 100 countries. It's an international sport today. With the help of BCCI, they have made India really as a global map, on the global map. And we basically, it looks at enhancing our consumer trust. Apollo is leaders in this category. So consumers' trust with our product is going to be more enhanced. We believe we can get more new distribution into this networks, whether it's in India or whether globally. And so, yes, there's much more to see what really happens with this new brand that we've taken on.
And Neeraj, cricket, of course, has a massive following, right? Not just in India, but also in other geographies, UK, Australia, several other countries where the sport is growing rapidly. Do you plan to leverage this partnership to expand your presence in these sort of, cricket crazy international markets, if I can put it that way?
Well, at first, all the Commonwealth countries where cricket is played, so the exposure is right there, right? And recently we've had in the US a lot of coverage of cricket. So cricket is growing in other nations as well. And visibility is becoming more and more because with international TV channels and with social media, people are watching more cricket outside of India. And that's an advantage to Apollo because Apollo, as you know, has two brands, the Apollo and the Fredestein brand. And that in itself will give us a lot of visibility in the consumer space all across the world, not just India. Yes, India is a main market. 65% of our revenue comes from India. But yes, it will also give us equal amount of exposure in the international markets.
Well, Mr. Conrad, on a lighter note, we have seen that jersey sponsors in the past, whether it was Sahara, Byju's, or even Dream 11, they haven't exactly had the best of luck, right? Did that thought ever pop up before signing on?
Definitely, I was told about this by a lot of my people, but I have faith in my company, and this company is built over since 1976 by my father, the chairman, and it has very strong foundations. And Apollo is just not a name. It's also the spirit of our nation. It's what is carrying load in our country, which is by road to rural markets, to feed the people, to in trucks where trucks are going. It's being carried by Apollo Tyres. So Apollo is a very strong company. I have no doubt in my mind that we are in it for a long term. And that's one of the reasons I think BCCI has favored us, because they know that here's an BCCI, an institution tying up hands with another major tire leader and an institution in India. And therefore, it has a very clear synergy with the Apollo brand and with the Indian cricket national team.
Take your point on board. Well, let's focus on business then. With the government's recent GST rationalization, Tyres too has been moved from 28% slab to around 18%. How do you see this impacting demand, particularly at a time when the overall auto demand has been relatively muted?
Well, firstly, I'd like to commend the government. I think this is a very good, positive move in the right direction. It simplifies GST to a great extent. It also reduces the operating cost of vehicle maintenance. So that's in itself putting back money into the consumers, which will give growth to the economy because they will be, it will stimulate demand by getting back money into the consumer's pocket. So I think this is a very positive move for GST. What it does to tires is, number one, that it is pro-consumer safety, because now tires will be a bit cheaper and people will now look at changing tires at the right time. First, they were expensive. So that in itself is going to increase tire demand and also increase the safety levels of our roads in India, thereby giving much safer travel to our fellow Indians all over the country. So it's very positive. Our logistic costs will come down. So I'm totally for it. As far as Apollo is concerned, we'll be passing on all the price that has come down. The full benefit will go to the consumers.
Neeraj, what would be growth outlook for FY26 and FY27 then? I mean, just to sort of recap everything into hard numbers for the next 2 years.
Well, I think it's too early to say, but like we always look at a double-digit figure, we are not shying away from that.
Well, appreciate you joining in, Mr. Conrad. Thanks a lot. Wishing you all the best, in this new journey, and we look forward to catching up with you very, very soon. Well, time to slip into a short break. Up next, we'll get you the technical trades. Sudarshan as well as Mitesh are waiting by for us.
Welcome back. We are putting the spotlight on a couple of individual stocks now, starting with yesterday's stellar listing. Urban Company was such a headline grabber yesterday. The listing premium was 60%. So obviously for those who got allotment, they would be extremely happy. But the question is, what now? At current valuations, what is the view on the company? What are the growth prospects like? Let's go across to Manglam to find out more. Manglam, morning.
Good morning. So a couple of things. Yesterday the stock did extremely well. It was expected to do extremely well given the sort of excitement that there was for the IPO. Over 104 times subscription is what we saw. But at the same time, people compared it to the market caps of Zomato, Swiggy, as well as Urban Company itself. The explanation being that, okay, if the total addressable market or the total audience pool for all these companies is the same, then why is there such a big market cap difference? Where you look at Urban Company at close to around 28,000 crore, even after a 60% pop yesterday. You look at Zomato over 3 lakh crore, and you have Swiggy at a little over 1,10,000 crores itself. So that was one of the reasons which was explained for the big up move, notwithstanding the 100 times PE that the stock is trading at after this big up move. The second thing that we're looking at is whether there was fear of missing out on a platform business that may perhaps become extremely big. And the third part, of course, a large part of the shares were also locked in for sale because there was not much liquidity. So we'll keep an eye out on how these factors play out. Typically, for a big blockbuster listing that happens, we see, next few days do extremely well for the stock until the first tranche of sellers come in or after a month when the first liquidity window opens in. But a couple of things we'll have to watch out for: how the company grows from here in their core business, how the margins expand out there, and more importantly, profitability. And at the same time, their other growth driver, which is the hardware business, the native business, how does that grow? We spoke with the management yesterday, and they said that currently they're present in around 50 cities. They have the potential to expand to 200 cities by FY30. But more importantly, they are looking at between 30 to 40 times growth in their native business, very close to break even out there. But they are expanding into other hardware products as well. Key areas that they're looking at are cleaning solutions as well as air conditioning. So those are a couple of things we'll watch out for, whether the management, goes ahead and delivers on those promises. But as of now, the street likes what they have on offer and the overall addressable market here as well. Let's hear out what the management had to say.
The right time, hopefully either in the first or the second earnings call itself, we will come out very, very clearly to investors with how long will that investment phase last, what is the capital we would like to deploy. I think today we are playing in many services, but not the end state of everything we can do. So in the end state, any service in the four walls of your home will very much be part of our ambition and our playing ground. And similarly, we are imagining a connected ecosystem inside your home of devices which have a strong affinity with our service ecosystem and our platform. So more than a services company, we think of ourselves as a home platform, and that's what we're building. It's hard to see it today, but I think over the next 10 years, this will play out. And we want to be the operating system for your home, the backbone for your home. I think water purifiers and smart electronic door locks are potentially only 2 or 4 or 5 such products that we could build. We will be calibrated. We recognize that this is a new turf. Even though it is related diversification, it's a new territory for us. We have to get it to scale. We have to make it profitable. But if I take a 10-year view, I don't think we will be limited to only water purifiers or electronic door locks. Native, as the brand name says, we want it to be natively integrated into your home, into your life. I can tell you that, look, we're going to be hard at work, and we're not going to be satisfied until we're at least 30, 40, 50 times larger.
Well, those are the men of the moment yesterday. Native, that scaled substantially, but they won't be satisfied if it's not 30 to 40 times of what it is currently. So we'll keep an eye out on that, because that's where the big value unlocking could come about as well. Well, let's move on then, and let's go across to Hormuz. He's here to track some stocks that were moving around yesterday and whether or not it was backed by delivery. Morning, Hormuz.
Morning, Nigel. You spoke of Urban Company, so we'll focus on the new listings of yesterday first up. And it was a healthy buying traction seen on at least 2 of them. Urban Company had almost 50% of their shares traded marked for delivery yesterday. Shringar House of Mangalsutra also had more than 2.5 crore shares being traded, and close to 1.5 crore shares were marked for delivery as well. So healthy first day buying seen on the new listings. Can't say the same for Dev Accelerator, of course, a smaller IPO and a subdued listing as well. But the theme of yesterday's trading session were PSU banks, and PSU banks saw very healthy delivery-based buying yesterday. Take a look at the volumes first up. Bank of Maharashtra, SBI and PNB, all of them saw anywhere between 1.5 crore to 3.5 crore shares being traded yesterday. And compare that to their 20-day volumes, which lie anywhere between almost 50 lakh to 1 crore shares. So higher than their 20-day average. And usually when you see something like this, that when the traded volumes are higher, the delivery percentage is generally lower or adjusting in proportion. That's not the case for the PSU banks. Almost 50% of the traded shares of all of these PSU banks were marked for delivery in yesterday's session. Bank of Maharashtra almost 1.5 crore as well. SBI almost 80 lakh. PNB almost 1.25 crore as well. So healthy delivery based buying seen in PSU banks. Now India Pesticides was another among the top gainers yesterday. Biggest single day gain since May, has been outperforming off late, 7 out of the last 8 sessions. Now yesterday close to 50 lakh shares were traded. 20-day average is just 6.5 lakh, and 10 lakh shares of that were marked for delivery. So around 1/5 of the total volumes. 20-day average is around 2 lakh shares, and it's up around 30% on a year-to-date basis. Has done well this year, but continues to remain below its IPO price, which is at 296. And lastly, Premier Explosives. The defense stocks have been on a move in the month of September so far, and it's gained in 4 out of the last 5 sessions. Tuesday's volumes were the highest on record, with over 1.5 crore shares being traded. The 20-day average is just 6.5 lakh. So very strong volumes yesterday, and close to 19 lakh shares were marked for delivery, and the 20-day average here is just close to 2 lakh shares. So defense on the move, and a lot of these PSU banks should be on your radar as well.
Very, very interesting data as always, Harmers. Thanks very much for that. Well, just a few more names, and this is a note which came out, I think, day before yesterday. Some of them, some reactions to it yesterday. It materialized yesterday, but I think there's still important to put it out. Short covering candidates. What does the data indicate, and where is positioning still heavily net short? Sudarshan is here with that one. So over to you.
So market at large has been moving higher over the last few sessions, and that's the reason you have seen that Nifty is above the level of 25,300, and FI's long exposure has increased to the level of 13% from the recent low of 8% that we have seen. So majority of the names have been seeing short covering or fresh buying. So we have shortlisted few names that might see a continuation of short covering. So from the Nifty, the first name comes to mind is Trent, which has been the biggest, most shorted counter in the last 1 to 2 months. And yesterday also stock was up 1%, while OI, or say open interest, was down 1%. And second name that comes to mind is Kotak Mahindra Bank. In the last few sessions, it has been one of the top Nifty and Nifty Bank contributors on the upside. And yesterday also the stock was up almost 1%, and OI was down almost 6%. From the broader market, first name from the IT pack, that is KPIT Tech. It has been one of the underperformers in 2025. It's down 11%, but on Wednesday's session, stock was up 3%, while open interest has fallen 6%. PSU basket continues to see a move towards upside, both PSUs and PSU banks. So from PSU bank basket, I have selected PNB, for which stock was up 3%, and similarly open interest was down 3% as well. And last name is from real estate pack, Prestige Estates, where stock was up 1%, while open interest was down 3%. And do remember, real estate is one basket which has been the biggest underperformer of 2025.
Okay, all right. So thank you very much for that. Well, with that, we actually have to quickly get to our technical experts as well, figure out what the trading setup today is looking like. We have Sudarshan Sukhani and Mitesh Thakkar joining in. Gentlemen, good morning. It's been good going for the bulls, actually. The market has been nicely cruising along, and the indicative start again today is on the upside. Maybe we'll get a 80-point up move right at the start. So what should the approach be? Mitesh, morning. You go first.
Good morning, sir. My first observation, rather my initial observation, was that we might see the Nifty kind of struggle around this 25,300 mark, but looks like we'll clear that level with the gap today. Then, I mentioned about in case we get past these levels, then we'll look at possibly 25,500, 550 zone. So I think that's where we are heading. We advise taking some profits on the Nifty so that view was there, but be trading long on the stock side. I think 25,550 looks to be the near-term target in the Nifty, but what could be more important is that the Bank Nifty could start catching up post the underperformance, which it's shown for the last number of weeks. So the first targets for the Bank Nifty is around 55,900, and then beyond that, I'm even looking at 56,300.
Okay. All right, Midday, got that. Sudarshan, what about you? Is it still, I mean, should you still be in a buy mode on the indices?
Yeah, good morning. See, the trend is up, and that becomes a very easy call to make when we have a clear, well-defined trend. I can't make a call on when this trend will end. So the trade still is buy on dips, maintain your long positions, buy on small consolidations. But because at some point every trend matures, we raise our stops and make it as tight as possible. So keep your stops now at 25,200 approximately and stay long.
Okay. All right. So that's the advice on the indices. Gentlemen, stay on. We'll come back to you for stock advice as well. But first, a very quick break. We'll come back. We'll have the pre-opening rates and then more on stocks. Also, Dayanand Mittal of JM Financial will be with us. We'll talk about trends in the oil and gas sector. Welcome back. Well, we will be getting the pre-open rates by about now. So let's see. Okay, the first rate is in a very different direction compared to what the implied open was telling us. So let's just wait by for this to settle for a bit. In the meantime, let's discuss stocks as well with our technical experts. Mitesh, what's on your list today?
Yeah. I have all buy calls. Very clearly the market is showing signs of continuation. So all calls on the long side. The first stock is buy on Federal Bank, which I would recommend buying with a stop just below levels of 196. Look for a price target of 205 to about 206. Ambuja Cement, I think that's one stock which has given a strong reversal on the after 2-hourly charts, hourly to hourly charts. And that's a buy with a stop at 575 for a target of 600. Also a buy on NCC with a stop at 212 for targets of 224, and a buy on BPCL is the final call. That's a buy with a stop below 318.5 for a target of around 334.
Okay. Sudarshan, what about you? Stocks for the day?
Well, it's a buy list. Overall reality is a buy with a stop at 1625. let me point out that the real estate index may be finally bottoming out. ONGC is a buy with a stop under 232. Nykaa is a buying opportunity. It's a short-term buy with a stop under 238. And finally, Dalmia Bharat, again from the cement pack, which Mitesh was also talking about, is a buying opportunity, stop under 24.22.
Okay, all right. Thanks a lot for joining in, gentlemen, and giving us all of those details. Well, let's focus on the oil and gas space then. We're now joined by Dayanand Mittal, the oil and gas telecom research analyst at JM Financial Institutional Securities, who joins us on the show. Hi, Dayanand. Good morning. Thanks a lot for joining in. Well, the next big event for GAIL is going to be the tariff increases, right? How much upside would tariffs bring for GAIL, if you've done some math on that? And also, GAIL's, GAIL gas listing, how much, it adds to the valuations? If you could give us some brief numbers.
Good morning, Ajal. So, in terms of tariff hike, is long pending since the APM gas got deallocated for the gas transmission business, and the cost of their operating cost of gas with the use in transmission business has gone up significantly from $3 to now $10. So, given for GSPL regulator had made those changes, so for GAIL it's just a matter of time when those final numbers gets revised. So our expectation is versus 57-58 rupees per unit that they get currently, we are building in conservatively 65-66, while companies applied to PNGRB for 77 odd, and companies saying at least they're confident based on their understanding that 71-72 is what they should get. So assuming they get closer to 71-72 versus broadly we and Street are building about 65 odd, so there could be about 10% odd upside to earning and similar kind of an upside to valuation. So that's on the transmission part. So I guess it's a matter of time before it comes. Don't think there's much debate on the rationale for the hike. On GAIL Gas, yes, listing is pending, but last 2-3 years, the outlook for CGD sector has got a bit deteriorated, particularly after the Russia-Ukraine crisis, leading to spike in global gas prices. And hence the input cost for all the CGD companies, given APM deallocation, surge in APM pricing, high spot LNG prices. So the outlook for CGD company has deteriorated over the last 2-3 years. So we are not very optimistic about too high a valuation for GAIL Gas. But yeah, whenever it happens, so we don't build much upside per se from GAIL Gas listing as of now. But whenever it happens, that could probably some 2-3% kind of a bump up to valuations as well.
Okay, got it. All right, not too much on that front. All right. Could you tell us, about, since we're looking at oil and gas space, and now you have crude oil prices, that earlier this year went down to around $55 a barrel. They popped back up and holding around this $66, $68 per barrel mark. What's the view on ONGC as well as Oil India? Do you think valuations and steady crude prices with the hike in production are enough to be interested in the stock?
So we have a positive view on Oil India. Also, we like ONGC, but we prefer Oil India. First, just some quick view on crude price. So our sense is the two key global players who are driving this prices, one is Saudi, second US. So the near-term interest seems to be aligned to keep crude price a bit soft, particularly US. US President wants Fed to cut rate. We saw one cut yesterday, but it's small in what US President wants. And they also want Russia to come down to the negotiating table. So for both these to happen, then US President needs oil price to remain soft in the near term. And given Saudi's strong relationship with the current US President, Saudi is obliging to it. And so this last week, OPEC plus output hike, where they're now reversing the second set of voluntary cut of 1.65, that came as a surprise to us. And in our view, that will ensure crude remains soft for next 3-4 months, because this monthly hike might continue till US President gets both his objectives. But from a one year plus view, we think Brent prices are likely to stabilize more around $70-72, primarily because the break-even price for shale is around 65-66. Plus Saudi needs high oil price to match its fiscal deficit. They need about 80-85, and also they need to keep selling stake on Aramco to fund this diversification strategy. Also, US President wants shale investment to continue, given for the US energy exports will be a key source of reducing trade deficits. So medium-term view is oil will be around $70. So near-term it may remain soft. So next 3-4 months perspective, maybe ONGC Oil India remains soft. But yeah, I think valuations are quite reasonable. They're discounting $60 kind of net crude realization. So downside is quite limited. So one can buy with a 1-year view, I think, in both the names. We particularly like Oil India because it could be a 2-3 year compounding story.
Dayanand, finally, I was going through some notes which were trying to get to the overall currency impact, because the rupee is down 3% over the quarter. So whether you're talking about city gas distribution companies, even oil marketing and refining companies, at the end of the day they're all importing, directly or indirectly, whether it's oil or gas. Are you baking that into your estimates? I mean, overall, as we gear up for this earnings season, what should we watch out for?
So yeah, so from oil marketing companies, things are quite robust. Last year was a very, very strong quarter, 1Q. 2Q would also be quite healthy, though maybe down QOQ. This currency moderation will provide some relief. The sharp depreciation of currency was becoming a concern, so some relief there. But what's more positive from OMC's perspective is crude likely remaining soft and hence marketing margin remaining strong. So OMC's 2Q should be quite decent, above normal earnings. For CGD companies, yes, this given they don't have much ability to take price hikes, given very limited differential between CNG and petrol diesel now. So this INR appreciation should ease concerns which was arising over last few months when INR was depreciating sharply. So CGD should be a steady type quarter, nothing major in the results. OMC should be a strong quarter in 2Q.
And what's your top OMC pick in that case?
So we are more neutralish in OMC, so we prefer more BPCL, and primarily because of its strong refining play, and refining we think margins should remain strong in the near term, and also IOCL, but that's more on a valuation ground. So IOCL is trading at 0.9 time price to book versus 1.2 to 1.3 for BP and HP.
Absolutely. Then on this one last question, we've done the micros, etc. Prashant, morning. Just one macro question, but I think it's also very important. Do you know what is the difference between, Russian oil and, say, the Indian basket? Is there because the difference has been coming down dramatically?
Yeah.
And that is, at some point, if the difference is immaterial, we may actually stop buying because it doesn't make sense, and then the problem is resolved on the tariffs, etc. Do you know that number?
Yeah, so broadly, even OMC's management, we keep interacting. So they broadly suggest the discount is around $2 to $3 per barrel currently. It used to be $3 to $3.5, let's say 6 months back. Obviously, post the Russia-Ukraine crisis was very high at $9 to $10. This number that I'm telling is net of higher transportation and insurance costs, so net benefit to OMCs, let's say. So given we import about 30-odd%, so OMCs import about 30-odd% of their crude from Russia, so that adds about $1 to the GRM. $1 to GRM for OMCs is quite sizable, about 8 to 10% EBITDA is what $1 implies in terms of overall consolidated earnings. So it's quite sizable still. And given US and Europe is trying to further tighten sanctions on Russia, that would mean the discount might continue. So I don't think the discount is ending anytime soon, unless as part of this Russia-Ukraine settlement, maybe the sanctions gets removed, which is obviously it's very fluid, difficult to take a call.
All right. No, absolutely. But as you said, I mean, from $9, $10, it's come off quite sharply, right? So maybe you're at a point where you need to assess at $2, $3, and if it comes a little bit more, maybe the trade-off in that sense. But interesting times. Thank you very much for joining us, Diana. It's always a pleasure, and look forward to having you back on the program here on CNBC TV18. Let's get the 9-10 calls out of the way. There's 4 minutes to market open. Sudarshan and Mitesh are back with us. Sudarshan, you go first. What do you have?
It's overall reality, buy with a stop under 1625.
Okay. And Mitesh, what about you?
Mine is just a long on Ambuja Cement for pallets of around 600.
Okay. All right, gentlemen, thanks very much. By the way, the pre-open has settled and it is looking good again. 110 points up on the Nifty. A lot of IT stocks. I can see IT on the upside as we're gearing up for the open, so watch out for that. And there is Sun Pharma. Sun Pharma's up 1% in pre-open. Speaking of Sun Pharma, let's go back to Sud. There's some positive brokerage commentary around the company and the stock today. Sud, fill us in.
So Citi has today added Sun Pharma to a pan-Asia focus list and maintains Biocon with a target price of ₹2180 per share. It believes the revenue for innovation business is going to rise to $3.2 billion by FY30 from current level of $1.2 billion. It has mentioned some of the revenue growth catalysts. First one is comprehensive formulary coverage. Second, it has a clear edge in clinical profile, especially in safety. And third is Illumia's potential approval and expansion that company has been planning. And also on the valuation front, company is saying that it has moved to undemanding levels post recent correction.
Okay, all right. Thanks a lot for that, Sid. Going across to Mangalam, because Avenue Supermarkets is going to be in focus. There's a bullish note coming in from UBS. Mangalam, tell us more.
There is a bullish note, and it's a very interesting bullish note because, you know, they are positive on the business. They've rolled forward their estimates and multiple by a year. They have a target price of 5,600 on the stock. Why are they bullish? One, they say that growth is set to accelerate. They're strengthening their own e-commerce platform, and more importantly, they have a winning business model with large structural growth opportunities, especially ever since they opened their first store in, the main market of Uttar Pradesh, which is India's largest population when it comes to this state. But the important part that they highlight out here, and remember, DMart is trading at over 77 times FY27 price to earnings. They believe that if the company sustains 18 to 22% sort of growth, then these multiples are tenable. And in fact, they can also expand if the revenue growth sustains above that 20% mark. So that's an interesting one. The first time someone saying that DMart multiples can actually expand if the revenue growth stays above that 20% mark. So we'll watch out for that. 5,600 is their target price.
No, interesting. And hearing that after a long time, multiple expansion for DMart. Possible, of course, revenue growth dependent. Mangalam, thanks very much. Here's a quick recap of the stocks that we covered over the last 1 hour or so. So US FDA approval for Biocon, stocks up about 1.5%. That's finally how stocks have closed at the end of the pre-open. Block deal likely, Cohan's Life Sciences, and 6% lower. I think the deal's done, right? 34 million shares on Cohan's in that window. There's stocks with news flow, Vari Energy and Vikram Solar. Vikram Solar down a little bit, Vari up about 0.25%. There's an order from ONGC for Cochin Shipyard, which will come up about 1.5%. Moil, Go Digit are stocks with news flow. There are new launches. We discussed TVS Motors and, of course, Escorts, Kubota as well. Escorts is up about 1% and TVS is up about 0.5%. So, in terms of reacting to news one way or the other, there isn't, they're not outsized, very large moves, but it's all adding up and building up, as we've seen for the last 10, 11 trading sessions now. And the market's come off nicely from the 24,400 levels to about 25,400. So actually, it's a clean 1,000-odd point move we've seen. About 0.4% higher on the Nifty. That's the Bell, and 25,436. We've got the Nifty Bank, which is starting 0.5% higher. So there's a strong start, 55,700. And Midcap index about 1/3%. The small cap index is higher at this point as well. So that is the overall picture. 1,450 stocks are higher. About 1,000 stocks are lower at this point in time. So Nifty heat map quickly gives you a sense of where things lie before we go any further. So how many up and down will come up on your screens. I think IT is opening up in a decent way. Can spot a few of those names right there at the bottom of the screen. Okay, I think
there's by the way, while we talk about large caps, look at Urban Company. It's servicing the shareholders very well. 3.5% up again on Urban Company after yesterday's big start. Okay, now it seems to have cooled off, but yeah, maybe we can get the rates from both the exchanges. Yeah, now it's cooling off 2% on Urban Company. Anyway, large cap, the leadership is all IT. This Fed rate cut has really inspired sentiment, it seems. Infosys, Wipro, HCL Tech. One narrative, remember, is that eventually with lower rates in the US, people will get back to more discretionary spends, the regular spends, even as the AI juggernaut continues along. And that at least sentimentally seems to be helping. So between 1% to 2% up on all large cap IT. Then you have financials, which are firing. So, that's turbo engines, twin engines firing, both IT and banks. HDFC Bank, ICICI Bank, 0.5% to 0.7% on the higher side. Then what else? There's Eternal, there's ITC from the consumer space. Yesterday, some of the metal stocks were weak. Today, they're at least starting out on an optimistic note. I saw Tata Steel flash by, but it's flattening out now. Reliance is up 0.25%. So that's how we are positioned, at least at this point in time. Sun Pharma, the stock that Sud was talking about with that Citi positive view, It's starting off with a gain of about 0.5%. Now, on the downside, you've got Hindalco, which is lower. There's Bajaj Finance, SBI Life, State Bank of India itself, which is down about 0.25%. So those are your key losers. Life insurance companies still lower. And there's Apollo Hospitals, Reddy's and Cipla. So healthcare and pharma, not very hot, but IT surely is. Nigel.
Well, that's right. The index that we highlighted in the morning that could potentially react to this Fed rate cut was the IT space. And that, in fact, is the outperformer today. That's up close to 100%. So big move is what we're seeing on that index. The other one that we've spotted earlier this morning was HFCL. And we gave you a hint last evening itself towards the end of trade. That could be one of the stocks that's coming out of the FNO band. So we're seeing some kind of action out there. Volumes as well, rather high on that one. Besides that, IRM Energy, that stock has moved on very, very high volumes. I'm not sure if there is any news out there, but solid move is what we're seeing on that stock. Big uptake in initial trade itself. A few more notable movers, Cohance, as should be mentioned, I think, that block is out of the way. Stock is down 5%, volumes very, very high. Sometimes it's interesting to see the stock post the block getting out of the way. So let's see whether or not there is some more action. Redington, after a big surge, is still up close to 18% in this week. It's cooling off a breath a little bit this morning, though. A few more notable movers. You have KNR Constructions, unusually high volumes out there. That's up close to 2.5%. Urban Companies holding on to a 2% gain. And Sagility, that's the other stock that's up and about in today's trading session. A quick word on Hindalco. There was a fire at one of their units, at Novelis itself. And the stock is a little under pressure, because the Oswego plant, which is, has a capacity of roughly around 400,000 odd, which will effectively mean close to around 10% of Hindalco's total capacity. And more importantly, bulk of their capacity is toward the automotive space, which is high margin business. So you could expect some pressure for the remainder of this quarter, if in case the plant doesn't reopen. That's a stock to track.
Absolutely. By the way, we are now up a clean 1,000 points. This is the 14th day from that low on the Nifty. 24,400 was the low, and 25,400 is now on the screen. So that's a 1,000-point move. Number one volume-led gainer is Urban Company. It's up back up 4%, so 173 there. Lots of interest, of course. Zentek is coming up as the third largest volume gainer. It's up 5%. Limit up, I think, for the day, 1621 on Zentek. On your screen. And what else? Heritage Foods is up 3%. Ismo is up about 4%. $1,000 on this one. IZMO. Escorts is up 2%. Subros is up 4%. Saregama is up 3%. So yeah, I mean, this is still very early in the morning, but lots of stuff with volumes moving. And moving in a good way. Tega is down about 2.5%. Stocks at about 2,060, but it's up 30% for the year still, although it's just a little bit off the highs, basically. DCM Shriram is coming up with a 3.33% of a cut right now, 1335, and Aether is down about 1.5%. MobiKwik is another one which had such a sharp move, so it's coming off a little bit from the highs at this point in time. So that's where we stand. Let's welcome in our market march of the day. Sunil Kaul is Global Emerging Markets Equity Strategist at Goldman Sachs. Sunil, good morning. Great to have you with us here. Good to have you back on the program, back on the channel. Sunil, let's just maybe start by looking at things through the lens of markets, from a market perspective. Do you think we are set for new all-time highs shortly? I mean, as some are saying, by Diwali. And maybe there are bigger gains in store. I mean, these things creep up on us. And before you know it, I mean, we're already up, as I was saying, about 1,000 points on the Nifty in the last 14 days. What's your sense? It's a slightly near-term question. Diwali maybe by the end of the year, but what's your sense?
Look, Prashant, I mean, I'm not sure about Diwali or year-end, but look, I think we do expect further upside in equity markets in generally, including in India. I would say, I mean, obviously, we just had the Fed rate cut, but in general, if you sort of look at the global backdrop right now, you're kind of looking at US economy slowing, but avoiding any outright recession. You're kind of seeing Fed cutting rates. We think they will do more, 2 more rate cuts this year, another 2 next year. So still more rate cuts to come, which means many of the EM central banks will continue to have some room to ease policy more. You got a dollar which has been weakening and we think will further weaken from here in. So the setup is one wherein it should be generally pro-risk, right? Weaker dollar, rates being cut, growth kind of holding up in many places. And so that should be, people should be continuing to take risk in EM markets. And that's why EM, for example, is more than 20% up year to date. And we think investors will continue to take allocations in the EM equity markets, and that continues to play out. And in that, we think India will also benefit. And so we do expect markets to go higher. We do have a 27,000 target on Nifty on a 12-month basis, which from current level is still sort of mid-single to high single-digit gains. Whether that comes in a shorter period of time by year-end or Diwali, we'll need to see. But overall, I think given the macro setup, we think markets should still go higher from here.
Yeah, Sunil, hi, good morning. Great to have you in. I was thinking you will sound even more optimistic because I was going back to our old conversation and I remember, and this was before the 15th of August speech and before the announcement of the GST cuts. And we were really, really optimistic on the second half, and you'd given us that target, 27,000 in the next 12 months. So I thought today you will, either increase that target or shorten the time duration, because now we have the GST bonanza as well. But still, on that comparison scale, still tempered. But tell us, I mean, your call on consumption spot on. But now how much more? Because stocks have also run up quite a bit since we last spoke.
No, I think that's a great question, Surbhi. Look, I think as you recall from the previous conversation, we were expecting a recovery in the consumption. We were already seeing a rural recovery coming through. And on top of that, you got the GST cuts, which I think means that consumption should be recovering in the next couple of quarters. And so we were, even before the GST cuts, we were kind of positioned that way in the market, in the sense that we were overweight the consumption pockets, and we continue to hold those views. I've been sort of running around in Asia, speaking to clients this week and part of last week. And I would say the consistent feedback around India has been that growth has been coming back, but it's still very concentrated in consumption rather than the rest of the pockets. And that's kind of our view as well. And there has been more going on in the rest of the EM pack, which is where the action has been. And obviously people are quite excited about the AI story, and you got the North Asian markets and China to play that. There have been sort of more catalysts in the rest of the EM in terms of corporate reform story in Korea, more excitement around Europe and the markets in there. And so I think the general feedback has been that India doesn't play into the AI story. You have consumption coming up, but you haven't seen much pickup in the credit growth. You haven't seen sort of IT obviously today is doing well, but it's still a US sensitive sector. And in the case that US growth is still slowing, it has come off in the last year, but people are still a little bit reluctant to take exposure there. And then given government has been consolidating on fiscal and they have given the consumption boost, the general sense is that they might moderate the infrastructure spending. And so you go through the sectors, it just feels like consumption is the bright spot, which we agree, and we are positioned there. But the other sectors might take a little bit more time, which is why the upsides is more kind of moderate in our estimates.
Sure. Sunil, so I'm just trying to understand that incrementally, when you map earnings now, overall for the market, for the wider index, or even for, let's say, consumption companies, where are you at? And have those estimates been bumped up after the GST cuts? Some ranges or numbers would help here.
Yeah, I mean, that's a great question, Surabhi. So I think we have, I mean, obviously the second quarter reporting season was generally pretty decent. The bar was low, but I think we got the underlying earnings growth of around 12%. Our full year number for calendar 2025 is about 11% earnings growth, and we think we are kind of on track to meet those. We have started to see in the last couple of weeks sort of earnings upgrades in the consumption space, notably in staples, in discretionary. And so I think the sentiment is starting to improve. When you look at the broader market, there are still more downgrades that have happened in the last 1 month since the GST announcements. Then we have seen upgrades, which means the net sentiment is still sort of in the red zone, wherein downgrades are more than upgrades. But incrementally in the last 1 month, we have seen consumption pockets, people raising numbers. We think there's still more to go there, and so we can start to see more upgrades in the consumption sector. And as I said, we think we should be able to achieve that sort of 11-12% earnings growth, which is what we have. We also did some deeper analysis around the GST cuts and the impact of that on corporate earnings, and our sense was that, I mean, obviously, you have to make some assumptions in terms of how much demand elasticity in different sectors. But our sense is that in general, it could improve India's earnings by 1 percentage point. It sort of looks a bit low, but it's because it's concentrated in consumption, and large parts of the other markets do not really benefit from GST. But net that should be accretive for underlying earnings. We haven't raised the numbers a lot because some of that gets shaved in because of lower growth on the infrastructure side and the continued uncertainty around tariffs. So net, we still think overall there is a net positive earnings impact from the GST overall for the market.
Hi, Sunil. Good to see you. I remember exactly 12 months or so ago, we had quizzed you about the Chinese markets, and you said maybe the Chinese markets from 9.5 times could trade around 11.5 times as well. And that's what could cause them to, that index to do pretty well. And that's how it's played out, right, in the last 1 year. Indian markets, actually, MSCI India is struggling, while you have the MSCI Emerging Market Index that's done far better. So we have relatively underperformed. Give and take everything with the kind of action we have seen both on the fiscal and the monetary side. Do you think India gets to a stage now where we get back to market performance or maybe outperform? Point number one. And the second point is on the FI holding. They have been selling into the Indian markets non-stop. The holding in the Indian markets is the lowest we have seen in multiple years, and they're net short. Do you think it's reaching to a stage where we see that slow down a little bit at least?
Look, Nigel, I mean, you're exactly right. I think India is, depending on whether you look at MSCI India or Nifty and dollar or local returns, but India is flat to moderately down for the year. EM is up 25, 26 for the year. So you have sort of seen more than 20% underperformance for India. That's the largest underperformance India has seen on an annual basis in the last 30 years. So it's been a stark underperformance, and China has done much better. We were lucky in terms of our allocations that we were overweight China, we were overweight Korea. We downgraded India, as you may recall, back in October last year, so almost a year back. And so that relative call wherein China has outperformed, Chinese equities have outperformed Indian equities by almost 70 percentage points, has worked very well. So you're right in asking, and foreigners have sold, and are we at a point wherein some of the mean reversion can happen? I would say, look, I think the valuation premium has definitely come down. When China was at 9-10 times, India was at 24-23 times. You were looking at 100% plus premium. Today, that premium with China rallying and going to 15 times, with India being at 20 times, is sort of down to 30-40%. So we have seen a large compression in premium. But we do think, and we are still overweight China. We think that momentum in China could extend for a couple of quarters. But at the same time, I think the catalyst for market rotation, so to speak, or India to outperform, has to come in from not just valuation coming off a little bit, but underlying growth and earnings improving. I mean, we obviously have a real GDP growth of still 6.5, 6.7 is where our forecasts are. But inflation is running pretty low, so the nominal growth is still at 8 handle. We think next year that goes to around 10 times, which is similar to what it has been in the last few years. So this year, obviously, the nominal GDP has been unusually low. That, along with the fact that consumption recovers and some of the other sectors, especially financials, we think will recover with a couple of quarters of lag. I think that could cause the market to do a bit better. But in the near term, we still think that some of the other markets, including China and Korea as a case in point, might have a better momentum compared to India. I mean, FII flows, encouragingly in the last couple of weeks, have been turning positive. But we'll need to see if that trend sort of persists. We see that across the EM complex, wherein flows have generally been positive because of the macro tailwinds. And I think what we are seeing now is India is also benefiting a little bit from that.
No, absolutely. I mean, the last few years, right? I mean, the best performing markets have been India and the US. I think recency is a powerful thing. You expect every year to be a big one, but it's turned out to be quite okay. And we're in September, right? Still a couple of months to go before we close this one out. Sunil, so how does one position one's portfolio? Financials is clearly an area you like, but if you can, I mean, talk about your published sort of names, or you want to go as close to names as possible, segments where one should look for opportunities in a positional way now.
Yeah. Look, I mean, Prashant, I mean, we can't talk about individual names, as you know, but I mean, in terms of sectoral preferences and segments, as I mentioned before, even after the personal income tax cuts that we saw through, we already had positioned in terms of liking the consumption sectors over investment sectors. And so we are overweight staples that should benefit from the GST cuts. We are overweight autos. We do pick up some of the QSR and the tourism and the internet names through the overweight in the internet or the TMT sector in general. We also are overweight financials. So I think financials and consumer sectors are where we have our sort of most positive views on. On the other side of the ledger, we are underweight infrastructure, excluding defense, which is a structural theme, but the rest of the infrastructure pack, we are underweight pharma. And so we have a clear preference of consumption over investments there. We are neutral IT, realizing that it has come off a little bit, but we think it may be a little bit too early to position there. The only incremental change I would say we have made after the GST announcement in terms of our sectoral preferences has been around the cement sector, which may be a bit sort of anti-consensus in the sense that obviously there is a GST benefit specifically for the cement sector, but we also think that they may be able to sort of hold on to or improve their margins given the industry setup. And property sector in general is still looking pretty decent. And so the combination of sort of benefits from the GST cuts with pricing power within the cement sector could do better. But overall, I think those are the pockets which we think outperform within the broader market.
Got it, Sunil. That gives us a good framework, at least, when an overall view on how you're thinking and positioned on the market. Just a clarification, this 11% earnings growth that you spoke of, that's for calendar year 25 or is it for FY 26?
Surabhi, this is for calendar year 2025. And as I said, we are halfway through or more through the year. We'll see how the third quarter reporting numbers come up, but we should be able to we are in line with those numbers. Just to sort of put that in context, we haven't sort of changed those numbers or felt the need to change a lot of those numbers through the course of the year. Coming into the year when we had a more cautious view on growth slowdown, we were still at 11-12%, or roughly at 11%. I think consensus at that time was 16-17%. Consensus has come down to our numbers where we, through a lot of changes, did not feel much need to change those numbers. But we do expect earnings growth to further improve next year, as in calendar 2026, from current 11% estimate to around 14% estimate, as some of these growth recovery comes through. And we think market basically on a 12-month basis rides those underlying earnings growth with a bit of multiple sort of compression from current levels, given it still looks expensive relative to everything. And how we sort of get to.
No, I'm glad you brought up that point because I was just leading into that. So I'm just reiterating for the benefit of our viewers. So 11% earnings growth this calendar year, 14% earnings growth in the next calendar year, 2026. And that really brings us back to the central point, Sunil, right? It's all about earnings. The day these earnings start really firing up, we'll see the FBI's return. I mean, they'll take their tactical calls again vis-a-vis positioning and valuation. So this 14% growth that you're talking about for the next year, this primarily you expect will be driven by consumption and financials, right? And those are your key overweights.
Right.
So what makes you optimistic? I mean, I know I'm being a bit of a naysayer here or whatever, but it's just that we haven't seen a broad-based pickup in consumption in so many years. The market's been completely pivoted towards capex. What will change? And the problem is that usually it's been wherever there are savings, it goes to a few discretionary stocks. It doesn't become a wide mass sectoral trend, right? So what makes you confident that that will change? It won't be just about 3 jewelry stocks and 2 real estate, stocks which go up on discretionary consumption.
You partly answered that question, Surabhi, there itself, because I think the pushback we were getting from investors, even during the recent marketing, is that, look, the GST cuts would be helpful, but does it sort of extend beyond a couple of quarters, and how sustainable could the pickup in the consumption be? So I would say make 2 points. One, I think the GST cut benefits come on top of the recovery we were already seeing in the rural cycle. And so we were already therefore seeing not just the high-end consumption doing better, but signs of pickup in the mass market consumption. And I think GST at the margin kind of reinforces or accelerates those trends. There is also the difference between the earlier sort of VAT cuts or even the personal income tax cuts that were announced back in the budget versus the GST cuts that we have been making, is that the exact point you made, that when you have personal income tax cuts, that only benefits a small cohort of the population, whereas the GST cuts are actually much more wider. Everybody kind of benefits given, and it's across different segments. And so we think the impact of the GST cuts should be far wider than we have seen from personal income tax cuts, which obviously was a smaller segment, but also some of that was used in deleveraging household balance sheets. And this one we think should help a lot of the consumption categories. There's also a difference that in the previous instances of VAT cuts, you always had the entry for profiteering law, which means the companies had to fully pass that through. This time around, that's not there. So we think companies have more degrees of freedom in terms of how they pass these GST benefits, and in terms of price point packs and grammages increasing in the sense of higher volumes. In some cases, you do pick unorganized to organized shifts, and so you get some premiumization come through. In some cases, you have better pricing power, and so you may be able to only sort of retain some of the margins. In some cases, you were already spending on marketing and expenses, and so with the cuts now, GST cuts, you may be able to retain, not spend as much, and that's expansion. So to a variety of models, I think there could be sustainable growth, a boost from the GST.
Okay, and that explains why you are so optimistic on consumption, not a small, narrow part of it, but, a pretty wide basket of the Indian consumer. Thanks very much, Sunil. Great conversation as always. You have a good rest of the day, and of course, we'll see you again soon. For the time being, it's time to put the spotlight on corporate conversation. And we have Mr. Vimal Kejriwal, Managing Director and CEO at KAC International, joining in. Mr. Kejriwal, always a pleasure to have you in. So much to discuss, as usual, on the business, on the sector. So let me distill this for our viewers in terms of three key highlight areas that we want to focus on. Of course, we want to understand the impact of the GST cuts on your business. I mean, of course, entirely B2B, but how does it play out? Is there any implication? There's some concern in the market whether the government's pivot towards consumption, whether that means lower capex. So then are orders at risk? And finally, again, GST related, EPC contracts are going to be taxed at 18%. So what does that mean? Let's understand and find out. So Mr. Kejriwal, it's all GST related, right? Step by step. So let's start with your first interpretation on these EPC contracts being at 18%. And overall, I mean, it's all a pass-through. I guess you get input tax credit for everything. But is there any change, positive or negative, from your lens?
Surabhi, good morning. See, first of all, almost I'll say every contract of ours was at 18%. What has happened from 12 to 18 is small contracts which were very, very, I'll say, labor-intensive, with a lot of sand supplies, other items which were at a much lower taxation. So there were very few contracts. At least I don't think we had any contract at 12%. So it effectively does not apply to us or to any of the large contractors that the GST change from 12 to 18 applies. I don't think it applies to, at least I have looked at all my contracts, it does not apply to any one of them. We didn't have anything at 12, number one. Number two, I think the major benefit for us in the GST change would be on the duty reduction on cement, which would help us on the inverted duty structure. Today, if you look at my balance sheet, we have got close to around 500 crores lying on GST input credit. And most of it has been happening because we've been paying a higher duty on the input and we've not been able to set it off. Now that the duty on cement has come down, and which is where our major input credit reversal was pending, that would definitely help. One is on the balance sheet side. Second is also on the cash flow side. Now that you will end up paying 10% less on the cement procurement, I think that's one major item which I'm saying. Third piece which I think we can see is that with the reduction on duty on the solar side, there could be some better economics on the solar side for the developer, and resulting into better economics for the EPC. I think very broadly those are the impacts of GST for us.
Okay, so maybe more solar orders as they have a lesser tax burden now.
Yeah.
The EPC change doesn't affect you because you were already at 18%, and cement obviously is a big boost. On cement, I mean, just to follow up, since it's a big saving, right? It's 10% saving. So what does that mean? Should we expect some of that to flow through the margins anyway? This year you've been guiding for margins to improve to 8%. So how are you going to digest the savings on cement?
So Surabhi, that 8% is on EBITDA level. So whatever savings we'll have would be on the interest side. Because cost mate will not make any difference to us because the GST was in any case billable to the customer. So it is only a cash flow impact for us. Where there could be slight changes on cost structure would be items which were not billing to the customer. Let's say whatever we were spending on the stores and everything else which is there on the consumable side. There may be a marginal impact, but I still don't see that as a major driver for margin correction. But interest can get impacted positively. And also now with what's happening with whatever RBI has been talking with the Fed cut yesterday night, I think there could be some improvement on the below the EBITDA lines.
Okay. So basically some savings on interest costs perhaps. That would of course flow into earnings, so it will be good news for your shareholders. So the other concern, and this is a wider debate though, I mean the finance minister in her response to that question, when we had that conversation with her, she was very committed to capex. She said, whatever I've committed in the budget on capex, we are not pushing back or pulling back from that at all because of the GST cuts. But still there is this, chatter that the government's focus is now consumption. So maybe it starts having some impact on order flows, different segments, water, power, etc. Your thoughts?
I think irrespective of the GST cut, we have seen an impact, at least on the water side. There's hardly any funding happening on the water projects. And then that's a big setback. One is the cash is not coming for the existing contracts. And I think the number of orders which are coming on water side have also slowed down. So that's one impact. As I said, with or without GST, we have already seen a significant slowdown on the water cash flows, especially from the central side. Okay, center is actually nudging states that you need to do better work on the execution and you need to take a better control and payment and all that. But somehow with the state finances, that's not happening. So water is definitely one subject which I think is getting impacted on this. Power, if you look at it, was not it was largely independent of the government financing. Power Grid or NTPC and all that, they have been raising their own money and then they have been funding their projects. So I do not see any major negative on the power projects because of the impact of the cut or the government finances tightening. On the other hand, I think with the interest rates going down, that could have a positive impact on the government financings.
All right. Hi, Mr. Kejriwal. Good to see you, Ben. So what about collections? The last time around you had mentioned that collections in various sectors, water as well was one of them that you said collections were a little bit slower. Has the situation improved?
For water, it has not improved. Let's be very honest. I don't think we have seen any major improvement happening on the water side. I think there's still a little bit of a tug of war between the center and the states as to who will fund what. And I think that's where we are having a problem. But on all other sectors, I don't think we have seen any payment issue. No.
Okay. All right. Tell us, what is the order inflow, sir? As of Q2, what is that number at? And for the year, what are you gunning for?
So as of now, our order intake has been roughly close to 9,000. I think 8,900 or something like that has been the inflow. We have a large L1 position. We do expect significant conversion to happen by 30th September. Our target for the year is around 30,000 crores. Last year, we did roughly 25. So we are hopeful that we should be able to improve it by 20% and reach 30,000 crores.
All right, so we've got a date then before the end of September itself, because that L1 position, you're optimistic that it gets closed out. But give us some idea about the size of it. Close to 9,000 crores of order inflow so far. For the year, expecting it at around 30,000 crores. But this L1, that's a joke on the pack, it seems. How large is it?
So right now, it's around roughly, I think around 6,500, 7,000 crores is the L1 today. Largely, I'll say in transmission, a little bit in civil and railways also. But we expect that most of it, not most of it, at least some part of it would get converted before 30th September. So we should have an order intake coming into 3,000-4,000 crores by 30th September further.
All right. And final question from my end for FY26. How are things looking? I think earlier when we were talking about it for the outlook for the year, revenue growth, I think, was in mid-teens, around 15% is what you're talking about. Margins in that vicinity of around 8.5%, and some debt reduction as well. So revise all those three numbers for us.
So the first two remain where they are. that at 15% or so of growth and margins between 8 to 8.5. Debt, I think the water is still worrying me. I'm not sure how much debt will go down, but I think the interest rate scenario is becoming benign, both in India and international. And I think we are around 35% of our debt is in foreign currency now with the Fed rate cut happening. I think that part of the numbers, I think we should see some improvement happening below the line, below the bottom.
Mr. Kejriwal, before we let you go, I just want to go back to that point on water. So my question to you was more in terms of awards. This whole debate between government focusing on consumption versus capex. So when you say that financing from the center side is going down for water, and that's an ongoing issue. I mean, you've been explaining that to us, that the onus is on the center, wants the onus to be shifted to the states, so they can start financing and clearing the dues as well. But in terms of awards, whether it is the water segment, whether it is power you've already mentioned, or even the railway segment for that matter, do you sense that the awarding activity could slow down at all over the next couple of quarters?
So I don't think a slowdown will happen in the power side. Railway, I think, has been a bit of a issue for all the larger contractors except for the bullet train. So I think if you see, most of the larger contractors are not getting any railway contracts. Okay, execution is a serious challenge on the railway side. As far as water is concerned, what is happening, Surabhi, is that one is I'll say the tendering has slowed down because of the funding issues. Today, if the government does not, the state does not know whether the central will fund them or not, I think they are very apprehensive of floating new tenders. Secondly, whatever tenders come, like if you ask me, I have not won, or probably I have not even bid for a single water tender in the last 2 years. Even if the tenders are there, I think it's not a market where we are there till today, unless and until the cash flows improve and the backlogs get cleared. I think that's the point I was making.
But that makes perfect sense. Unless the cash flow situation improves, collections start improving, I mean, fresh bids will get impacted. On railways, you said you're expecting more slowdown in railway awards as well?
So I don't think the railway awards will slow down. I think the issue on railway side has still been on the execution front, where because of, let's say, blockages, blocks and all that you require, execution on railway projects has always been a pretty slow affair. And because of which, we have seen, many large players getting out of the typical railway EPC contracts.
Right.
However, last 2 years, the focus had been more on the customer side, with new trains and stations and all that. Now we are seeing a change happening, and a lot more tenders are coming out for new railway lines, etc. So I think railway, the tendering has definitely increased from before.
Absolutely, and I think you've been, Mr. Kejriwal, you've been telling us that you've been a little cautious on the railway side on your own part, as some of the other bigger players as well. Thank you very much, sir, for joining us. It's a pleasure having you here on CNBC TV18. Thank you. 90 points on the Nifty, 25,420. Have to mention Poonawalla FinCorp. Poonawalla is up 11%. Wow. It was not there in the morning when we started, but it's in the mix now. And how? Look at that. That's a 50 rupee move. It's the #1 volume-led gainer on the NSE. So that is Poonawalla. There is IRM Energy. It's 372. It's 13% higher on IRM Energy. And #2 in terms of volumes, volume-led gainers. And there is Newgen. Newgen is up 7%. Actually, all three were not there in the mix in the morning when we opened. But Newgen is in the #3 spot. Price and volumes, 943 on Newgen. And look at the volumes take off on that one. Actually, there's lots of new stuff which has come through. Zentech, etc. I mentioned, but there is Sonata Software, which is up 6%. There's a big jump. The L&T, Mindtree and LTTS, both are up 3% apiece as we stand. IOL Chemicals is up about 4%. So this is a new list now. The initial sort of, pop mostly is all flipped to newer and newer names, which means that the breadth is also expanded. In 90 points on the Nifty, we take a quick commercial break here. We have the management of G Shipping joining us on the other side. Stay tuned.
Welcome back. This is Corporate Radar, and as promised, let's shift focus to GE Shipping. Now, the company has recently sold, a 2005-built Suez Max crude tanker, and also has planned 2 fleet acquisitions in Q2. We have with us Mr. G. Shivkumar, the Executive Director and the CFO at the shipping company. Hi, sir. Good morning. Thanks a lot for joining in. Well, we're coming to you in just a bit, but for now, just highlighting the 3 big talking points that we're going to be looking at. There's been multiple sale purchases of contracts for vessels. Point number 2 is the current business landscape and the spot rates. And point number 3, changes due to the geopolitical developments and how things are panning out on that front. So lots to discuss. Let's get straight to the action then. Mr. Shivkumar, always a pleasure, sir, having you on the show. Lots to talk about, so let's get straight to the point. 3 ships have been purchased, 1 ship has been sold. How are the asset prices for the new as well as the older ships? And are there any plans on conducting more such activities, that is, buying or selling some of these ships? Do you have some kind of outlook in the near future?
Morning, Nigel. Thanks for having me. Yes, we've currently contracted for purchase of 3 second-hand vessels, 2 bulk carriers and 1 Suezmax crude tanker. And we have contracted for sale of our oldest crude tanker as well. These transactions, and this is what we've been doing over the past 2 years, prices have been significantly higher than our comfort levels. And therefore, we've been focusing only on maintaining capacity, not doing capacity expansion. So we've been selling older, less efficient, less desirable vessels and moving them to similar types of vessels which are younger or more marketable. So that's what we've been doing. For instance, you'll see we sold a 2005-built Suezmax and we bought a 2010-built Suezmax. So what we're doing is we're extending the runway till we can get the market prices that make us comfortable to do a significant expansion.
Okay. All right. So, Mr. Shivkumar, just to get this clear, obviously the older vessels, they'll be, calling for higher OPEX, higher amount of spends as well, and profitability could be relatively less. That's why you're looking at getting in the new set of vessels. Is that correct?
OPEX, not so much. There is sometimes maintenance CapEx, which is higher. However, what happens is on the revenue side, because they are less freely tradable beyond a certain age, and therefore we'd like to have our ships freely tradable to maximize revenues. It's more on the revenue side than on the cost side, really, so that we can maximize revenues by having the maximum optionality for trading those ships in the international spot market.
Okay. All right. Give us some more color then. How are the new vessel additions, sales expected to affect the company? Say the revenues, the margins, the NAV as well. If you could give us some kind of insight.
No change really in the NAV because we're buying them at market and we're capturing part of the NAV gain by selling the older vessel. So we'll book a profit on sale on the old ship that we sold. In terms of revenues, yes, the capacity goes up, but finally for us, it's the rates which have the bigger impact on revenues. The capacity, of course, is a factor, but the significant swing factor here are the rates. These capacity changes, we're talking about 3 ships, of which 2 are incremental. It's not huge. It's on a 40-ship fleet. It's 5%. The rates move by 10, 20% in a week. So that's really the big factor that moves revenues.
Yeah. Mr. Shivkumar, what's the net? Good morning, Prashant here. What's the net outflow because of these transactions?
This would be a net outflow probably in the region of $60 to $70 million, something like that. $60 to $75 million.
$60 to $70 million is the net outflow after these, because of these transactions. And you fund this how, and what's the cash levels post this?
Yeah, so we have about $800 million in cash currently. So we'll just fund it out of cash for now. We'll be using cash to fund, our a lot of our expansions before we go into taking debt, really, because there's so much cash sitting there. We might as well use the cash before we really draw down any debt.
Okay, so you're using basically about 10% of it.
That's right, less than 10% of
less than 10% of your existing. And are you doing this for many more, or are you done with these vessel swaps in that
We've done,
sense?
I think, 8 or 9 of these transactions so far. We would be looking to do some more. We are always looking at these opportunities to do some modernization of the fleet. And if we get any transactions that make sense, we will do those. But again, mostly we'll be doing just the switches, which is you sell an older vessel and get into a newer or a better spec vessel.
Give us a sense of how business is across segments now, Mr. Shivkumar, now compared to, say, we left off at the end of the last quarter.
That's right. So the one significant thing which has happened in the markets, in the crude tanker market specifically, is that OPEC came back with more oil into the market starting from May, June. That's starting to have an impact on crude tanker markets now, which is basically you're having more oil that is being transported, which means you need more ships. So the rates for the large crude tankers have gone up a lot in the last 2 weeks. We don't have the VLCCs, which are the 2 million barrel ships. So those have gone up to, I think, $80,000 a day from maybe $30,000 to $40,000 a day 2 to 3 weeks ago. And those typically are the most sensitive to OPEC oil production and OPEC exports. It hasn't filtered through to the other sectors, a little bit to the Suezmaxes that we operate. So those also have gone up. Net, we are about at the same levels as last year, a little bit better, maybe a few $1,000s better than we were 2 to 3 months ago in terms of spot rates for Suezmax tankers. For Aframaxes, it's much of a muchness. For MR tankers, we are probably better off by 1 to 2,000. And again, MR tankers that's the sector where we have maximum exposure. We run 12 ships in that sector. Those rates are up by about $1,000 to $2,000 a day compared to where they were a couple of months ago. Coming to dry bulk, we've had a surprisingly strong market, mainly on account of, and Nigel mentioned geopolitics, possibly on account of some front loading of grain imports by China, soybean imports by China. We've had the smaller ships having a pretty strong market over the last 2 to 3 months. Basically, the US grain season starts in October, the soybean season. And I think they've been stocking up, the Chinese importers have been stocking up from Brazil and Argentina, preparing for a situation where tariffs may make that grain unaffordable.
Point taken, Mr. Shivkumar. That's a pretty comprehensive sort of picture that you draw out. So all told, I mean, at a company level, what does this mean? I mean, as we progress through the quarter, where does it leave us?
Currently, where the rates are sort of net around where they were a year ago.
Okay.
Maybe marginally better than the previous quarter for some tanker sectors, but not very different. So prices are pretty high. Prices of ships are pretty high, and that's why we are not doing any significant expansion. So we are still waiting for those opportunities. So for now, it's a holding operation. We make significant cash flows at these rates, significant free cash flows at this rate. We are still really collecting the cash and waiting for the market to give us the opportunities and the prices to buy.
Always a pleasure, sir, having you on the show. Thanks a lot for joining in. Post your Q2 numbers. We'll re-invite you, and maybe we'll try to pull out some numbers as well from you. Wishing you a good day ahead.
Thank you.
Well, I think the street likes actually what Mr. Shivkumar had to say. I think the stock was more or less flattish. It's seen a bit of an up move here in the last few minutes or so. So keep an eye out on the bottom of your screen. Those are the important takeaways. Let's get in Vijay Rajani, though, Senior Technical and Derivative Analyst at HDFC Securities, who's back on the show. Hi, Vijay. Thanks a lot for joining in. What's your call on the index? You know, a good 1,000-point rally is what we have seen in a matter of a few trading sessions, after underperforming, mind you. But now the Nifty Bank is on a winning streak. The Nifty is up, I think, 11 out of 13 trading sessions, taking today into account as well, 12 out of 14 trading sessions. Good for more? Or do you think now you get to a stage where you see some kind of consolidation, some kind of a near-term hurdle? And also fill us in with a couple of your stocks.
Yeah, good morning. So definitely the overall trend has been positive and the continuation of an uptrend is there. There was a breakout around 24,900 where we saw a trend line breakout, and after that continuous participation is there from the different sectors. So the way sector rotation is happening, it looks like that market should continue to do well and it will continue to extend the rally which has started from the recent low of 24,800. So yesterday we saw that Nifty also surpassed the crucial resistance of 25,250, which was the previous swing high. The immediate resistance I see is around 25,550, which was also swing high registered in the month of July. So right now, the best strategy for the trader in the Nifty should be the trailing stop loss. And as of now, according to us, 25,250, which happens to be the previous swing high and resistance, now it will act as a support. So 25,250 should be the trailing stop loss right now, and we can expect some higher levels from this level. And the way sector rotation is happening, like many sectors have still not participated in the market, like IT, real estate. These are the sectors, then capital goods, some of the PSU stocks. So many sectors have already done well and many sectors are yet to do well. So I think participation will come and short covering will come from them. FIs are still holding much short position in their index future position. So we can expect further short covering from them. So we are bullish on the market right now. 25,550 is the immediate resistance and followed by 25,670, which was the swing high resistance. So yes, one can continue to hold on to the long position with the stop loss of 250.
Okay, all right. What about individual stocks?
Yeah, so today IT stocks have participated well since morning. Some gap up opening is there, and I still see upside from this particular sector and participation. So Infosys, the large cap IT stock, looks good to me. 1550 is the level one can go along around this level. 1520 should be the trading stop loss on the upside. We can expect a target of 1595. The second pick I would choose from the capital market segment. Yesterday, CAMS did very well, and today we can see some other stocks participating in this sector. So CDSL has given a fresh breakout on the chart. So capital market theme can work out for a couple of days at least. So CDSL around 1610 can go long. I would suggest a trading stop loss at 1585. On the upside, I'm expecting a target of 1650. So Infosys and CDSL on the long side with the mentioned stop losses.
All right. Vinay, good to get those particular trades. By the way, you've got this massive move in Poonawalla today, Vinay. Yeah. And I think it's coming up to the highs of whatever, 520 or so, I think was the high. Any thoughts here?
Yeah, so it is a very good breakout with the volumes, and NBFC space has been doing quite well. We saw that Bajaj Finance, Finso, and the last session in the last show which we did, we recommended Chola Finance, and today Poonawalla Finance has participated. So the primary trend was up. It was into consolidation. Now today's move gives lead to the resumption of an primary uptrend. So it is a clear-cut breakout on the chart. The immediate support we can say short-term for the trader is around 475. That should be kept as a stop loss. And yes, we can expect some higher level. 520 is the all-time high level I can see on the chart. So yes, there is a good chance that it will surpass that level and do well in the coming days.
All right, Vinay, thank you very much for that. So those are some trades, and that's a view on Poonawalla FinCorp. But I think Gaurav is standing by now on Poonawalla FinCorp. Gaurav, tell us more. Morning.
Well, yes, fundamentally, if you look at Poonawalla FinCorp, the thing which is supporting the stock right now is the capital infusion. Now, the promoter has infused around 1,500 crores in the business. Earlier on 25th of July, during Q1 results, they had already announced that the board has approved this infusion, and now they have gone ahead with the infusion. If you look at the stake now, the stake of the promoter has gone up from 62.4% to around 64%, and after that, there are other different changes as well. The book value per share now. This is going to be a value accretive. The book value per share will go up almost by 13.4% because of the stake increase. And let's also not forget that this is also during the time we also have second quarter's results which are coming in a few days. So definitely timing is also something which is positively working for the stock. Remember, yesterday the stock was trading in the range of 440 and this fund infusion has happened at a cost of around 452.5. So definitely that is also something which is positive. And as a result, we are seeing a sharp uptick in this counter.
Okay, all right, Gaurav, thanks a lot for that. Clearly, the stock up and about, up close to around 10% as we speak. I'll tell you what, we'll slip into a short break. You come back, Manisha Gupta is waiting for us on the other side. She'll tell us what what's going on in the commodity markets. Don't go anywhere.
Welcome back. It's time to talk commodities. We have Manisha in the house to tell us how the commodity markets have taken into that 25 basis points rate cut. Manisha.
Well, thank you for that. You know, it was a huge run-up that we saw in many of these metals. The open interest was also increasing. The buy call was there. There were no sellers in the market. But now that the event is done with, we are looking at some sigh of relief and some profit-taking as well. And the US Fed has signaled 2 more rate cuts as labor market weakens. There also was a statement, various statements, by the way, from Powell. But one thing that the market seem to be hinging on right now is that Fed is in a meeting-by-meeting situation regarding interest rate outlook. So that's what the street is looking for. So it still is a bit of a suspense as we go forward from here. If you look at the gold prices, then we did see a record high as soon as that 25 basis point rate was cut. We saw an all-time high of $3,704 an ounce, and then there was a big profit taking that you saw in the overnight markets. We saw gold declining all the way to $3660 an ounce as well, and that's exactly where it seems to be trading right now. So while gold was down 1%, we saw silver down 2%. 2.5% of a decline is what platinum also put on table, and copper fell by 1.5%. So there was a sigh of relief. There was finally some profit taking with the event now done, and the market's reading into the statements there. But when it comes to gold, and with the kind of uncertainty that we are in right now, with expectation of more rate cuts and the central bank buying and the de-dollarization theme, most of the banks still believe that you're looking at higher gold prices going forward. Commerce Bank report came yesterday, 3,600 of an average in this year, 3,800 of an average in 2026. Deutsche Bank report also says that $4,000 an ounce of an average price is what they're looking at in 2026. So very bullish cues still continuing from banks. Goldman Sachs has talked about $5,000 an ounce in an event that you see treasuries move in case of gold. Even a 1% move could take the prices on the higher side. The other one that I want to talk about is copper. And here as well, we've seen profit taking coming in, but not for too long, because the markets believe that you are looking at demand going higher. At this point in time, it also has to do with supplies, though, because Chile expects national output to increase going forward. They're expecting a 6 million tons of a record production by 2027. It's not just Chile, by the way. The state-run Codelco in the month of July has seen an increase of around 6.4% in sense of production, and BHP's Escondida is also talking about 7.8% of an increase. So immediate supply increase is what the street seems to be working with right now. And the China announcing 5% of a decline in production in September till time really seems to have been nulled by this. So with major moves done, the markets do anticipate there could be some consolidation today and tomorrow before we start seeing buying come back in for many of these metals.
All right, Manisha, thank you very much for that. Interesting as always. Well, we are coming back after a quick break. It's the JP Morgan conference curtain raiser. Latha in conversation with Sajid Chinoy and Sanjay Mukim. So we've got the economy and equities both covered. Take a break and see you on the other side.
A Fed rate cut has just been announced and 2 more are likely this year. In India, a massive indirect tax cut, GST cut, goes into effect on Monday. More rate cuts in India too may come. To parse the impact of so many tumultuous changes on Indian markets and macros, the JP Morgan Brain Trust is with me. Sanjay Mukim, the head of India Equity Research, and Sajid Chinoy, head of Asia Economic Research, JP Morgan. Welcome, guys. What a great time to have your JP Morgan 10th Annual Investor Summit. I mean, such a crucible of changes. Sanjay, therefore, to start with you, September 22nd, your conference day coincides with the GST cut going into effect. So I just wanted to ask you, you all must have parsed the impact by now. Yep. After the Q1 earnings, you may have a forecast. Have you upped or changed any earnings?
We haven't yet, and it's great to be on. Thank you for having us, Lata. So it was not by design that September 20th. That's a week we do it every year. Okay. But I would argue to that point you made that expectations in India have actually been cut, quite a bit, and quite early in the fiscal year. So normally what you get, typical sell-side behavior, is that earnings are cut towards the second half, when nobody cuts earnings in the first quarter because, there's 9 months to go and we'll wait it out. But because we've got such cautious feedback from corporate India in general, that there's been a significant amount of earnings cuts in the 1 quarter already in the year. And therefore, you're starting off the second half with a very supportive pace. And while it's still early days to say how much of an upgrade or if we get upgrades at all, but the base for earnings now looks far more favorable. Whereas on the other side, you've got the support to consumption from the tax cuts in February and these GST cuts which have come through. And of course, remember that the Indian market has got far more interest or far more representation on consumer-facing companies than capex-facing companies.
Yes.
So overall, you are likely to see support to earnings. Expectations being low is a good start for looking at equity.
But has it pushed you overweight on, anything, consumption, discretionary, financials?
We are overweight, India in the EM context, and we are overweight discretionary in India as well, right? Because there is a clear shift in policy preference to try and drive the consumer part of the economy a little out of the rut it has been in, let's say, for a few years.
I have lots to ask Sajid on consumption, but before that, the big event that is just behind us, the Fed rate cut. From an India standpoint and from a global growth standpoint, what are the takeaways?
So a couple of things, Lata. First, the 25 base point cut was no surprise. I think 2 things I was looking at was that it was important that there was only one dovish dissent, which was Miran. So 2 governors, as we know previously, voted with the consensus. And that actually is the more important takeaway, that the independence of the Fed is being prioritized more than personal ambition. I think that's an important takeaway.
And that's why the dollar didn't fall further.
Exactly. So you had both, Bowman and Waller, who had previously voted against the consensus, now joining the consensus to say the Fed's very much behind their chairman. The other takeaway for me was that the chairman described this cut as being an insurance cut. And that's not a surprise because we've been arguing for a long time that tariffs and immigration are both stagflationary shocks. They simultaneously hurt growth and push up inflation. So the Fed did this dilemma at this point where the labor market has slowed meaningfully, and the worry is that the US may slip into recession, but at the same time, core inflation is firming and firming and firming. Exactly. So the way we see it is if the labor market were to crack, then the Fed will have a very long easing cycle, no matter where inflation is, because they will presume that a recession is very disinflationary. But if the labor market, if this is a head fake, and the labor market stabilizes, it's important to realize that the break-even rate may be lower in the US now because of all the anti-immigration efforts. Okay. If this is a head fake and the labor market stabilizes, then this could be a much shorter easing cycle because this is purely insurance. Okay. The implication for EMs is not very much. The point is, unlike previous cycles, the dollar has weakened so much in the run-up to the Fed meeting over the last 6 months. That's what matters for EM central banks. So even without the Fed moving, in the last few months in Asia, for example, we've seen a series of cuts across the board. Thailand, Indonesia, Korea, India, the Philippines. So EMs now don't need to wait for the Fed necessarily in the wake of a weaker dollar.
A serious Asian disinflation. I'll come to that. I tend to get carried away by these topics. But, the one question I would have asked Sajid, nominal GDP. While the real GDP is very good at 7.8, reminiscent of the 2004 times, at 8.8, does that, impinge on you when you are doing an earnings growth forecast?
It will. And this is something that we've been highlighting to our clients as well. If you roll back, Lata, let's say to FY23, there were several quarters where nominal GDP growth was north of 20%.
Yes.
And when that happens, your 1,000 stocks in the market, the median growth will be high double digits, right? And everything looks great, and you straight line those growth forecasts, you double the multiple, and the market's a multi-bagger. Now, we are single-digit nominal growth, and we will probably stay around the vicinity of 10% for the next 3 years. So we'll have this fallacy of composition in equity earnings forecast because every analyst will bottom up say, my company can grow 15%, but with the nominal GDP at 9, 10, only a handful of companies will deliver double-digit growth, right? The median growth of earnings in the market will be a multiple of that 10%, probably a low multiple, right? And therefore, we will have this phenomena where growth from corporate India will get concentrated into the few that can deliver double-digit growth. In our framework, the ones that deliver growth will still command those premiums and will still command the multiples, but investors will need to be careful in assuming that almost everything under the sun will have double-digit growth because it is India.
Oh, absolutely. But Sajid, what is the inflation trajectory for India itself? Because the GST cut will take away a little bit from prices. But the RBI had forecast 4.9 as 12-month ahead for the second quarter next year.
So inflation is very benign even without factoring in the GST cuts. If you look at the full year as a whole, because each quarter will change. FY 26, year ending March 26, our average is 2.8%.
That's the market consensus.
Extremely soft. Now, if you add on to that some fraction of the GST cuts, I mean, the RBI should look to the GST cuts. These are one-time price changes. This isn't disinflation. But you're looking at about, 3%. I think the issue for the RBI is that we've already kind of bottomed out. And if you look forward, base effects have an important role to play. Base effects depressed inflation this year in the middle of the year. Base effects will push up inflation in the first half of the year. First quarter looks above 4%. Second quarter could be close to 5%, but that's coming on a base that was 3% in this year. So you have to average these things out. So I think inflation for the RBI is not the issue right now. I think from the central bank's perspective, I would think that they have front-loaded their easing. They're very focused now on monetary policy transmission. We're seeing good transmission in the banking sector on fresh loans. Bond yields have gone the other way, but financial conditions more generally are easy. And I would say that if the Trump tariff shock persists, my own advice is to take a more surgical approach. This is a sectoral hit on certain sectors. We have an example from COVID before. When there's a sudden demand shutdown, we know what to do. And I think a combination of liquidity support, regulatory forbearance, and targeted fiscal support, I think, will be more efficacious, even as the RBI waits to see how things pan out globally and domestically and holds its any gunpowder.
Very quickly, rate cut October?
Not in October.
But you expect one more?
Well, I think it'll depend because 30 seconds, Lata, you've got the headwinds of the Trump tariffs, which are very clear, but you've also got some building domestic tailwinds in terms of higher consumption, monetary easing, direct tax cuts, indirect tax cuts, lower inflation, good monsoon. So the RBI and a good, strong GDP print. I think the RBI will wait and see, like the Fed, how is growth panning out? Low inflation allows the RBI to cut in the future, but they'll want to see what the growth trajectory looks like.
Fair point. But, how is the FII interest in your conference? Because we are so clearly the underperformers. Is it reflecting in interest?
Interest is very strong, Lata. And I was worried... Ulta. I was worried that given the market's been flat and other parts of EM are actually doing well, that you might see subdued participation this year. This is the 10th conference we're doing consecutively. It's the 80th year for JP Morgan in India as a firm. This is the strongest ever, the largest ever conference we've organized. We have 1,200 participants coming in. We are overwhelmed by the vote of confidence that we've got from our client sets. And again, content-wise, participation-wise, there is absolutely no sign of any waning of interest in Indian equities from both domestics, of course, but even foreign investors.
What are investors waiting for? What are the highlights, if I may ask?
I think let's think of the setup for Indian equities as well. The underperformance has been very stark, especially if you measure it in dollar terms. It's north of 20% YTD. Okay, on multiples, India is now trading at, let's say, a 10% discount to the S&P. Now, we've written research on this quite often to say that India's multiple tends to track S&P more than it tracks EM. So I said earlier, our earnings have already been cut. So expectations have been right-sized to a degree. And we are trading at a 10% discount. And now we've got these domestic catalysts that Sajid has talked about. So the setup looks great for a bit of a catch-up.
The inflection.
That's right. And what people are waiting for is signs of that inflection. So everybody is here to talk to corporates, to talk to people on the ground, to figure out, are we seeing any now, or are we likely to see any during Diwali or in the December quarter, right? So to build confidence in what is currently theoretical, but likely to happen, I think that's what's driving everybody to participate.
And you have a lot of corporates representative of consumption.
That's right.
Okay, just a word on financials. Sajid says at some point in time there can be one more cut, and that's kind of the feeling I'm getting, that no, people are not expecting in October, but they see the space. So does that make financials still something you're worried, not financial so much as banks, because there'll be more margin pressure?
Yes.
Or are you happy that they will be seeing credit growth?
So it's two stories there, Lata. One, of course, is that there will be margin pressure. And the charts are very, very clear. Lower rates do drive NIMs for most large banks down. Okay, it becomes difficult to manage that. However, the hope is that that is the catalyst that drives further lending into the economy, right? If you do the math on how much it now costs you to buy an entry-level car, right? So you build in the GST cut and you build in the lower rates and you look at the delta in the EMI, a middle-income family has to pay to buy their first car. That's a very material delta on the loan.
Yes.
Right? And therefore, the argument is that all of these are significant changes and should be a catalyst for volumes. So yes, the margin comes under pressure, but the hope is that over the next 2 or 3 years, for the bank's financials, the volume outlook starts to improve as a consequence of what is happening.
Okay.
And that should therefore be good for the sector.
I spoke to Dixon a few days ago, and they are so bullish on, a 10% fall in the price of a 32-inch plus television, according to them, is going to make a very big difference. But, I have to run into a break. Give me just 2 numbers. What is your GDP growth for this year, nominal and real?
Yeah, so I think real will be somewhere in 6.5 and 7.
Really?
Because on the back of a nearly 8% first quarter.
Real GDP 6.5 to
7. Nominal could be between 8 and 9. And therefore, it's important for investors, when they look at nominal variables, credit growth, GST collections, tax collections, we have to be realistic. It's not possible to get 13-14% credit growth if nominal is going to be 8 or 9. That has to be your anchor on which you forecast earnings, credit, taxes, GST collection, which could be high single digits or very low double digits.
Okay, well, actually, even now, although the credit growth is 9.9 or whatever, under 10, if you count the bond market borrowings, then credit to the commercial sector is 13%. So probably we are managing 1.5x credit growth for the kind of nominal GDP. But quick break, I have more questions for you all. We are back. Bazaar viewers, you will get chartbusters, but we will play the entire show after market hours.
The Indian market opens higher, aided by positive sentiment from the Fed's 25 basis points rate cut. The Nifty crosses that 25,400 mark early in trade, scales 55,800 for the Nifty Bank. And we're also seeing the Nifty IT doing well as it's crossed past important technical levels.
Cohance Life Sciences dips over 5% after around 8.9% equity worth around 3,770 crores. Changes hands via block deal. Sources says that Jusmiral Holdings, an affiliate of Advent Holdings, is likely to have been the seller.
Shares of Poonawalla FinCorp surged to a 52-week high after the company's promoters complete a 1,500 crore rupee fund infusion, increasing their stake from 62.5% to near 64%.
Saregama trades higher as Nuvama retains its buy rating on the stock with a target price of 630 rupees, with paid subscription expected to be the next growth engine for the company.
Page Industries slightly lower today, down 2%. HSBC issues a reduced rating on the stock. Their target price is at 41,040 rupees. Sees limited potential from the launch of their athleisure collection, JKY Groove.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the Fed delivered overnight what was expected. That's a rate cut. Indian markets have been on a winning streak. We're up in 12 out of the last 14 trading sessions. And the Nifty Bank, 12 and 12. So pretty good times, Mangalam, for our markets. For the time being, all the frontline indices in the green.
Good. Nigel, both the engines firing. We have the Nifty Bank, which has been doing well, the IT index doing well, a bunch of sectors doing well, plus we have the fuel of short covering as well. That may increase as we progress to higher levels on the frontline index. But as that happens, there are a lot of stocks and sectors that we have to discuss. We do have with us Lavina Cordros, who's the capital goods, logistics and utilities analyst at Jefferies, joining us now. Lavina, always a pleasure speaking with you. Just the obvious question, because over the last 6 months or so, ever since the budget was announced, seems like things are moving from capex to consumption. And with this, GST cut coming in, etc. as well, do you think that reduces the elbow room for the government to invest further in capex and add more to consumption? In light of that, how does the sector look over the next 12 to 18 months? And what do you think is still backable?
Firstly, good morning and thank you for having me. Just on your question, very, very relevant, right? So yes, post the elections last year and especially in the budget this year, right, we saw the government discussing a focus more towards consumption versus capex. So you have seen a slowdown in the capex cycle. However, you are seeing certain pockets of capex doing exceptionally well, right? So for me, if I look at the overall capex cycle very top down, you have end markets of power, you have end markets of defense, which are doing extremely well. But outside of that, very fair that even if you look at the spend of the budget, right, earlier capex spend, let's say particularly between 2021 to 2024, the budgeted growth for capex was 15% above, let's say on a CAGR. And now you've come to a point where what's being discussed is a medium-term CAGR where the capex to GDP ratio will get maintained. So probably implying closer to 8 to 10% industry-wide CAGR. But again, like I was highlighting, if you're in the right end markets and in the right pockets, there's still opportunity to do very well on a stock-specific basis.
Hi, Lavina. Good to see you in and finally have you on the show. Well, expectation is that consumption will pick up, right, in the second half of this fiscal. That's because of GST 2.0. Do you think finally that long-awaited private capex push, now they don't have an option, they need to show the money and need to lend support. Do you think that's in the offing?
So again, very interesting you asked this question, right? So I'll tell you how I'll put it. While there's a general perception that private sector capex is not doing well, again, in private sector capex, if you look at pockets, right, power, a lot of the capacity is actually being set up by private sector, larger corporate groups, mid-sized groups, smaller groups. Housing as a capex end market is continuing to do very well, which is highly private sector driven. If you look at data centers, PLI linked schemes, again, all of over there, private sector capex is doing very, very well. There are a couple of larger corporates who have also commented that they are seeing some revival on the private sector capex side. So again, it's back to end pockets. Broader level, I think private sector capex to pick up in a very, very big way is going to take time. Because if you just think about industrial capex as a whole in India, right, A lot of that goes into oil and gas.
Oopsie.
We also require a big infrastructure push. So as infrastructure push slows down a bit, you'll find that capex in those areas will also.
All right, we're just trying to repatch that connection. It's slightly unstable, but I think we'll get Lavina back. Meanwhile, just keep an eye out on the market. Okay, Lavina, I think you're back and on a stable connection. So continue your point.
Oh, no. I was just saying that, as you know, private sector capex again in pockets is picking up. Broader based is going to take longer because, again, broader based, if you think about it, you need investment in cement, steel, oil and gas, and a lot of that also needs a bigger infrastructure push.
Got that. So let's get a little more specific. Then you did say that defense is doing well over the last few years or so. The ordering activity has picked up. The indigenization theme has come by. We've seen that movement in a lot of these defense-focused stocks as well. If you had to back some capex themes from here on, which ones would they be? Would you look at domestic companies, capital goods companies? Do you look at some of these MNC conglomerates? Or, are there any other specific areas where you would, as much as individual stock names you can take, if you could give us a sense?
So I'll tell you what, I'll discuss business models here. I'm not in a position to really discuss stock recommendations. But let's say in power equipment T&D market, right? You do have companies that are present over there, like let's say Siemens Energy, you have a Hitachi Energy, you have GE Vernova T&D. Those are companies present in those sectors. In defense, you have the larger names like an HAL, a BEL, for that matter, even the shipbuilders and smaller companies like data centers and so on. So these are companies, of course, you'll have to have a look at valuations and then decide which investments make more sense than others. But you have these host of companies which are in the right end markets. Data centers is a very interesting area. I mean, in data centers, again, you have beneficiaries in your power equipment names. You also have beneficiaries in your automation names. Companies, NABB present, Siemens.
Okay. All right, Lavina, I think we've got you on a bit of a scratchy line, but thanks a lot for joining in. We look forward to having a longer chat with you in the time to come. But for the time being, we got a broad gist of what you had to say. By the way, the markets continue to hold well into the green. And now the Nifty Bank, actually, from being a relative underperformer, that's leading the way. That's up a triple century today. So good going on that. Just a few trading sessions ago, it was holding below that 54,000 odd mark. And now it seems to have got its mojo back. There are shorts in the system. A lot of the shorts in the Nifty Bank. The FI selling has come down. In fact, you're getting the institutional number net that's been a buyer of the last few days. So that as well bodes well for the Nifty Bank.
Yes, and before we slip into that short break, if our director can pull up the Nifty Bank with both the 50 and the 100-day moving average, you would see that it's crossed those important levels. So that's another thing that is causing that further upside to the Nifty Bank. After having crossed the 20-day moving average, which is about 1,000 points away from here, we will obviously, we were expecting a 1,000-point up move. So there you have it. Both the 50 and the 100-day moving averages, Nifty Bank has crossed past that. All right, we take a short break, come back, tell you more on markets and a lot of stock-specific action. Stay with us. 96 points for the frontline index. The Nifty Bank doing a lot better. We have the mid-cap end of things looking a lot better as well. For the second day running, nearly 2 stocks advancing for every stock which is declining. So market looks good. The question is, how much more? Sachidanand Taker of Trade Bulls joins in for a quick technical check on the market. Sachi, we were, wondering whether there would be some recovery that would happen. Slowly and steadily over the last 10, 11 sessions, we've put on a near 1,000-point uptick from the lows that we saw, just before last week. So do you think it will accelerate from here on? Or do you think after this 1,000 points, there is consolidation likely in a 200, 300-point band? Are there any important levels you're looking at?
Good morning, Mangalam. Good morning, Nigel. Clearly, the market has been performing well, but it has been a very gradual, steady up move. The rotation has been really healthy. We have the Nifty IT also contributing now. So I think from a momentum perspective, this particular move may extend towards 25,620 is what we are observing right now. Even if we see a decline, I think the supports are well established at 24,840, 880 kind of a zone. So until unless the Nifty trends above this, the bias for the market remains on the positive side. Even from a momentum perspective, the ideal stop loss level can be placed at 25,340 on a closing basis. The gap up that we have seen is very significant because we have the Nifty IT, Nifty Bank, and a lot of other pockets have also started performing. So I think it's a very steady, healthy up move, which may extend towards 25,550, 620 kind of a zone during this particular series itself. Post that level, we do expect a kind of a consolidation, but as of now, there are no signs of any weakness or exhaustion. So probably we may see this gradual up move getting continued in the Nifty.
Got it. Okay. All right. What about individual stocks? What's in your radar?
Good morning, Nigel. Adani Energy Solutions did display a breakout from a falling channel sequence. Now, if you look at the price action, it has already exhibited fresh signs of an impulse getting developed. If you look at the way its 200-day exponential moving average is placed, which is placed at around 850, there's also one more hurdle at 860, where its 50-week exponential moving average is placed. But if you look at the overall sequence, this looks like a classic fresh bullish impulse unfolding. We have the weekly RSI giving a positive crossover after a while. So we are expecting that this particular rally may see a good amount of momentum, and we may see this move getting extended towards 896, 900 kind of a zone. So we are recommending building long positions in Adani Energy with a stop loss at around 822 on a closing basis. The other stock which has hit our radar is Brokerage Realty. Even here, if you look at the immediate data, we have seen a consolidation base somewhere close to around 1640, 1660 kind of a zone. It looks like a classic double bottom formation, which we may see unfolding soon, and the price targets are placed somewhere close to around 1750 on an immediate basis. Even here, the 50-day exponential moving average is placed at around 1680. So this is the immediate hurdle. The moment we see this particular level getting surpassed, we may see very strong short covering move unfolding in this particular counter, which may push the stock towards 1830 eventually. So we are recommending building long positions here in Brokerage Realty on the futures. The stop loss can be placed at around 1662 on closing basis. The first target would be 1750. Second target would be 1830.
All right, Sachi, thanks a lot for that. Adani Energy Solutions and Brokerage Realty are the two stock picks for today. With that, let's get you some more ideas for profit. Our colleagues from Money Control Pro standing by. Kanchi Shah has a stock. Kanchi.
So the company that I've picked up for today is Hero MotoCorp, which is India's two-wheeler leading manufacturer. So several factors make us positive on the stock. Firstly, the demand in the two-wheeler and the motorcycle segment remains strong with the festive season in full swing. Also, the recent GST cut from 28% to 18% should further boost the volume. With Hero products, prices are expected to decline between 5,500 to 15,500 depending on the model. The rural demand, which is a key growth driver, has also been doing exceptionally strong. Hero is also accelerating its premium portfolio with aggressive new launches, including 2 upcoming products in the 125cc segment. At the same time, its electric vehicle business continues to gain traction. So the EV push is delivering results, with the market share rising from 4.7% in May to 7.3% in the first half of September, which is reflecting increase in customers' acceptance for their EV products. So the company's global business has also shown strength, recording a 27% year-on-year growth in the Q1. So this adds to diversification and enhanced long-term earning visibility of the company. On valuation, the company's stock trades at 87 times FY projected earnings, which we see as reasonably valued compared to the peers. Supported by strong demand tailwinds and premiumization and EV momentum, I think that the investors can accumulate Hero MotoCorp for long-term gains perspective.
Thanks, Kanchi, for joining in and explaining that to us. For the time being, we'll slip in a short break. Come back, continue to focus on markets and on individual stocks. Don't go anywhere. Welcome back. Let's focus on Hindalco. Well, the stock's in focus following a fire incident at its US-based Novelis plant. Now, on September 16th, a fire broke out at the Novelis facility in Oswego, that's in New York. Fortunately, no injuries were reported either from the fire itself or during the firefighting effort. So that's good news, right, from a humanitarian perspective. The production, though, at the plant is currently halted, with the company now investigating the cause of the incident. Importantly, the plant is insured. So that should give, shareholders some kind of comfort, which will cover both the property damage as well as the potential business interruption losses. However, the impact could be rather large, going by the size of it. because the Oswego plant accounts for a little more than 10% of Novelis's total production capacity. I was just looking at what all is available on the website. It appears the plant is close to 400,000 odd, and importantly, it's one of the key sites for manufacturing high margin automotive business. So because of that, it could be accounting only for around 10% of the total volumes, 10 to around 14%. That's the broad range. But otherwise, profitability could get hit because it has exposure to the high margin automotive space. So keep an eye out on the stock. Explains why the stock is a little under the weather. As it is, Q2 should not be great because they're going to be having the impact of higher tariffs that will hit, but that's already guided for. So keep an eye out on this development as well.
All right, take that point. Nigel, thanks a lot for that. Temporary disruption out there at this plant because of fire. Good part is no one is hurt. Cohance Life, that's the stock on our radar. Saw a bunch of big blocks this morning. Vivek joins in to tell us more about the participants in that large trade and importantly, what further. Vivek.
Well, that's right. So Cohance Life Sciences, what we're tracking is two separate pieces of news flow. First up, last evening we mentioned that there could be close to 5.1% equity stake that could be sold by the promoter, which is the private equity Advent International. But today morning, what we learned from our sources is that the particular block deal size was actually upsized to close to 9% of the total equity, so amounting close to $350 million. So promoter P Advent, remember, Cohance Life Sciences is actually the merged entity of Cohance as well as Suven Pharma, both of which were earlier controlled by Advent International. Now this is the combined single CDMO entity. Now, along with that, CNBC TV18 also exclusively managed to go ahead and get access to the Form 483 that was issued by the US FDA to the company's Telangana facility. There were 6 observations of the Form 483, something that the company had intimated the exchanges. The details of the Form 483 are as follows. The first observation reads that there were failure to review discrepancies. Also, written drug record complaints were not fully followed up. Along with that, quality control unit procedures were not fully followed. Equipment as well as utensils were not maintained well. And along with that, lastly, test method accuracy not established. Slightly tricky observations. It will be interesting to see whether there is a further update in terms of either an inspection or some relief coming in from regulatory headwinds. The block deal overhang as well as the Form 483 is something that is weighing down on the stock price today.
Take that point. Thank you so much, Vivek, for explaining the reasons why Cohance is in focus today. With that, we are out of time on this edition of Chartbusters. Stay tuned. All the 4 indices up and about in the green. The team of Trading Hour takes the market action forward.
Hello and welcome to Trading Hour live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Hormis Patakia and Reema Tendulkar. Hey guys, good morning. Well, yesterday we saw those levels above 25,300. Today we are comfortably above 25,400. In fact, we are building onto those gains as we speak. So right now, 110-point uptick on the Nifty. All the major four indices, they are in the green. We have a good contribution coming in from the Nifty IT pack. The Fed rate cut and a lot that is happening globally is something which is putting focus on these names. We do have some of these stocks in the Nifty pack which are at the day's high as we speak. Insurance stocks should come up for you on the screen. SBI Life at the day's high. We also have HDFC Life, which is doing well. Across the board, good gains coming in. Bank Nifty outperforming yet again. So we'll be watching out for what moves take place through the course of the trading session. But for now, maintaining the gains that we started with today.
Indeed, and it helps when the two twin engines, both IT and banks, are firing for the market. Just a quick word on IT since you brought it up. The Nifty IT index is one of the best performing sectors, up nearly 1%. Some of the reasons driving the optimism, one, the Fed rate cut is positive for the valuations of Indian IT companies. These are cash-rich companies. Now you're discounting them at a lower rate and therefore the value goes up, the net present value. So that's reason number one. Secondly, because of lower interest rates, some of the sectors which require very high capex or which are indebted, for example, the telecom sector, they maybe can start spending because they will save more via interest expenses, or even the mortgage sector can see a recovery. So that's a positive. So even sectorally, some of the sectors which were hurt could see a revival. Third reason is the dollar index. Well, yesterday rebounded, but the dollar index is still broadly 10% lower on a year-to-date basis. Recently, the Infosys buyback, the Infi buyback, has also raised expectation that others will follow suit. So both TCS and Wipro are eligible for the buyback. And then finally, the biggest reason is the underperformance. The Nifty IT index is down 15% on a year-to-date basis, while the Nifty is up close to about 7.5%, and it's still about 20% away from its 52-week high. So these are some reasons driving the gains in IT. But let's talk about stocks. Hormis is here to put the spotlight on it.
Lots of news flow driven names earlier in the morning, and look at the absolutely crazy volumes that you are seeing today. And SEPC is the first one, Shriram EPC, the one order earlier in the day, 443 crore order. That is almost 20% of its overall market cap, that order win value. And today's volumes are already at a 2-month high in the first 2 hours of the trading session. Close to 4 crore shares have already changed hands, and in comparison to the 20-day average of just around 15 lakh shares. And now the stock is broken above its 100-day moving average at 1294, and now the next level on the upside is the 200-day moving average, which comes around close to 15 rupees. Now the other one on the list is high-tech pipes, and pipe stocks have been in the news over the last few trading sessions. And look at high-tech pipes here, 7th day of gains for the stock. It's up 32% in these last 7 sessions, and today's volumes have already crossed those of last Friday. Last Friday's volumes were on the higher side. We've already had close to 1.5 crore shares that have changed hands. The 20-day average is only 7 lakh shares. Now it is broken above its 200-day moving average of 111, post which it is now trading above all of its key moving averages. And since its migration to the main board in 2018, the stock has surged over 4x in value. The third one on the list today is Prism Johnson, and today's move is the biggest single-day gain since September of last year, 11% higher on the stock. It's broken above its 50-day moving average as well, now above 151. Today's volumes again at a 2-month high already. Had close to 33 lakh shares that have already changed hands. And look at the 20-day average, only 34,000 shares. That's 34,000, by the way. And it's all because of this move, the stock is almost set to turn positive on a year-to-date basis as well, trimming its losses now down to just 2%. And last on the list, Poonawalla FinCorp, of course, can't not talk about it. The third straight day of gains for the stock, 13% higher today. And the volumes today are already the highest since October of last year and counting. We have had close to 3 crore shares of Poonawalla FinCorp that have already changed hands in the first couple of hours of today, and the 20-day average is only 2 lakh shares. And it is now the next level to watch is 520, which is the all-time high on the stock for Poonawalla FinCorp.
Okay, interesting names there. Thank you so much, Hormus, for bringing us all those movers. But let's bring you a corporate conversation. CNBC TV18's Parikshit Luthra spoke to Vivek Chand Sehgal, the chairman of Samvardhan Motherson Group, and began by asking him about the company's ambitious 5-year plan that the company released a few days back. Here's what he had to say.
India is going to fast propel into a 5 trillion economy, as the Prime Minister has laid out. The group per se is going to focus on the issues that are at hand. What all we need for our group to achieve its target. You see, in Motherson, every 5 years we come out with an audacious 5-year plan. And of course, everybody is very excited about it. People tell us that it's not possible, but we make it possible. I think every 5-year plan, right from 95, when we just listed our company, from $2.14 million as turnover, we've gone to now 25.7 billion. So I think the idea to dream, the eyes open, and then go for it. I think the levers are many. We have automotive by itself is going to be a big thing. People are wanting more and more alternatives. And I think one of the key things that we have announced this thing is that a lot of the car makers are asking us to set up manufacturing plants for them. But manufacture not in a sense of big numbers or something. These are niche areas where they want the car to be produced. And so why not? We can assemble machines, we can assemble the components, we can assemble a car, why not?
So when would you be looking at starting the assembly or manufacturing of cars?
The moment the customer gives us this thing, we'll go ahead.
So you're ready to start as soon as possible?
Yeah, whenever. Why should it take time?
Okay. Any announcement there which is on the horizon?
No.
Not immediately. How are you navigating these global headwinds? The US tariffs, 50%. There is, of course, trade negotiations going on with Europe as well. But how are the trade uncertainties impacting you?
So Motherson has been very focused that if we are exporting more than 10% of our turnover, then we will go into that country. We will stop the exports. We want to export, we want to make it in that country. So we're in 44 countries. We have more than 450 plants all over. So I don't need to export, otherwise I'll be taking all the export awards.
Right. You've often said that you prefer acquisitions than joint ventures because it gives you complete control on the technology and running the company. Could you give us a sense of the future acquisitions that you may be looking at? What sector or what aspect of the automotive or manufacturing industry would you like to focus on? Because today Motherson is not just into automotives, you're into aerospace, you're into semiconductors and other sectors as well.
I think, first of all, we are a not yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it. So we're an open-minded company. We go for those particular challenges which the customer poses to us. I think it's very important to understand what does the customer need. And the customer decides and tells us and we go for it. Same in acquisitions also. We have never got up in the morning and said, today I'll buy this guy and that. No, that's not us. We wait for the customers to tell us they want a particular thing to be made and to top quality. So we do that. So we've done 44 acquisitions up till date. And we think it's a better way than joint ventures because you own the technology, the patents and everything come to you. And the first thing we do is to bring one part of it, that company into India so that we can have a global offering to all our customers over there.
Vivek Chand Sehgal in an exclusive interaction there with CNBC TV18. Take a short break. On the other side, we put the spotlight on the crypto market with Archit Mittal from SmartWave Academy. On the other side with Manisha Gupta.
CNBC TV18 presents Crypto Corner, powered by Coin DCX.
On Crypto Corner today, we are joined by Archit Mittal, who is the founder of SmartWave Academy. Archit, hi, thank you so much for joining in. You work in cryptos for a very long time now. You have been responsible for teaching, training people to responsibly invest in cryptos. What really has been the feedback? Do people in India now understand when it comes to crypto in sense of investing?
So thank you, Manisha ji, for letting me answer this. So basically, the response is very good. For the last 3 to 4 months, we have seen a tremendous response for this asset class, and people are adopting it at a very high pace. Like last year also, crypto has shown some boom, but this year the boom, along with the interest of the people, is really taking the market forward. We are seeing a lot of volume surges across the exchanges as well.
Oh, well, absolutely. Archit, when we look at the last week itself, in sense of, pardon me, in sense of volumes, whether it has been about ETFs or overall volumes or even inflows has been near record highs there. But this is more to do with the international markets and overall volumes. When it comes to India and when we talk about responsible investing, I mean, I'm assuming that is a discipline that you have to have in various asset classes. But when it comes to cryptos, what is that additional care that one needs to take?
So as we know that the crypto markets are much more volatile than any traditional markets across the globe. So that's why this term responsible investing has to be kept in mind every time when the person is trying to get into the crypto markets. The markets are a bit volatile. If I talk about Bitcoin as well as Ethereum, the average volatility is almost around 20 to 25%. That if the coin is going up to $1 lakh also, if I am talking about Bitcoin, it can show a deep dive till $75,000 also. That's a massive massive capital erosion for the people, for the investors which are out there. But when we are like talking about cryptos, all these giant coins are now behaving a bit maturely, and the markets, as the markets are maturing, we are seeing that the top coins are showing a bit less volatility compared to the altcoins which are there in the market. So yes, when we talk about responsible investing, we should go and further our investments towards the top 5 and top 10 coins which are there in the markets.
Oh, well, absolutely, Archit. That really was my next question, because there are some 25,000 cryptos there. Some have been around for all that time. Some really haven't been. We hear enough about frauds and rug pulls and etc. So what is your sense when there is a new person, a beginner looking to invest in cryptos? What should they be looking at in sense of investment?
So basically, if a beginner is trying to invest in cryptos, there should be 2 levels of investments which he should look for. First, investments in the top coins, the safe havens, or basically what we call as the blue chips of the crypto markets. That is the top 5 coins: Bitcoin, Ethereum, Solana, XRP, or BNB coins. These are the top 5 coins, and this list can extend up to the top 10 coins. But when we are talking about the altcoins, apart from the top coins, which have the decent volumes in nature, then the person should shift towards the researching part and should read about the white paper and what the crypto is actually doing behind the scenes. So that is a major important rule for the investment purposes for the altcoins. But for the top 5 or top 10 coins, the people can go ahead and allocate some of the percentage of the capital towards this thing as an SIP or a directly investment format.
Archit, also, since you work with a lot of people who want to invest in cryptos, what really is your sense on what geographies are they coming in from? What is the age group that seems to be picking up now?
So basically, if I'm talking about the global markets, the major volume drawn is from the US markets only, the US clients. There are a couple of US clients with me as well. But apart from that, in India, the major segment which is targeting is the first job goers and the early 20 people, because they want that sense of freedom also in their investment. They want a market which they can look for and actively participate in. So that is not a choice in various other markets, because all the markets are time constrained. This is one of the rare markets which is 24/7. There is no time constraint. So we are seeing a lot of interest from the early movers who are starting their investment journeys, who want to actively participate in this markets.
Archit, also, what should really be your portfolio in sense of percentage when you're looking at crypto?
So anywhere around 5 to 10% as of now, that is a good portfolio mix-up and a good portfolio diversification for people. You can enjoy the returns of cryptos also without getting into that much of risk which is associated with the volatility of crypto.
Archit, as you said, the last 3 or 4 months have seen an increase in participation and more people eyeing up, lining in to buy cryptos with the kind of returns that it has given. Is it about more awareness? Is it about a class which is giving great returns? Are people also venturing into futures and options now? Or is it more about investing?
So basically, like, returns are great because it's a new asset class. It's picking up the pace. So we are seeing a bit better benchmark updates which are there. There is a bull run also. That's why the returns are a bit on a higher side. But on an average, on a longer frame of time, we will be seeing the average returns which we are seeing in the other market. But it's more about the freedom which the people are getting in terms of investment, in terms of the market participation, which is a 24/7 markets. So that is a main agenda which I see in the participants, that they want more freedom around it. They want to participate in an asset class where globally all the people are participating. So in that way, it is picking up much more boom.
Archit, markets continue to react to what's really happening in US because we're looking at more legislations, more friendlier tones coming in from there. And then the street is also reacting to the macro, the 25 basis point rate cut from the US Fed. So when it comes to crypto, whether it's about strong legislations, friendly moves in various countries, and then the macro as well, what is your sense from here on? Because we've done halving the last year as well. So when it comes to 2025, even 26 for that matter, what is it that you will keep an eye on?
So definitely, there are a lot of tailwinds for the crypto markets. We are getting, like, US strategy reserves are created. Fed rate is there. So Fed rate also has impacted positive. Like yesterday was the Fed rate, and today we have seen a positive uptick in all the major coins as well as in the altcoins as well. And apart from that, in the industry overall, there is a lot of support globally which we are seeing for this market. So yes, definitely 2025 and 2026 is going to be very great years for crypto markets. It's kind of a bull run. And in October, November, December, hopefully, as per the recent year data also, we are seeing a very positive month going forward in October, November, December this year also.
All right. So Q4 usually is good for cryptos, and this year is going to be no different. Archit, as always, thank you so much for joining in. And with that, we slip into a short break. More news and updates continue on the other side.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. 100 points higher on the Nifty. We mentioned in the morning that 25,350 and thereabouts will bring the index towards 25,500. We are moving towards that level, and the Nifty Bank as well. The second of the two levels that we have highlighted, 55,700 on the upside. Both of them now trading above those levels, and good going for both the Nifty and the Nifty Bank, powering along in today's session as well. So a good time to get in what the FNO data is indicating. Mangalam is at the FNO desk to tell us just that, Mangalam.
Well, the FNO data is indicating no different from what it was in the earlier few sessions as well. That the index is gradually moving higher, going towards important levels, and at the same time there is gradual short covering that takes place as well as the index continues to sustain at higher levels. So today we have the Nifty doing well. The broader markets are doing a shade better in terms of the market breadth, and it has been led by two engines, the frontline index, that is the Nifty Bank and the Nifty IT. And in doing so, the Nifty Bank, once it crossed the 20-day moving average, something that we had pointed out last week as well, it had a clear runway for a 1,000-point rally because we had the 50 and the 100-day moving average, and today it's gone ahead and crossed that also. So the Nifty has put up nearly 1,000 points from the lows. The Nifty Bank too has seen a near 1,200, 1,300 point rally on that index. The IT index, that too has been doing very well, and in today's trading session as well. However, there's a bit of a congestion that it's facing around the 100-day moving average. It crossed past the 100-day moving average today. 36,804 is where the 100-day moving average is placed. It went to over 37,000, but now is just slightly below the 100-day moving average. So we'll watch out for how the Nifty IT index, or whether it recovers in the second half or not. The only fly in the ointment that I'm looking at right now is the India VIX. As the index is gradually moving higher, the India VIX is now nearing complacency levels. It's sub 10, so that's something we'll watch out for. After a 1,000-point rally on the index, can we see some consolidation? The India VIX move higher as well, and some put writers also becoming a little more moderate is something I will watch out for, because despite the up move that we're seeing today, we're seeing call writers active at 25,500 and put writers active at 25,400. So the support of the Nifty has moved higher, and call writers believe that maybe closer to 25,550 to 25,600 is where some supply will come in. And in doing so, the put call ratio has moved higher from overbought levels of 1.22 to about 1.24. So the India VIX spiking and the India PCR, the Nifty PCR coming down, would be two important parameters to track whether the up move sustains or not. But a lot of individual stocks are fairly well bid today. We have KFIN, which has seen a lot of long positions being added. We've seen the KPIT tech stock fairly well bid as well. Midcap IT continues to do well, even as the large cap IT index has seen a bit of moderation from the highs. And IREDA, that's the other stock, which is up 2%, with a lot of open interest backing it on the long side.
Thank you very much for that. Get into a break. On the other side, we'll discuss the market fundamentals. Mangalam was just telling us about this 1,000-point rally that we've seen. In fact, brokerages are turning more bullish. PL Capital is incrementally more constructive on the market. Risk rewards turn favorable, and now their portfolio has shifted from defensive to a moderately aggressive one. So we'll discuss all this with Siddharth Vora from PL Asset Management on the other side.
investing.
Welcome back. The Nifty is at 25,450 on the gainers list today. You've got HDFC Life right on top with the up move today. It's crossed the 50-day moving average. Infosys is seeing some buying. Infosys at 1545. The buyback price will be 1800, though the dates so far have not been announced. Eternal is seeing some interest. We should pull up Urban Company as well. After a 60% up move, it opened up with a gain of 1.5%. But let's see whether the interest and excitement continues in Urban Company, because market capitalization has crossed the 25,000 crore mark and indeed still holding up with a gain of 1.5%. HUL, HDFC Bank, which underperformed the rest of the private sector banks yesterday, is up nearly 1%. So that's doing well and that's powering the banking sector. But as promised, let's talk about under the lens. And the stock on Sonal's radar today is Platinum Industries. Sonal, take it away.
Thank you so much for that. Well, under the lens today is Platinum Industries, and the stock was on the move yesterday, gained around 11%. The company is in the business of CPVC, PVC additives and lubricants as well, and it caters to a whole host of sectors from agriculture to construction, healthcare and even automobiles. Platinum hit the markets in March last year. The price was 225 rupees, which was a premium of 32% to its issue price. Since then, the stock has held strong and now trading about 40% higher than listing levels. At IPO, we did see big ticket anchor investors like Baring PE, AIF, Elara India Opportunities Fund, Sane Capital and Antara Evergreen back the company as well. But now, today, only we have one of them, that is Baring, remains as a major shareholder in the company at 2.7%. Let's check the financials now. Revenues, they have grown consistently from 188 crores in FY22 to nearly 392 crores in FY25. In quarter one, we saw revenues of 115 crore rupees. EBITDA too has climbed to 58 crore rupees in FY25, more than double of the FY22 levels at 25 crore rupees. If we talk about profits, they have expanded from 18 crores in FY22 to around 50 crore rupees in FY25, and on quarter one, 13 crore rupees as of now. Now remember, the company already holds a 13% share in the domestic PVC additives market, and about 10% of the sales come from exports, which has Europe, the Middle East, Africa and Asia. But export expansion is in focus. The company has set up a 60,000 ton facility near the Suez Canal in Egypt to cater to some markets like Latin America and the other regions as well. Alongside its 1.2 lakh ton capacity at Palghar is something that the company is focusing on as well. Now let's talk about balance sheet. Cash from operations slipped to negative 8 crore rupees, and working capital days have stretched to 62 in quarter one versus 51 in FY25. The collection period has gone higher as well to 70 days in quarter one versus 66 days that we saw in FY25. On shareholding, promoters remain firmly in control with 71%. FIIs, however, have sharply cut down their exposure from over 5% last year to just about 0.5% now. DIRs are steady at around 2.8%. That figure will come up for you on the screen as well. But Platinum says it is banking on its enhanced capacity and new geographies to cement market leadership in PVC stabilizers. If you talk about the valuations, the stock trades at 38.67 times based on FY25 earnings, not too cheap, but mostly on the expensive side. And the return on equity is at 14%. Return on capital employed has come in at 18% in FY25, which is slightly lower than the previous year.
Interesting. Platinum Industries, the stock under the lens of Sonal. Keep that on your radar as well. Let's bring in Siddharth Vora now from PL Asset Management, joining in now to take the conversation forward. Siddharth, good morning. Thank you for joining in. You mentioned that your stance now has turned more constructive and your portfolio shift has now moved from a defensive to a moderately aggressive stance. If you could explain that rationale to us first, and then we move on to your sectoral ideas as well.
Sure. So, after a very long time, we've turned bullish on the short-term, medium and long-term prospects in India. And of course, multiple drivers behind this change in stance. From the overall macro setup for India to the micro setup for India and global cues, I think after a very long time, things are converging for the better. Everybody's already aware that tax cuts, GST reforms, lower interest rates, strong GDP growth, low inflation, banking liquidity within India, all of these are going to definitely create the demand drivers that are needed for the next leg of growth. Also, we believe that the whole earnings downgrade cycle in India has peaked out, and now we're entering an upgrade cycle. Factor spreads, quantitative factor spreads were at multi-year lows, close to zero. They are now starting to reverse, which is a great sign for markets to do well, factor strategies to do well. Furthermore, if you look at India's overall trade positioning also, globally, our equation with EU, Japan, UK, China, Russia, and now finally US is also, heading in the right direction. While all of this is happening, valuations remain neutral. They are not extremely expensive. The U-turn of FIIs is critical at this point. Low DXY and rate cuts in the US will obviously fuel a rally in India, and India's relative underperformance versus other emerging market peers will ensure that we have enough room for outperformance in the next 12 months. So overall, I think reducing uncertainty, improving risk appetite, improving sentiment and breadth, and neutral valuations.
Okay. So Siddharth, you've said that you've deployed roughly 15% cash in the recent weeks. What's the cash that's left on your books now? When will you turn more aggressive on the market? And where have you deployed, this 15% cash recently?
We've deployed all the cash, actually.
All the cash, okay.
Yeah, we don't have any cash anymore to deploy. Now, any more cash that comes might come from, any rebalance or rotation. If we exit a couple of stocks, enter some new stocks. And we've deployed mainly in our existing holdings. We've increased allocation to industrials. We've increased allocation to financials. We've increased some allocation to materials as well, like metals mainly.
Okay. You're talking about where you have increased exposure. Some of them are existing holdings for you. But you've trimmed exposure to private banks. What explains that? Do you prefer PSU banks over private banks? What's the catch here?
So we exited private banks 2 months back, 2.5 months back, actually. We were holding them from Jan all the way up to 2 months back. And then we've moved into NBFCs and asset management companies, and now we've scaled up our allocations there. We believe that we're entering a higher beta phase of the market with improved risk appetite. And private banks were in our portfolio mainly as a defensive, low volatility, high quality bet on the financials. Now, as we come out of the low volatility and high quality regime, increase the beta, increase the risk, I think NBFCs, asset management companies, likely to do a little better.
What about capital market names, Siddharth? Where does your preference lie? Be it the exchanges like the BSE or the discount brokers like Angel and the likes, or even the wealth managers?
So we are currently positioned within asset management companies. I think three of them, asset management companies, an exchange as well. Broadly, these are the names, yeah.
No platform companies? So much interest. Urban Company had a fabulous day one. Eternal Swiggy continues to do well. Are they a part of your portfolio?
Unfortunately not.
No, okay.
Okay, all right. Thank you so much for joining in today and giving us your sense of the market moves going forward. The fact that you've turned constructive as well and have deployed the remaining cash in the portfolio as well. Time for a short break now. Management of Interarch Building Solutions will join us next to discuss their FY26 outlook and a lot more. Welcome back. You're still tuned into Trading Hour. Interarch Building Solutions is the next company on our radar. Arvind Nanda, who is the MD at the company, joins us now to discuss a lot of points. The first is the fresh capex and capacity expansion plans, the outcome of income tax searches as well, and their growth guidance. Mr. Nanda, good morning. Thank you so much for joining in. Let's talk about the fresh capex that you have in place. What is the amount that you're planning here? What is the current capacity? And how much will it increase by with this new capex that you have undertaken? And what is the revenue potential from this particular fund?
Thank you for having me on the show. Yes, we had started these facilities last year, started the work, and now they are into full commercial production. So one is, of course, Andhra Pradesh, which is the final phase, and now it's a fully integrated plant. So that will be our fourth fully integrated plant in India. Fully integrated plant is approximately 40,000 tons of buildings and about 500 crores of building sale in value, approximately at today's values. So with these four integrated plants, we have a capacity now of about 2,000 crores plus to deliver buildings in. And the additional line in Kitcha serves a dual purpose. It is a new form of welding line which makes box lines, which is box columns. Box columns are very popular in coming all these new age industries kind of buildings. Box columns are very popular because they don't have any edges or any grooves which can spoil the inside, the level of cleanliness they want. So box column line was very essential because currently we do box columns either on our normal welding line or we buy them from outside, both being very, very unproductive for us. So box line will be very, very useful. It will also add some capacity. I think a couple of 100 crores worth of capacity will be added. So for the current year, we already have enough capacity to deliver what we have to deliver. But this will help us try to complete our order book faster. Like I mentioned before also, in many ways, our order book reflects what we can deliver in the next 10 to 11 months. We can't really go longer than that. So I think putting up these facilities, having them in full play now will help. Going forward also, like we mentioned, we are starting two new facilities, one in Gujarat, which will be again in two phases, one coming up maybe about 10 to 11 months from today, and the second phase by the end of next year, end of next calendar year. So that will be a fully integrated plant by end of next year. And a heavy structure plant in Andhra, next to where we are, will also add to our capacity, but in a different kind of an item. Just like box line, heavy structure is also a different item, but of course contributes to the sales because the sale is the total building. That is our current plan for capacity expansion and what is the current capacity now.
Mr. Nanda, if I may just request you for some numbers then. What is the total capex outlay? What would it take your capacity to, say, by the end of 2 years, once all of it comes under stream? And what is the revenue potential of that? Some numbers would help, sir.
So we are planning a capacity to be able to deliver about 2,500 crores of buildings by 27-28. So we are hoping that by the end of 26 calendar year, we should have this capacity in place. Currently, it's about 2,000 crores. We have spent approximately 50-55 crores on fully integrating the Andhra Pradesh plant and the new Kitcha line. And we will spend another 150 to 160 crores in the two new lines we are planning in the next 18 months. So plan is that 27-28, we should have minimum of 2,500 crores worth of capacity or approximately 220,000, 230,000 tons of buildings to be delivered. That is the plan.
Mr. Nanda, thank you for joining in. Before we get back to business, it's just clearing the air on the IT search operations which you had highlighted on the 18th that took place at some of your offices and factory premises and were completed on the 22nd. If you could elaborate a little more as to what exactly happened, and after the completion, have you heard anything from the IT department?
Well, IT department came and I think they were here for 4 days. They interviewed a lot of our people and went through all our records, everything. But I don't think there's anything to worry about for Interarch in this whole matter. We've always complied with all the laws, all the rules. There's nothing to worry about. They had their own reasons, I guess, that we cannot question. but we are fully cooperating with them. And I think they have found us very cooperative. They have, in fact, being very, very cooperative, and we are also being very cooperative. But the whole process takes about 30 days. So I think today or tomorrow, the process of some people's lockers, our own records, they need time to go through all of them even after they leave. So I think from October onwards, we will start hearing a little bit more. But like I said, Interarch has nothing to worry.
Oh, okay, all right. Looks like we lost that line, but that is the word coming in from Interarch Building Solutions, looking at capex and a lot more updates in terms of expansion as well. The stock is up 2% as we speak. Time for a short break now. On the other side, we bring you our big story of the day. Stay tuned for that.
Welcome back. Let's talk about the big story then of the day. It's Cohance Life Sciences. For one, there was a large block in the counter, and two, there were also some US FDA observations. So first, let's just get to the news, and then we'll take the conversation forward with Ekta. But Vivek, tell us first the updates on Cohance.
Well, that's right. Cohance Life Sciences, the merged entity of Suven as well as Cohance, which is now controlled by private equity major Advent, last evening launched a block deal. So Advent launched a block deal, and last evening we understood that they were looking to sell close to 5.1% stake. But today morning they went ahead and upsized the block deal offering. So close to 9% of total equity that they held is something that they looked to offload today via the block deal. That particular deal did go through, and now what we understand is that there is a lockup of a further 210 days as far as the selling shareholder is concerned. So the total size of the block that happened today was close to $350 million at the floor price of close to 900 rupees a share. Now, other than that, remember, in August, there was an inspection as far as the company's Telangana facility was concerned, and the company told the exchanges that they had received 6 observations in the Form 483. We managed to access the Form 483 today. 6 observations are largely routine in nature. Doesn't appear as though there are any data integrity issues. So the first one is failure to review data discrepancies. Number 2, written drug record complaints were not followed up. Quality control unit procedures were not followed. The fourth one states that the equipment and utensils were not maintained well. And lastly, test method accuracies were something that were not established. On the back of that, you can see the stock down almost 6% today.
6% lower for Cohance. But, to put this into perspective and on for a broader perspective as well, this was about Cohance, but Ekta is here to tell us about the key drivers for the CDMO industry. There's a lot of conversations happening in the recent times, Ekta.
Well, yes, absolutely. So the CDMO industry, just want to put it into perspective that innovators are now looking for a dependent CDMO partner to build supply security when it comes to their entire supply chain. So innovator companies are looking to do that, global innovator companies. Now, to explain to you that the AD-CDRMO market, which is basically the ADC market, is basically the antibody drug conjugate market, which is a type of cancer therapy. Now, that is valued at $1.4 billion currently and is estimated to grow up to $4 billion by 2029. So that entire supply chain needs CDMO participation, and hence companies such as, say, for example, Cohance, Pharma, all of these CDMO companies are expected to be beneficiaries when they participate in this ADC opportunity. Now, China +1 as well as EU +1 are expected to be key drivers when it comes to CDMO growth going forward. Also, the US Biosecure Act has come under discussion again, and it could be an opportunity for Indian CDMO companies when innovator companies try to sort of move away from China in terms of their key supplier because of the US Biosecure Act. Remember that China +1 is already taking place, but once the US Biosecure Act, if it does come into action, then that could be an additional incentive for global innovator companies to basically secure themselves in other locations such as India.
But Ekta, tell me, finally, how does it impact Cohance specifically from this opportunity, the CDMO opportunity?
Okay, so I'll just tell you a little bit about Cohance. It's basically a contract developer and manufacturer, basically a CDMO company. It was formerly known as Suven Pharma. Remember that Advent bought around 50% stake in Suven in September 2023 for around 6,300 crores. It's rebranded as Cohance since May 2025. And Cohance is basically formed via an amalgamation of several entities, including Suven Pharma, ZCL Chemicals, Avra Labs. There are a couple of acquisitions such as Sapala Organics, etc. Now, Cohance has said that they've responded to a healthy set of requests for proposals in the quarter gone by when it comes to innovator companies responding to them. They're seeing RFPs from established customers. Global innovators are basically responding to the company's capabilities when it comes to antibody drug conjugates or ADCs, something that I just explained earlier, can be a $4 billion opportunity eventually. It's showing up in the numbers slowly. So Q1 FY26 revenue was up 12.5%, margins 20.4%, profit of 46.4%. On an adjusted basis, the pharma CDMO segment was up 30%. Now, they do have, for example, 2 products from the small molecule portfolio which could transition to commercial stage. They've secured a life cycle management supply mandate from an innovator company for a branded API product, and NJ Bio, their arm in the US, has received a new order from existing customers to supply ADCs. So basically, they also have a $1 billion target by 2030. So that is something that the street is looking for in terms of something that they could achieve. Ekta, thank you very much for that. That brings, and Vivek, for joining in. That brings us to a close in Trading Hour. Thank you for watching.
Stocks gain after the US Fed Reserve cuts its benchmark rate by 25 basis points with indication of further cuts ahead. IT and realty lead gains while industrials and energy drag.
Once Life Sciences promoter Advent Private Equity upsizes its stake sale, plans to 8.9% of equity from 5.1% earlier. The move signals strong demand and high investor interest in the contract development and manufacturing business of the company.
Apollo Tyres MD Neeraj Conrad tells CNBC TV18 that the Indian cricket team jersey deal was struck at 579 crores for 3 years, but they're in it for the long innings. Like with Manchester United, they also guide for double-digit growth in the business.
Finance Minister Nirmala Sitharaman says the government has delivered on ease of doing business and that the PM has never ignored wishes of the industry. Given this, she expects industry will now not have any hesitation to invest. Hello and welcome to Halftime Report live from the CNBC TV18 Motilal's Oswal studio. I'm Ekta Batra and with me is Manglam Malu and Vinny Motiwala. Well, it's turning out to be a session where we are seeing some amount of consolidation for the frontline indices. The mid-caps are quiet as well, but what really stands out is the kind of run that we've seen for the financials. So the Nifty Bank in today's trading session is up around 0.5%, and to put it into perspective, we've gained around 1.7% this week itself in terms of the Nifty Bank. So overall, that's what's taking place with the markets. We have an advanced decline ratio, which is in positive terrain as well. So as of now, the US Fed rate cut is obviously rubbing off well for our Indian equities.
Indeed. The only thing is that we'll have to watch out for where the mid-cap index goes from here on. We've already seen a 1,000-point rally from the lows on the frontline index. If there is some consolidation, which is likely, then, do we see some underperformance of the mid-cap index? Up until now, we were in line. Just the last few minutes or so, seen the mid-cap index see a bit of a slide from the highs, as has the small-cap index. And those lines, the advanced decline lines come up for you. They've come a wee bit closer. Now, in the morning, we had around 1,800 stocks in the green for about 1,000 stocks in the red. Now those lines have come closer, almost as many stocks in the green and red. So that's something I'll be watching out for. And the second part is the India VIX. That after a big move that we've seen on the frontline index, you would want the India VIX to be somewhere around 11 and 12. Sub 10 prices in a bit of complacency. So let's see how that goes.
Absolutely. We'll keep an eye out on that. Just a sector-wise performance, IT, that's managing to hold on to good gains today. 0.8% of gains for Nifty IT, Pharma 0.6% of gain. On the flip side, what's not doing well today in terms of sector performance? Energy, that's not doing well, as well as metals, muted performance coming in there as well, down almost 0.03%. A lot of individual names obviously are moving in trade on the back of some announcements, either news flows coming in or even brokerage notes. So that's what we'll take you all through in the next 1 hour of the show as well. But keep an eye out on Eternal, Sun Pharma, ICICI Pru, some of these brokerage notes that have come in today. Those are some of the stocks that are buzzing in trade as well.
Well, yes, I'm in fact looking at Glenmark, which is in focus. That is because of the news that Astria Therapeutics has announced positive initial results from a phase 1A healthy subject trial of a particular molecule which is under development in their portfolio, STAR0310. Now, why exactly is this important is because Glenmark's arm, Ignis Sciences, had entered into a licensing agreement with Astria back in October of 2023 for this particular molecule itself. Now, the agreement was to develop a portfolio of monoclonal antibodies targeting OX40, which is basically for inflammatory as well as immune diseases. Now, Ignis has received an upfront payment of $320 million, potential milestone payments at that point in time, and low double-digit royalties. So as of now, it's only in phase 1. So let's see how that progresses. But nonetheless, it's definitely positive news for Glenmark if in case they do progress and it goes beyond phase 1A and meets certain milestones as well as certain targets, then maybe Glenmark would be eligible for more. As you can see, the stock is up around 1.5%. But let's get talking a little more about the healthcare space. We have with us Dr. Bhaskar Rao, Chairman and the Managing Director of KIMS, who's joining in. And we're going to be discussing 3 main talking points, which is basically commencing operations of their 450-bed hospital in Bengaluru, performance of their new hospitals which have come up, and outlook on occupancies as well as average revenue per occupied bed. Dr. Rao, thank you very much for taking the time out. This new hospital which has come up, you've started operations in Bangalore. It's a 450-bed hospital. Just give us a sense in terms of what kind of numbers, occupancies, RPOPs are you expecting in what is a very competitive environment?
So in Bangalore, we started this month the Mahadevapura KIMS facility, which is around 450 beds. And it is only 150 beds has been opened up. And we are already touching within the last 3 weeks about 15% of the occupancy. Moving forward in this 150 beds in this next quarter, we may touch around 30% occupancy. The average per operating bed is at the level of 65,000 rupees per bed. And the RPOPs will be around 2 crores per patient. That is in line with the market in Bangalore. Maybe we are lower than 10% below the other our peer groups. Similarly, I think we are doing in Bombay. We opened around nearly 4 months back in Thane. That is also doing very well. Maybe we also touched around in the last 4 months about 30-35% occupancy as of now, with 150 beds capacity as of now.
Right. Good afternoon, Dr. Rao. Thank you so much for joining us. I just wanted to understand, you said 150 beds right now is something what has started, right? Commenced. What about the remaining 300? By when will we expect those 450 beds, all of them coming into action?
See, all the 450 beds has been done everything now. Only thing is because we need to employ all the people of the nursing and other people for 150 beds. Because from day one, we cannot able to expect all the beds will full. Whenever there is a need, so we need to able to employ the more nursing staff, the paramedical staffs. Doctors and all has been boarded. All of them by 50% of the doctors is already there right now. Maybe another 50% will be next couple of months. They will be able to join.
Do you expect this?
After the 300 beds, whenever there is a need, we will be able to keep it occupied.
And by when do you expect this to, break even? Typically, how long does it take for a new facility to break even and then reach company level margins? How long?
Usually, the operational break-even will expect around 6 to 9 months, 12 months. The reason is today we are doing even within 1 month, we have a 10-15% occupancy of 150 beds. That is nearly 20-25 beds are full. The insurance, most of these territories, insurance patients are 50% of things. To get the insurance permissions will take about 9 months to 12 months. So by end of 12 months, I think we will be able to break even and even we'll have a cash flows which can be able to repay our term loans also.
So what is the amount that you need to repay and what is your total debt on books? Because you have had a number of new hospitals open up recently.
See, as far as the Bangalore is concerned, I think we have spent about nearly 800 crores. Out of that, maybe 300 crores is our equity, 400 crores is the debt. That will be able to, these are all for the two facilities, 800 beds. If you take it as a per bed is coming around nearly 1 crore 10 lakhs, which is very, very reasonable amount we spend on the good facilities. And I think within, I don't have how much is the EMIs we need to pay, exact number, we'll be able to come back later.
All right. Just wanted to narrow down a little bit on your Mumbai operations. You did mention Thane as seeing 30 to 35% occupancy. Your earlier guidance was that it would break even by Q3 or neutralize losses by then. Is that on track?
Yeah, it is on track.
Okay, so you should be EBITDA positive by Q3?
There will be operational break-even. By Q4, I think we will be able to definitely positive.
And what about Nashik? Because that was a little slower in terms of ramp up. Are you seeing any kind of ramp up now? What is the status in terms of occupancies, your insurance tie-ups there?
Nashik is a place where we initially thought that we will be able to break on 6 to 9 months, but it is getting delayed because of the operations. I mean, the insurance companies has not yet boarded. The moment the insurance tie-ups has been happened, it will be done very fast.
Dr. Rao, also just in terms of specifics on the Telangana cluster as well, you had spoken about maintaining that 5 to 6% volume growth there. Is that something that you still maintain, and do you see this further improving going forward right now?
As of now, we are maintaining. Maybe by January, we are opening up another 2 facilities in Kondapur and as well as in Kompally. If these 2 have been there in the 4th quarter onwards, the volume jump and will be improved.
Right.
Better than 10%. Yeah.
Dr. Rao, if you could give us a longer term projection, by FY28, what is the kind of room capacity that you're looking at? And your existing facilities will all also mature by then. So what is the kind of system-wide revenue, occupancy and EBITDA margins that you're expecting by FY27-28?
Whatever we are giving, and we believe whatever is the thing that is happening, maybe we are expecting around 20-25% growth on top line as well as on EBITDA growth year on year. That was we showed so far, and the moving forward also in the next 3-4 years, that much of growth will be there.
20-27%.
Yeah, 20-25%.
Okay.
20-25%. Okay.
Just quickly before we let you go, Dr. Rao, your burn rate for the new hospitals, how much would it be on a quarterly basis? You did around 21 crores in the previous quarter. What can we expect in the coming quarters? It was expected to be within that range, but now that you're saying Nasik would probably take a little longer to break even, what can we expect in terms of the burn rate?
You mean top line?
No, how much you are making in terms of losses in your new hospitals?
See, the losses will not be too much. Maybe we are expecting this quarter will be around 25 crores. So moving forward, the 25 crores will come down in the quarter 4 and next year, quarter 1. By end of quarter 4, I think we'll be neutral. There will not be any loss funding. That's what our estimations.
Okay. All right, Dr. Rao, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that is KIMS talking about their new hospitals as well as the commencement of a new hospital in Bangalore, which is 450 beds. And they're starting with around 150 beds there. We'll take a short break. We'll get you more on the markets and an exclusive chat with Tata Steel's MD and CEO on the other side. Stay tuned.
Welcome back to a half-time report. As of now, Nifty is managing to hold on to 25,400 levels, gains of 0.4% for the Nifty 50. But let's move on and talk about some of these individual names that are buzzing in trade. Vivek is joining in with us to give us those details. Good afternoon, Vivek.
Well, good afternoon. Quite a few stocks, especially in the broader end of the markets, that are making all of the moves. Have a look at Poonawalla FinCorp. Promoter has gone ahead and infused equity. On the back of that, the book value per share has gone up quite significantly. Street cheering that move. Also, confidence coming from the promoter, stock higher by 12%. Cooled off a little bit from the day's highest point. The other stock in focus is Saregama. Now, this particular stock, Nuvama has initiated coverage on the stock with the buy rating. Fizzled out a bit, but at one point of time was higher quite significantly. Biocon, the other stock, an important nod coming in for some key drugs. On the back of that, this particular stock higher by over 2%. Prism Johnson, after a while, this particular stock on very strong volumes, the top gainer, especially as far as the NSE 500 index is concerned, and the entire mid-cap IT pack, some of the names seeing strong moves. So names like LTTS, KP, IT Tech, Sonata Software, all of these stocks high by over 2%. On the other hand, quite a few stocks seeing some negative or selling pressure as well. Cohance Life Sciences, the large block deal, acting as an overhang on this particular stock. SBI Cards, worries on the back of the fact that RBI has put some curbs as far as a certain segment of payment is concerned. That stock under a bit of pressure. You're also looking at Page Industries. HSBC today has a note on this particular company. They've gone ahead and said that demand trends look quite subdued. Stock down by almost 3%. And Aegis Logistics, remember, this particular stock has moved significantly higher in the week gone by. Today seeing a bit of profit booking.
All right, take that point. Meanwhile, a couple of stocks on our radar. At the bottom of your screen, you have Capacity Infra, about 1,500 crore worth order win. That stock is up around 3%. But Tega Industries, that was the bigger news that came in. Everyone was expecting details of the fundraise to come by, and they've gone ahead and announced that fundraise, nearly 2,000 crores via issuance of crore shares at 1,994 rupees a piece. So that's a positive, boosts their balance sheet a little more to be able to go ahead and digest the acquisition, the big acquisition that they had made a couple of weeks ago. With that, let's get you another important corporate conversation. Tata Steel's MD and CEO TV Narendran says the global environment for the steel industry remains challenging. In an exclusive chat with Parikshit, he also shared that the company's growth and production targets for FY26 are robust. Listen in.
Yeah, I think we are, because key to that was the Kalinganagar expansion, which is pretty much completed. We are ramping up as per plan. So I think we are well on track for that.
Right. In terms of the global headwinds, how does the export picture look like right now?
Globally, for the steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month. And oftentimes at prices at which they themselves don't make money. So it's very difficult for anyone to compete with that. But luckily for the Indian steel industry, the demand growth in India has been strong. So we've been less vulnerable to what's happening in the global markets. The additional capacity that many of us have built in India are being fulfilled, being taken care of from the demand that there is in India. But if we were to export, yes, it would be challenging.
Right. I would also like to ask you, while the Steel Secretary has also said that the impact of US tariffs on India has been minimal as far as the steel industry goes. But overall, what is your expectation and wish list from the trade negotiations in order to protect the interests of the domestic steel makers?
I think, like the Steel Secretary said, India does not export much steel to the US because US traditionally has been a difficult market to export into simply because of the trade actions that they take. So for instance, we used to export steel 30 years back to the US, and they're very quick on anti-dumping and safeguard duties. So you don't see much steel exports going from India there. But I think there's a lot of engineering exports which goes there. Steel consuming sectors export into the US. So when we look at the trade negotiations, we are more interested to see what is the benefit it brings to our customers, and hence the indirect benefit that can come to us.
Right. On the EU negotiations, they're looking to conclude negotiations by the end of the year. The EU, in its vision document, which has come out yesterday, they said that EU is simplifying the CBAM, and any carbon price paid in India will be deducted under the CBAM final adjustment mechanism. Do you feel that this will address the worries around CBAM to a great extent?
I think this mechanism was there, and I honestly think that is what we should leverage, because asking Europe to remove CBAM becomes very difficult because they are only charging importers the same carbon tax that they are charging on domestic players. So for them, it's not just a trade issue, it's an industrial policy issue, and we should recognize that. So they can't just address it through removing it for trade.
A final question to you, would you have any asks from the government at this point in order to safeguard the interests of Indian steel makers?
See, Indian steel industry goes to the government only when we see very unfairly priced imports, because, it's only when steel comes into India at prices at which the suppliers don't make money do we say that it's unfair, right? Otherwise, Indian steel industry is very competitive. We have some of the latest steel plants in the world. It's not just Tata Steel, all our peers as well. So I think from an Indian steel industry point of view, the ask of government is continue to spend on infrastructure, which they are doing, address the cost and ease of doing business, which they are doing, and give us some support whenever we see unfairly priced imports, because we should recognize the fact that the steel industry is been one of the leaders of private sector capital investment. I think between us and our peers, we are investing at least 40-50,000 crores a year, which is more than most other sectors.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Let's now go across to Mangalam. He's at the F&O desk to tell us all the updates for today.
Well, the Nifty is holding above that 25,400 mark, so that's a positive, and it's been led by two of its most reliable engines. We have the IT index doing well and the Nifty Bank doing well as well. But now as we look at it, there are important parameters to watch out for the market after we put behind us a 1,000-point rally on the Nifty. One, as we move higher, we are seeing some bit of consolidation in the broader end. So the mid-cap index and the small-cap indices are slight underperformers in today's trading session. And, the Nifty IT index and the Nifty Bank index are also near important technical levels. Today's high on the Nifty IT index was 37,065, and it's just under the 100-day moving average, a level which it hasn't closed above in a while. So 36,804 is the level that it has to close above for it to, sustain its up move despite meandering off a bit from today's high. The Nifty Bank continues to hold above the 50 and the 100-day moving average, so that's a positive. Let's see whether it sustains at higher levels for that index as well. The India VIX, we've been talking about how it's lower now, so is it pricing in complacency? Do we see a bit of a spike in the India VIX, and that would happen if the market was to become a little more volatile than the gradual steady run-up that we've seen? Option writers expect a bit of a range at higher levels. 25,400 put writers fairly active, telling you support has moved higher to 25,350. But 25,400 call writers equally active, telling you that there is resistance around the 25,500 mark as we move towards that psychologically important level. A lot of individual stocks in focus. This morning there were a lot of long positions being added, but now shorts are piling up as well. So Page Industries is seeing some fresh shorts. We're seeing some longs added on CDSL and HFCL in the last few trading sessions, last few trading minutes. In fact, HFCL is also out of F&O ban yesterday, so as a result of which fresh positions are taken out there. And LIC Housing Finance is the other one I'm looking at, currently seeing some bit of short covering. So those are a bunch of stocks and the frontline index.
Okay, Mangalam, thank you so much for that. The latest update coming in the world of F&O. But on that note, we're going to step into a very short break. On the other side, we'll be joined by Manisha Gupta, who will be joined by Kunal Shah of Nirmal Bang to talk about commodities. Stay tuned in.
Welcome back. Kunal Shah of Nirmal Bang Commodities now joins us on the show. Kunal, hi. The much anticipated event is done with now, and on expected lines, 25 basis points of a rate cut is what we are looking at. And the buying ahead of the event is something that has turned into a profit taking right now. For some time now, you've been calling this rally done. You've been advocating selling on rallies as well. From these current levels and with the bit of a profit taking that we're working with right now, do you see it deepening, and what are your target levels now?
Okay, yes. So, like you rightly said, we've been advocating that at $37.50, gold was fully priced in. All the positive news were priced in. And the moment yesterday rate cut came from Fed. So, one of the interesting thing about yesterday's rate cut and their statement after that is they clearly mentioned that this is just the risk management. They are not anticipating any recession or a severe downturn. Just the labor market is in a bit of stress right now, and apart from that, things are not that bad, and that itself is one of the major reasons why gold should have witnessed profit taking. So there's no question about recession. They've upgraded the growth outlook going forward. Then why gold should really do well from here? And if you see the consensus trade lately, people have been recommending. We are seeing reports coming out at 5,000 gold at $5,000, $8,000. And even we've seen a report stating gold can test 12,000. So it was becoming a consensus trade in a near term that there's only one thing which is going to go up in the world. That was gold and silver. That's it. And that itself was dangerous. So we are seeing profit taking. This is the behavioral aspect of the market. Whenever you see such kind of scenario, generally you tend to see the reverse trend taking place. So in near term, we are expecting gold to remain under pressure, and this profit taking can intensify. Gold can go down on COMEX to levels of $3,600 and presently trading at around $3,670. So expecting more profit taking to come. And on Indian bourses, gold can come and test levels of around 1,07,000 or 1,06,500 somewhere. Those are the levels, we'll reconsider to buy. But right now, it's a sell on rise market. All the positives are priced in, and there is too much optimism around.
Oh, well, absolutely. While you are suggesting a sell in gold, would you say the same for silver, at least for the near term? And what are the levels to buy here? Because a lot of people want to buy base metals. There is a very, very positive scenario continuing for that one. So for silver and for copper, how would you look at those markets?
Silver looks very strong fundamentally, but when you see gold going down the way it did right now, silver is likely to witness the selling pressure also. So I see silver retracing back towards levels of $40 on COMEX. And in India, that should translate to another 3 to 4% downside. So 1,18,000 or 1,17,000 is the base I see silver forming at. And I see in near term, silver will remain under pressure. And the long-term outlook still, I'm very much bullish on silver. But in near term, the pressure is likely to persist. As far as copper is concerned, I'm very bullish on copper. Now, whatever is happening with China, the positive talks, the sense of positive talks between US and China, and the expectation of stimulus building over there, and copper market the concentrate market likely to witness big deficits. China rebalancing the smelting capacity likely to be weed off. All these reasons are very bullish for copper. 900 rupees, you can go long on copper, nothing to lose, 925, and it should not go below 885. So we are bullish on copper and silver, but silver, I would still say wait a bit. Copper, you can continue to buy.
Let's go slightly longer term now, Kunal. And while for the near term, you were expecting another $40, $50 of a decline in case of gold. From the all-time highs yesterday, we've seen gold decline almost by $50 to $60. But if you look at slightly longer term, and this is even after the US Fed meeting done, banks have reiterated that their 2026 targets on gold just about still continue. And yes, they do expect a near-term correction and a sharp one at that. So if you had to give the best targets on the lower side for investors to look at, what would that be?
I would say gold has a potential to even go down till $3,500 levels on COMEX. There is too much pessimism for the US dollar right now, and everyone is expecting dollar to crash. It doesn't work like that. There is no other currency available in the world which can replace dollar. And people are talking that gold, the role of gold in that kind of scenario. So all different sorts of theory are coming and hitting in the market. So I am of the very firm view that $3,500 we can witness. But I'm not suggesting that gold is in a structure going to enter into structural bull run. So the problem because of which gold prices are up, that will continue to remain for the far longer time. So I would say next year, gold is still poised to give you 10%, 12% return. That kind of scenario is still there. So I would say this year, 3750, 3800 looks top for the year. Next year, perhaps $4,000, $4,100 again can be tested because the US debt problem, because whatever the reason for buying gold will continue to exist. But for the time being, $3,500 can be tested for the COMEX future.
Okay, we'll keep an eye out on those levels. But next year, again, we could keep an eye out on 4,000. That's the word coming in there. Kunal as well as Manisha, thank you so much for joining us and talking to us about all the commodities that we should be keeping an eye out on going forward. On that note, let's sip into a very short break. We'll get you a special discussion on REIT market, especially after the SEBI's reclassification that's come in for REITs as equity. What does it mean? All of that after the short break.
Welcome back. You're watching us here on Halftime Report. And as we look at it, the market's taken a smidge of a leg down. It's below that 25,400 mark right now. It's led lower by the Nifty Bank, which is at 1 point higher by almost 300 points. Now sitting with a gain of almost 175 points, very close to the 50 and the 100-day moving average for that index. But the markets, as they move along, let's focus on REITs, as the SEBI has reclassified REITs as equity. What does this mean for investors? To discuss this further, we do have Sundareswaran S, who's the Managing Director at Morgan Stanley. Along with him, we also have Ramesh Nair, who's the MD and CEO of Mindspace REIT. Thanks a lot, gentlemen, for joining in. The obvious question, with the SEBI's nod coming in, classifying REITs as equity itself, do you have any sense of how much money it opens up for potential investment into REITs? And what does this do to the entire environment?
It's a big step from a government's point of view and very positive for our sector. If you look at the overall mutual fund industry, the 75 lakh crore, nearly 60% of that goes into equity funds. Around 25% of that goes into debt. Balance 8% is hybrid. Previously, we were classified as hybrid instruments. Now there is clarity that it's classified equity. We believe this will, globally, REITs are always classified as equity instruments. We believe this will help index funds, this will help ETFs, passive funds, many funds which are in small cap, large cap mutual fund focus. They will also start looking at REITs. So overall, very good. The last 3 days, all the REITs have done significantly well since the announcement. So very positive news for the sector.
Absolutely.
The only thing I'll add is, keeping aside, what is the flow, right? Is this the right classification? We think this is absolutely the right classification. This was always intended to be an equity product. Obviously, SEBI wanted to give it some time before that classification came through. We think this is absolutely the right thing to do. The impact it has is not just on the flows, index inclusion, etc. And ultimately, this is an equity product, and this is where it should really be categorized as.
Do you think this could lead to better growth as well, right? Because globally, REITs are a bigger market value compared to what we are in India. And do you think now this will be one of those changing factors for REITs?
No, clearly, India is one of those unique markets where there are more home builders and developers who are listed than the REITs. I think that ratio is probably still going to take a while before it changes in India, but we think this is definitely going to give a big heads up in terms of increasing the overall equity market capitalization for REITs. Today we are probably just shy of $20 billion. We think that number has the potential to sort of meaningfully go up from where it is today.
Let me just, ask you about that meaningful growth that you see from that $20 billion. How much are you probably expecting the market to expand, say 3 years down the line?
So if you look at it today, you have predominantly commercial real estate and retail, which are listed as the REITs, right? The total stock which is listed in the form of REITs today is probably between 100 to 125 million square feet of completed. The total stock in India is obviously a much higher number, so I don't want to sort of get into that. Maybe not all of that goes towards the REIT market. But I think that what it does is, when I say the number can go up meaningfully, I think the equity classification will help up diversify the investor participation. If you look at it from the time the first REIT got listed to now, initially it was all dominated by foreign investors. Then you saw the domestic asset managers come in, and now you're seeing the domestic wealth also sort of playing in. We think that is what is going to change. Can it double from what it is today? I'm hoping in the not too distant future.
So you're not ruling out $40 billion in terms of a size?
Hopefully.
I'll just add to that. I think more education is required from a REIT as a product. From a few thousand when the first REIT came up in 2019 to today around 300,000 people. We have slowly seen people like mutual funds today have invested close to 30,000 crores. Insurance companies have invested close to 10,000 crores. I think a lot more education is required. Like our REIT in the last 1 year has given a total return of around 36%. Not too many people know about that. In the last 2 years, we've given an annualized return of around 27%. And last 5 years since listing, we've given a 15.8% total return. Now, in a world where there's so much of volatility, so much of worry. A 36% return over the last 1 year is fantastic. I think that's the kind of, we don't have big budgets like Amphi from a marketing point of view. It's early days, there are five REITs, and we see this market significantly.
You spoke about the education part of it. So let's cut it down to the basics, the brass tacks. From an investor standpoint, what different or what benefit does investing in a REIT bring versus, say, direct exposure to tokenized real estate now, or even, you know, buying some of the shares of these developers who are there?
So 4-5 things. Obviously, you get your dividends, which is we pay out on a quarterly basis. There is it's an inflation hedge given the returns you get. There's professional manage. It's professionally managed. You're not buying a starter sold small 5,000 square feet office space here. There's a team of 100 people supporting you with highly transparent sector. The SEBI has made it very, very highly governed, highly compliant sector. So multiple such benefits which the investor gets. But the main thing is the returns which I just spoke about now.
Past returns are not obviously an indication of the future returns.
The sector has done so well. So even if it's obviously driven by IT services, global capability centers, the costs even today from a HR point of view is 1/10 of Western markets. So talent costs. So
what is your sense on the GCC market now? You know, what is the growth that you're anticipating? Are you expecting maybe some kind of roadblocks simply because of the tariff situation?
Actually, we haven't seen that. See, in the last 6 months, there's been so much of uncertainty around tariffs. I was just looking at the numbers before the interview. The net leasing has actually gone up in the first 6 months of the calendar year by 28%. And gross leasing has again gone up by around 18%. So it's not stopping companies from taking space up. So every quarter, every time I see an IPC come out of the report, we're seeing record quarters over the last like 7-8 quarters we've been seeing. So I haven't seen that impact come except during that Pakistan war time where that 15-20 days we saw some decision making slow down, but otherwise it's like the markets are on steroid.
There's no issue, so there's no setback right now.
We haven't seen anything at least till.
See, since the first REIT got listed, it's been almost 5-6 years. I mean, we have gone through multiple challenges. COVID happened and a lot of other things. I think in the midst of all these things, I think REITs have really been resilient. I think they have continued to deliver returns. I mean, I think
You also have the SM REIT category, right? Just tell us a little more about that, the demand, the threshold. What is the kind of interest that you're seeing within that space?
So not want to take that.
Yeah, so that as a category is also sort of picking up. Now, it was something which I think SEBI wanted to make sure that the larger REITs get listed, how it plays out, and then it sort of goes, it's a natural evolution into that. What that offers is an ability for smaller players to sort of list smaller assets while maintaining the governance framework even for these. So I think it's a welcome change. Again, as a firm, we don't spend too much of time on the SM REIT as a category, but I think it's a welcome change and it's a step in the right direction.
So if I'm looking at the fundamentals of investing in a REIT, it would obviously be the underlying portfolio, the returns that it gives on the dividend that it gives on a quarterly basis, and how that expands, right? So on those two parameters, if you could give us some trends, what is the kind of asset addition that will happen to, say, a player like you on an annual basis? What are the kind of rental increments or yield increments that we will see on your REIT portfolio?
See, looking at yield alone is not the right parameter. One should look at total returns, which is price appreciation and the yield. And the numbers which I spoke about last 1 year, 36%, is the total return. Over the next 3-4 years, we plan to spend capex of close to 4,250 crores on capex. We have already spent around 650 crores on upgrades. We will be spending more than that. There's around 1.9 million square feet which still has to be leased. We are going to be making NOI from that, from rental revenues. We also have around 7 million square feet for development, which is in various stages of development. So you add up these, we're talking of close to 1,000 crores of NOI coming in the next 3 to 4 years, for a NOI of last financial year, which was around 2,060 crores. That's going to be like a 50% growth in NOI coming, and this is only organic. I'm not talking inorganic where you're buying third-party assets, where you're buying sponsor assets, where you're buying landlord assets from a JV partner. So that's separate. Just organic, there's an opportunity to grow by 50% NOI growth in the next 3 to 4 years.
Okay, all right. Just a quick one. Micro markets and micro cities, are you seeing a growth there as well in terms of the development, rental side? What is that happening over there?
Definitely. So the market where I saw the maximum rental growth last year was the high-tech city Madhapur market. When the year started, rentals were around 75, 78. And by the time the year ended, the financial year ended, we're talking of 95 rupee rentals. And we've been big beneficiaries of that. It's a place where we have 13 million square feet, where vacancies like less than just 200,000 square feet. So there are those kind of markets which are showing growth across the country.
All right, gentlemen, we've completely run out of time, but it's been a pleasure speaking with you about the REIT market. I'm sure there will be much more interest post the reclassification by SEBI. Thanks very much for joining in and speaking with us. Well, we need to take a short break on that note. More on the markets once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Nifty as of now is below 25,400 levels, just managing to hold on to gains of 0.2%. 50-point gain is what we're the Nifty is managing to see as of now. Sensex is also down from the day's highest point, so keep an eye on that. Let's pull up the Nifty Midcap. That's in the red as well, so it's down 0.1%. The Nifty Midcap significantly off the day's highest point right now, and especially in the last 20 minutes to half an hour, we've seen that fall coming in. And in terms of drags for the Nifty 50, if you look at that, also we have Bajaj Finance, Tata Motors, M&M among the top drags for the Nifty 50. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, Business Lunch.
Stocks continue to gain but are marginally off the highs after the US Federal Reserve cuts its benchmark rate by 25 basis points with an indication of further cuts. IT and realty are leading the gains while industrials and energy are the big drags.
Cohance Life Sciences promoter Advent Private Equity upsizes its stake sale plan to 8.9% of equity from 5.1% earlier. The move signals strong demand and high investor interest in the contract development and manufacturing business.
Apollo Tyres' managing director Neeraj Kanwar tells CNBC TV18 that the Indian cricket team jersey deal was stuck at 579 crore rupees for 3 years, but they are in it for a long innings like they have been with Manchester United. He also guides for double-digit growth in the business.
Finance Minister Nirmala Sitharaman says the government has delivered on ease of doing business and that PM has never ignored wishes of industry. Given this, she expects industry will now not have any hesitation to invest.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormus Fatakia. With me as always is Vamakshi Dhuria. Vamakshi, good afternoon. It was turning out to be yet another good day for the bulls, but we are slightly off the highs. The Midcap index has even slipped into the red now, and it's a proper BSE expiry session playing out.
Well, absolutely, Hormaz. You know, one would have hoped that at least the higher levels sustain, but that's clearly not the case. We're off, I think, about 70 or 80 points off from the day's highest point. We did see a century, at the beginning of the session, but, clearly that hasn't sustained. The Nifty 4 now is trading with a gain of around 59 points. Apart from that, when we take a look at the mid-cap end of the market, like Hormaz was pointing out, it has managed to slip in the red. The advanced decline ratio now in favor of the declines. The bank Nifty as well is managing to hold on to its gains, but still lower as compared to what we saw in the morning. The Nifty bank is up almost 0.3%. But apart from that, lots of sectors moving around in trade. The first one being IT, of course, given the rate cut that we saw from the Fed last evening, IT stocks are booked up in trade. Take a look at LTI Mindtree. In such a market, that stock is up almost 2.5%. Infosys is also, pushing the index higher. But on the flip side, what's slipped into the red is the Nifty PSU Bank is down almost 0.4%, Hormaz.
There are two very important levels that we had highlighted earlier in the morning. 25,350 on the Nifty, and we are exactly at that level right now. It's a bit of a steep fall that the index is seeing now from the highs, and the other one, of course, being 55,700 for the Nifty Bank. So that is the other important level, and the Nifty Bank is also around about and has cooled off significantly from those levels. In fact, it has almost moved into the red now, has the Nifty Bank. It crossed those levels, both the Nifty and the Nifty Bank crossed those levels intraday, but have not managed to sustain at those levels. So 25,450 is the August congestion zone, 25,350, 450. That's the important level to watch. And 55,700 is the high of the 25th of August for the Nifty Bank. So we need to keep that in your minds as the second half of this weekly expiry session for the BSE contracts plays out. For now, the market's significantly off the highs of the day. But the big story of last night was the fact that the Federal Open Markets Committee has lowered its benchmark overnight lending rate by 25 basis points in an 11-to-1 vote, putting the overnight funds rate in a range between 4 to 4.25%. CNBC's Steve Leisman brings us the details.
The Federal Reserve gave the market exactly what it wanted, a 25 basis point rate cut and a forecast for 2 more. But it also introduced some risk into the outlook. There was an expected dovish dissent for a 50 basis point cut by new Fed Governor Stephen Miron, but also widespread disagreement on the committee over the right path for rates.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views.
You could see the disagreement on the committee in their forecast for rates this year. One official didn't want to cut at all. 6 want no more cuts after the one this time. 2 want 1 more cut, 9 want 2 more cuts, and 1, apparently Stephen Miron, the new Fed governor appointed by President Trump, wants 5 more cuts this year. That forecast, called outrageous by bond investor Jeffrey Gundlach, could be a sign of things to come. Joe Busuelos of RSM saying, quote, "Given the coming changes to Federal Reserve personnel next year, we urge all to take this forecast with more than a grain of salt and would strongly suggest that the Federal Reserve is moving in a direction where it will tolerate inflation well above target." Futures markets traded with confidence there will be at least 2 additional cuts this year, maybe even more confidence than Powell expressed. The key to the immediate outlook may be in the statement, which said that downside risks for employment have increased. As long as that's the case, the Fed may be cutting rates until the inflation and employment risks are balanced.
Well, let's also hear out what Sajid Chenoy, who's the chief India economist at JP Morgan, said on the Fed's rate cut.
We've been arguing for a long time that tariffs and immigration are both stagflationary shocks. They simultaneously hurt growth. But if the labor market, if this is a head fake, and the labor market stabilizes, it's important to realize that the break-even rate may be lower in the US now because of all the anti-immigration efforts. If this is a head fake and the labor market stabilizes, then this could be a much shorter easing cycle because this is purely insurance.
Now, the Bank of England is also set to announce its interest rate decision later this evening and is expected to keep interest rates unchanged after a rate cut in August. The central bank will be keeping a keen eye on inflation, forecasting that the CPI inflation could peak at 4% this month. And it has also said that earlier it mentioned that it would take a gradual and careful approach to monetary easing, keeping in mind the inflationary pressures.
Well, we also spoke to Goldman Sachs Global Emerging Markets Equity Strategist Sunil Kaul on the outlook for the Indian market, the impact from the GST rate rationalization exercise and their sectoral picks. Listen in to what he had to say.
I think obviously the second quarter reporting season was generally pretty decent. The bar was low, but I think we got the underlying earnings growth of around 12%. Our full year number for calendar 2025 is about 11% earnings growth, and we think we are kind of on track to meet those. We have started to see in the last couple of weeks sort of earnings upgrades in the consumption space, notably in staples, in discretionary. And so I think the sentiment is starting to improve. When you look at the broader market, there are still more downgrades that have happened in the last 1 month since the GST announcements. Then we have seen upgrades, which means the net sentiment is still sort of in the red zone. Our sense is that in general, it could improve India's earnings by 1 percentage point. It sort of looks a bit low, but it's because it's concentrated in consumption, and large parts of the other markets do not really benefit from GST. But net, that should be accretive for underlying earnings. We haven't raised the numbers a lot because some of that gets shaved in because of lower growth on the infrastructure side and the continued uncertainty around tariffs. So net, we still think overall there is a net positive earnings impact from the GST overall for the market. As I mentioned before, even after the personal income tax cuts that we saw through, we already had positioned in terms of liking the consumption sectors over investment sectors. And so we are overweight staples that should benefit from the GST cuts. We are overweight autos. We do pick up some of the QSR and the tourism and the internet names through the overweight in the internet or the TMT sector in general. We also are overweight financials. So I think financials and consumer sectors are where we have our sort of most positive views on. On the other side of the ledger, we are underweight infrastructure, excluding defense, which is a structural theme, but the rest of the infrastructure pack, we are underweight pharma. And so we have a clear preference of consumption over investments there. We are neutral IT, realizing that it has come off a little bit, but we think it may be a little bit too early to position there.
Take a short break, but just before we do that, here's a reminder for our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBCTV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, masterclasses and curated lifestyle benefits.
Welcome back. You're watching Business Lunch on CNBC TV18. Finance Minister Nirmala Sitharaman has urged India Inc. to boost its investments in India, saying that the government has worked towards easing business regulations. Listen in.
If the government has been steadily moving, as was the expectation of the industry, that do this for ease of doing business, do this for tax-related benefits, do this for businesses to be better off, bring this policy, open up for more FDI, literally everything. And I take every one of them with the necessary seriousness. I hope there's no more hesitation for industry to invest further, to expand capacities, produce more in India. And what else is required by the government to do? Spell them out. You have a prime minister in this country who you have known for decades, from his days as chief minister of Gujarat. And he's never relented on reforms, nor has he ignored the wish list of the industry.
Now, Tata Steel's MD and CEO TV Narendran says that the global environment for the steel industry remains challenging. Listen in to his conversation with Parikshit.
Globally, for the steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month. And oftentimes at prices at which they themselves don't make money. So it's very difficult for anyone to compete with that. But luckily for the Indian steel industry, the demand growth in India has been strong. So we've been less vulnerable to what's happening in the global markets. The additional capacity that many of us have built in India are being fulfilled, being taken care of from the demand that there is in India. But if we were to export, yes, it would be challenging.
And in an exclusive conversation with CNBC TV18, Vivek Chand Segal, who's the chairman of Samvardhana Motherson Group, says that they have no problem in making cars and can begin the production as soon as possible. Listen in.
A lot of the car makers are asking us to set up manufacturing plants for them. But manufacture not in a sense of big numbers or something. These are niche areas where they want the car to be produced. And so why not? We can assemble machines, we can assemble the components, we can assemble a car, why not? The moment the customer gives us this thing, we'll go ahead.
Parikshit also spoke to Salil Gupte, the president of Boeing India and South Asia, about Donald Trump's tariffs and its impact on their business. Listen to what he had to say.
We're certainly continuing to assess the impact and potential mitigants, but what I can say is that we remain optimistic that because the U.S.-India relationship has been so strong and has gone from strength to strength over the last 20 plus years, that the two countries will find a way forward that enables trade to continue and collaboration on the industry front to continue. Regardless of what the various tariff regimes are, we have always advocated for what we call 0 for 0 in terms of tariffs. That in aerospace and defense, zero tariffs are the path forward because aerospace is such an important part of both infrastructure and national security. Well, certainly right now, in terms of financial impact, that continues to be under assessment. But in terms of decisions on what we are going to do from a sourcing and industrialization standpoint of India, we are more adhering to the joint statement of Prime Minister Modi and President Trump from February, where the two leaders came together and indicated that it is in the interests of the U.S. and U.S. industry to continue to grow industrial base in India, that is helpful to U.S. national security, and that is helpful to both countries. We're a good example of synergy between the U.S. and India in terms of how we can create a win-win situation. We're going to continue to pursue that and then hope that the two countries can work out the tariff situation in the next few weeks.
All right, on that note, let's slip into a very short break. For now, more news and updates follow on the other side, so don't go anywhere.
Welcome back. On to some national developments then. Doctors across Maharashtra are on a 24-hour strike today, protesting the state government's move to register homeopathic practitioners who have completed a one-year pharmacology course with the State Medical Council. Now, the Indian Medical Association claims nearly 1.8 lakh allopathic doctors, including those from private hospitals, have joined the protest. While emergency and critical care services remain unaffected, doctors warned that the move could compromise patient safety and healthcare quality. The controversy stems from a revived government resolution allowing certified homeopaths to prescribe allopathic medicines, sparking strong opposition from medical associations across the state.
All right, moving on then. US President Donald Trump is on his second state visit to the United Kingdom, which kicked off with a ceremonial welcome at Windsor Castle. CNBC's Eamon Zavers gets us all of the details.
Royal Bank. Now, the serious business begins today with a business roundtable event featuring the CEOs, many of whom have announced billions of dollars worth of economic development deals in conjunction with this trip.
All right, thank you so much for that. Now, at its annual Connect event, Meta CEO Mark Zuckerberg revealed the company's latest wearable technology products, which include the Meta Ray-Ban display glasses and the companion Meta Neural Band, and the Ray-Ban display marks Meta's first pair glasses equipped with AI and feature a full-color high-resolution in-lens display. Now, the glasses allow users to check messages, preview photos, or interact with AI prompts without looking down at a phone. Let's take a look.
Now, I'm at Meta Connect, as you can see, and Ray-Ban Meta Glasses Gen 2 were launched here. I'm wearing it right now. Now, I have been using the Gen 1 of the Meta Ray-Ban glasses for past year almost to take my calls, listen to music, and capture videos even during my runs and commute. So, when Meta dropped the Gen 2 today, I had to check them out, and honestly, these are some of the upgrades that I have been waiting for. So first up, what's improved? Battery life. Now, Ray-Ban Meta Gen 1 lasted up to 4 to 5 hours. Gen 2 can give you up to 8 hours plus 50% charge in just 20 minutes. The case carries extra 48 hours. So great for your commute, work commute, travel, and even more. Next, video. Now, I loved my point of view clips on Gen 1 whenever I shot them, but they max at 1080p. Gen 2 brings 3K Ultra HD at 60 frames per second with HDR. Also, later in the fall, company is promising hyperlapse as well as slow-mo on these models. Then, audio plus AI. Still, it's open ear, so you don't have to put anything in the ear, and AI has become more conversational. Live translation is now available in 6 languages, even offline. So hence perfect for travelers. Style-wise, still the iconic Ray-Ban Wayfarer, Skyler and Headliner, plus new colors like Cosmic Blue, Mystic Violet. Some of the colors that I really love. They look like actual glasses and not gadgets. That's like a big plus for me. The price, it starts at $379.
And with that, we call time on this edition of Business Lunch for the penultimate time this week from Amakshi and me. Thank you for watching. We leave you with the Nifty still around about 40 points higher, trying to recover from the lows of the day, but the broader markets have slipped into the red. Midcap radar takes the action forward.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Markets, they've come off from the highs of the day. We are below that 25,400 mark. At a point in time, we were up around 110 points. It's a 60-point downtick from the highs of the day. We did see some pressure coming in on the mid-caps as well. We'll discuss all that and a lot more on the show today, Vivek.
Good afternoon. As you mentioned, it's been a very topsy-turvy market, especially in the last half hour or so. The mid-caps or the broader end of the market saw significant selling pressure, but now has recovered slightly from the day's lowest point as well. We have a lot lined up on the show, an important corporate conversation. Let's start off with the top headlines. Stocks fall from highs after gaining for the third straight day in the week after the US Federal Reserve cuts its benchmark rate by 25 basis points with an indication of further cuts ahead. Energy and PSU stocks fall while IT and Pharma lead gains.
Shares of Poonawalla Fincom surged to a 52-week high after the company's promoters complete a 1,500 crore rupee fund infusion, increasing their stake to 63.97% from 62.43% earlier.
Cohance Life Sciences promoter Advent Private Equity upsizes its stake sale plan to 8.9% of equity from 5.1% earlier. The move signals strong demand and high investor interest in the contract development and manufacturing business.
Shares of Page Industries slip as HSBC issues a reduced rating on the stock with a target of 41,040 rupees as it sees only limited potential from the launch of athleisure collection JKY Group.
SBI Card and Paytm in focus after RBI directs fintech companies to withdraw credit card rent payment facility. Payment aggregators and payment gateways are now only permitted to process transactions for merchants who have completed their KYC processes.
All right, those are the top headlines that we are tracking. As for the markets, we've pointed out markets are off the day's high. So it's a 40-point uptick that we are seeing on the Nifty currently. We do have the mid-caps, which have seen a bigger pressure. The advanced decline ratio is in the favor of declines as we speak. There was a blip. The Nifty mid-cap index turned into the red for a brief period of time. And there you go. The crisscross lines, which were in favor of advances earlier, have now moved in the favor of declines as we speak. So a lot of pressure is on the mid-cap side of things that we are talking about right now. Couple of stocks from the broader markets which are on our radar. IRM Energy, which is up 13.5%. We have Prism Johnson. Poonawalla Fincop is the other one that we spoke about earlier. Of course, we'll discuss that in greater detail. But let's talk about mid-caps itself, because this is our special segment, Mid-Cap Movers. Vivek has gone across to the big wall. Let's talk about the mid-caps that are moving around in trade, Vivek.
Well, that's right. Quite a few stocks moving on pretty high volumes as well. First, have a look at, Poonawalla Fincop. A promoter equity infusion has come about, increases the book value per share significantly. Street clearly cheering that particular move higher by almost 12%. The mid-cap IT space, post the rate cut, seeing significant cheers. So look at names like L&T Tech Services and some other names like Sonata Software doing quite well in the session. Escorts Kubota amongst the top gainers as far as the NSE 500 is concerned. And like we mentioned, the mid-cap IT space, Newgen Software again 5% higher, and one name from the defense pack that continues to move higher is Zen Technologies. On the other hand, we did allude to Page Industries earlier. HLPC sales demand trends are quite muted. That particular stock down by over 2%. Cohance Life Sciences, significant pressure coming about after the overhang of a large stake sale. PI Industries, that particular stock in the broader end of the market down over 2%. DCM Shriram amongst the top laggards as far as the NSE 500 is concerned. And SBI Cards, like we just said, some pressure coming about as far as new segment of rental payments is concerned. On the back of that, that particular stock has recovered a little bit from the day's lowest point, but still trading with a cut of close to 1%.
Okay, all right. Thank you so much for joining us with all those details, Vivek. We've been talking about a lot more stocks which have been moving in the broader markets. High-tech pipes is the other one. The entire pipe space has been buzzing. So that stock is up around 11.5%. We do have Bajaj Consumer. Heritage Foods is the other one. Banco Products. Red Tape, second day moving for this particular name. So all these stocks are on our radar now. But let's get a corporate conversation now. SmartWorks Co-working Spaces, that is the stock on our radar. Nitish Sarda, who's the managing director and founder of the company, is joining us now to discuss a few points. The first, of course, is the revenue potential from the new commercial park, leasing targets for FY26 and the pricing trends as well. These are some of the points we'll be discussing apart from their expansion plans as well. Nitish, good afternoon. Thank you so much for joining in. You know, you've spoken about expanding more in the Mumbai market, reaching that 1 million square feet in terms of leased portfolio. But about the campus that is developed in partnership with Tata Realty, how does this partnership work? They have built the campus, now what? Like, you will be renting it out. Is there any potential revenue share that will happen here? Can you explain the contours of this particular partnership?
Absolutely. First of all, thank you so much for having me on the show. I think the size that SmartWorks has currently present in Mumbai, we were closer to about 500,000 square foot before we took up this property. This property now increases our footprint by over 125% in Mumbai, taking our footprint to over 1 million square foot. This is the largest campus in the city with over 12,000 seats that will be there in the center. The deal with Tata Realty is in a strategic location of, the Thane Belapur Road. We've gone ahead and taken the entire 557,000 square foot building in their Intellion campus. We've leased the entire building on a long-term lease. And there is no revenue share model, but with looking at SmartWorks' current presence, our existing centers, which are already operational, are above 95% occupancy in the city. And we're seeing a significant amount of traction. So being the financial capital of the world, we're happy to announce that of India, we're happy to announce that, we've increased our footprint to over 1 million square foot here in the strategic market.
Understood that. So give us a sense of how exactly this works for you. Do you already have tenants for this particular campus? And typically give us a sense of the sectors that these tenants belong to.
So we have a lot of indication from a lot of our large enterprise clients who want to expand into this location. Almost 35% of our existing revenue comes from our existing customers growing with us. So there is definitely a lot of traction for this location. Most of this traction is coming from large enterprise ITES clients. Our focus is always on, mid to large enterprise clients who are taking 300 plus seats. So most of the demand for this building is also coming from such clients. But ITES and GCCs are the major focus with the kind of traction that we've gotten so far.
Got it. Nitish, IT is one space which has been seeing some headwinds right now. Do you think the demand will not be as strong as what you have seen in other centers of the company? Also, how long does it take for a new center to achieve that break-even level? How many new centers are still to achieve that level for you?
This is the new center in Bombay. We have signed almost more than 1.5 million square foot, spread across in this financial year so far. I think it takes us about 4 months to build out a center to get to operational. From there, it takes us about anywhere between 10 to 12 months to get it to a break-even stage. Initially, that is the time that it takes. But just because of our focus on large campuses and our focus on mid to large enterprise clients who are more sticky in nature and who come and take up much larger spaces, that's why once it gets to that 60-65% occupancy in the first 10 to 12 months.
Hi, Nitish. I think we have a bit of a glitch as far as that connect. Yeah, please continue, Nitish.
Sure. So with the new centers that we've already signed up, we're seeing a significant amount of traction increasing in all these centers. While it takes you 3-4 months to build it out initially, but the ramp up visibility is very, very good.
So you're saying the payback period for any new center is around 12 to 18 months. Did I read that correctly?
12 to 18 months after it has gotten occupied. So typical payback period from the time that we invest is within 3 years, we get our entire investment back.
Got it.
Okay, Nitish, give us a sense of how the balance sheet is looking. Also give us a sense of cash flows. How is that looking? What is the total debt on books? Current financing cost? Post rate cuts? What kind of interest cost savings can you see?
SmartWorks has been going strong quarter on quarter. If you look at our numbers, last year we closed at 1,375 crores in revenue. The first quarter of this year, we had a 21% jump with closing the quarter at 379 crores in revenue. But that also with a significantly reduced loss. Our losses last year were closer to about 56 crores in the first quarter. It's come down to only 4 crores. So there is a constant progress despite the high growth base that we are in towards getting towards that profitability. If you look at our EBITDA margins, that has also been steadily growing. you'll see our EBITDA margins have grown, from 58 crores to the 90 crore number that is there. And if you look at our OCF, which is the true cash flow that the business is generating, SmartWorks has been constantly demonstrating that our cash flows are very, very strong. Just in the first quarter of this year, we generated a free cash flow of over 70 crores. So that cash flow coming in is helping us expand the business. If you look at the debt in the books currently, we're a net debt negative company now. We have enough cash flows in the company, and the debt amount is significantly lower than the cash flows which are available, or the cash which is available with the company. Some high cost debt we had returned with the IPO proceeds that we had raised, back in July. But I think our debt positions are lower than our net debt negative right now.
Got it. So, net debt negative, that is an important update that's come by for SmartWorks. Nitish, we had spoken earlier and you spoke about expanding internationally as well. There's a Singapore center, and now that you have free cash flows, you are in that expansion mode already. Tell us, how does it differ in Singapore versus India in terms of pricing, in terms of the capex that you have to make? Do you have any further plans to expand internationally? What kind of seat addition are you looking at?
But if you look at India as a market, it's such a huge market with so much potential. As I said earlier, we've already signed over 1 million square foot, 1.5 million square foot just in the first half of this year. We're seeing so much demand coming from India that our focus is always going to be in India with the size and the kind of centers that we are taking up. Singapore was more of a strategic expansion. We realized that a lot of international clients coming to India have their decision-making or regional headquarters based out of Singapore. So having a presence there gives you the ability to be closer to the decision maker. I think strategically we would want to keep growing in India because we're still, just a very small player in a very big potential market. The market is over 1 billion square foot. SmartWorks' portfolio is closer to about 12 million at this point of time. So I think there is vast potential in India itself, and our majority of our expansion and our focus is on the Indian market. But we will be opportunistic about the different markets depending on how well Singapore has done for us. We are still evaluating that. It's only been a year, but both our centers in Singapore are above 95% occupancy, and we're seeing a lot of traction coming from that market as well.
Okay, thank you so much, Nitish, for joining us, giving us a sense of this particular development as well as the way forward. We'll now slip into a short break. On the other side, Rajesh Palvia from Axis Securities will join us to give us a quick technical check on the market as well as its top trading picks. Welcome back to Midcap Radar. Well, the market has picked up some steam, especially the Pharma pack. The Nifty Pharma Index has surged to the day's highest point, and Biocon, one of the stocks that had some positive news flow in terms of a drug not coming through. That stock is higher by almost 3%. But it's a good time to welcome Rajesh Palvia from Axis Securities for a quick technical check on the market. Thank you so much, Rajesh, for joining us. First up, what are you making of the markets at current levels? It's cooled off a little bit from the day's highest point, but does the underlying positive momentum sustain?
Yeah, good afternoon. Yeah, definitely. So looking at the overall setup, we believe that, this momentum can extend further as broader market is showing a sign of confidence, and buying action is clearly visible in most of the sectors. From mid-cap, small-cap space is also showing buying interest. Nifty Pharma, Nifty Metal index is, showing a sign of buying interest. So I think till we are trading about 25,300, I think one should remain on the long side of trade for trading point of view also. On the higher side, the immediate call concentration area is placed at 25,400, 500 zone. So any breakout about 25,500 may attract more short covering, and then possible rally can extend to 25,700 also in the continuation of this up move. Even on the bank Nifty also, we are comfortably holding above 55,500 zone. So till these levels are intact, I think trend is likely to exhibit on the bullish side, and maybe in the bank Nifty we may see a breakout above 55,800 in next couple of days, and once that happen, rally can extend further in banking stocks also. So we are holding bullish view for both the indices. On the stocks front, at this juncture, we are focusing on pharma as well as on the metal space. From pharma space, Laurus Lab is looking promising. The way stock is, moving in higher top, higher bottom formation, we believe that, this stock can continue furthermore upside. We are positioning target of 945 to 950. So one can buy Laurus Lab. On the downside, needs to keep stop loss around 895. And another stock is from the metal space, that is NMDC. Stock managed to view breakout of consolidation on weekly chart. Looking at the daily, weekly structure, we believe that, this stock has, potential to continue furthermore upside. So NMDC one can buy for upside target of 82 to 85. On the downside, 73 needs to keep as a stop loss.
Take that point, Rajesh. Thank you so much for joining in with those individual picks and the important levels to watch out for on the Nifty as well. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the stocks and markets as well on the other side. Welcome back. You're still tuned on a Midcap radar. SBI Cards and Paytm, the stocks are on our radar as RBI has tightened payment aggregator and payment gateway guidelines. Gaurav is here with more details on this one. Gaurav?
Well, yes, when we look at RBI guideline, let's understand what has happened. As per RBI, what they are saying is that the PA, which is payment aggregator, shall aggregate funds only to the merchants with whom it has contractual relationship. Now, what has impacted is that, let's say, for example, when users are using payment gateway or payment aggregators, they pay several bills like rent, they pay several bills like electricity bill, mobile bill, and at the same time, payment aggregators were also allowing them to pay rent via payment aggregating websites. Now, this also includes that they could pay rent using credit cards, and this is something that now RBI has restricted. What they are saying is that KYC was one of the things that were in focus, and at the same time, RBI also says that they have to be onboarded as a seller or merchant. It's not just KYC, but it's also about which category the payment aggregator or the user is falling. So that is something which is actually restricting the application of payment of rental agreements, specifically from the payment aggregating websites. Now, what is impacting is that the websites like Paytm, they had already actually stopped their services for rental agreements, but at the same time, the credit card companies like SBI cards, there is something, these are the companies where we may see some kind of impact, because, for example, when we look at SBI cards, around, so from their retail credit segment, around mid-teen segment is what was coming from the rental agreements back 2 years ago. After that, the company said that they have actually slowed it down, but even at this moment, analysts believe that there may be some kind of EPS impact because of the complete stoppage of rental payments using credit cards, and that is something that we will be watching out for during the results, and at the same time, how company is going to talk about this during the commentary. But at the same time, as of now, we are seeing some kind of negative impact on the stock price as well for SBI cards.
Well, Gaurav, thank you very much for joining us. This is an important development, especially as far as payment aggregators as well as credit card companies also seem to be or appear to be impacted by this particular development. It's a segment of business that's important for them, and they also charge user fees as far as taking care or taking into account this particular segment. Some very important flashes on the bottom of your screen. Marauti Suzuki has said that they will now start passing on the entire GST cut benefits on to the customers. They are planning to slash the ex-showroom prices, and they will also go ahead and pass on the entire GST rate cut on automobiles to the customers. So you could see significant price cuts coming in as far as Marauti Suzuki cars are concerned in the Indian market. But with that, it's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC TV18. I'm Vinny Motiwala, with me Sonal Luthra as well. Sonal, good afternoon. And we have some recent changes that have come in from SEBI. How will that impact our mutual fund industry? That's what we're going to be discussing. But what are these changes? What are we looking at now?
So let's start with what has happened. The board of SEBI has approved the amendments to SEBI mutual funds regulations for reclassification of real estate investment trusts or REITs as equity, and the hybrid classification will continue to stay for InvITs, and that is why infrastructure investment trusts for the purpose of investments by mutual funds or specialized investment funds. The market regulator has also decided to revise the incentive structure and provide incentives to distributors only for investments or inflows from new individual investors from B30, that is the below 30 cities. So what does that mean? Will it mean there is more focus on REITs by mutual funds? Will it increase the investments there? And what happens with distributor incentives as well in B30 cities? To understand more about this, we have with us Mr. Sandeepan Roy, who's the Chief Investment Officer at Motilal Oswal Private Wealth, and Nirav R. Karkera, who's the Head of Research at FISDM. Gentlemen, thank you so much for joining in today. Sandeepan, let me start with you first up, because now SEBI has reclassified REITs as equity products, InvITs as hybrids. How does it change it for as an asset class for mutual funds? Does this improve MF flows into these categories?
Yeah, interesting. So REIT has been classified as equity, while InvITs has been retained as hybrids. I think this is a welcome change. To just put it in context, there is enough headroom for REITs allocation in mutual funds today. In US, for example, the REITs market cap is about 1.5 trillion, which is just about 2.5% of the total market cap. Compare that to India, it's roughly about 1.5 lakh crores, the private and public listed REITs that are there in the market, which is roughly about 0.3% of the total market cap. Which shows that there is huge scope for allocations for this market to develop. That headroom will translate into an MF AUM. Let's say today, out of the 75 lakh crore or 77 lakh crore MF AUM that we have, roughly about 24,000 crores is REITs, which is not even 0.5% of the MF equity AUM. Okay, can we really see an uptick in this category? The answer is yes. Now, there are two questions that need to be answered there. One, why has it not really picked up even now? Because even now, SEBI, for example, had allowed 10% in REITs and InvITs as an allocation, and within that 5% to a single issuer. But still, the max allocation that we see in various MFs, as I said, it's less than 1% as an aggregate of the AUM. And that primarily is because of two reasons. On the debt side, I think the fixed income fund managers have been reluctant to really have a big exposure in this asset class due to mark-to-market volatility. And on the other hand, on the equity side, I think the nature of this asset class is more, I would say, dividend yielding, cash flow yielding, and not a classical growth asset. And hence, the equity mutual fund managers would have also been kind of reluctant in increasing their exposures here. So this asset class largely found its space in the hybrid category of funds. So I think logically that space will actually have an improvement over the medium term. In the hybrid and BAF category of mutual funds, you will see REITs allocation increasing, and also it will be employed as a defensive or a contra strategy whenever there is, let's say, a bearish outlook in the markets. Interestingly, I have a slightly different take in the very short term. I think unless grandfathering is allowed, debt mutual funds might be forced to move out of REITs, given it's in a hybrid investment and not a debt instrument. And it will become classified as an equity instrument and not debt. And hence, these debt mutual funds who are already invested, typical income funds, etc., they may have to move out of REITs, which may lead to some bit of sell-off. Same can be the problem with, let's say, very conservative hybrid category of funds, where, let's say, already 25% equity is there, and then you had put REITs as part of the hybrid or the debt instruments. And there, the reclassification will lead to them actually breaching the 25% limit on the equity allocation. And you might see a sell-off there also. So in the short term, it will be interesting to see how these debt and conservative hybrid MFs react to the REIT allocations. But in the long term, I think it's definitely positive.
Long term, surely positive. Short term, we'll have to watch out for what happens to hybrid and debt. Sandeepan as well as Nirav, good afternoon. Nirav, what's your thought coming in on this front as well, right? This reclassification long term, surely a positive. But overall, in terms of exposure now, are there already enough funds that come in? Or equity side, do they have enough exposure? I think Sandeepan was, right now saying that there are very little percent in terms of AUM that actually comes in here. So how do you see that moving as well? And do you think that we could see more investments now coming in for REITs from mutual funds versus what we could see in terms of real estate currently, what they are doing right now?
Right. So, Vinny, a couple of things here. One, of course, the mutual fund industry's exposure is pretty limited to REITs and InvITs as we speak. And there's a reason beyond, of course, the most obvious ones that were shared. I'll just top it up with a few market side or supply side reasons. One is there are only a handful of REITs that are publicly listed, right? So the investable universe itself is not very broad. And now even within these handful, 5, 6 odd REITs that are available for, that is publicly listed and is investable, if you look at the average daily volumes that are traded into these, it's pretty low. In fact, it is in a couple of tens of crores, not even hundreds, right? Mid hundreds types of crores. So there's not enough depth as well as breadth on the REIT side. InvITs, if you look at the list, there could be around 18, 20 odd InvITs, but at least 8 to 10 of them are non-traded, right? There's no trading activity happening. So most of the trading is concentrated in the top 3. So you need to see also as mutual funds try and gain exposures, they cannot find themselves in a liquidity trap, right? They also need to be very conscious of the liquidity that is available, especially with open-ended funds, having a fiduciary to process redemptions within a certain timeline. So they cannot have a lot of exposure in relatively illiquid counters that REITs and InvITs are right now. And that's also another supply side reason for why exposure is sub 1% as we speak. However,
well, as you can see on the bottom of your screen, Maruti Suzuki has gone ahead and announced a few price cuts to pass on GST benefits. Let's now go across to the management of Maruti Suzuki, who is addressing the media after announcing the price cuts across variants to pass on the GST benefits.
In a major way. So keeping in mind this example, we also feel that it is very important for us also to see to it that we have a huge two-wheeler park of 266 million. And if we talk about the four-wheeler park, it is only 48 million. So Maruti Suzuki, being the market leader, strongly feels that this is the time now we need to come with some offerings to upgrade the two-wheeler customers to four-wheeler. And you all will be aware of it, that the Alto and the Wagoner are the two models actually, which are the very most well-loved cars by the Indian customers. Almost 4.6 million vehicles the Alto has sold till date, and Wagoner has also crossed 3.3 million. In fact, last year, if you have known that Wagoner has consistently been the top selling model for the last 4 years consecutive. So keeping that in mind, and also I would like to say that why this is the time we are proposing it, because there were 3 challenges for the small car. One was the high car prices due to implementation of the emission and the regulatory norms. Second was due to the high prices, the down payment was also increased, which was a challenge for the customer. Affordability was a challenge. And third, the high EMI is also basically a set-off of the high car prices. Now, if you try to see with this GST 2.0 revision, there has been a very positive impact on the car prices. It has come down. This year in the finance bill, our Honorable Finance Minister has given a special rebate for the income up to 11 lakh rupees, which will lead to higher disposable income in the hand of the customers who are targeting to buy small cars. And third, the RBI governor has already announced a repo rate cut of 100 basis point, which is going to reflect into the lower EMI. So what we are saying is these are the 3 key tailwinds for the growth of the Indian automobile industry. So on the eve of this GST 2.0 reform, we being the market leader wanted to start a new chapter by putting India on wheels and providing the joy of mobility, which is the motto of our MD sir, to as many as people as possible. So taking that thing forward, these are going to be the entry-level car prices. I will start with the Espresso. Now the Espresso will start from 3.49900 rupees from 22nd of September. I would like to bring one important point here that other than the GST, we have further reduced the prices so as to make the car more affordable to the two-wheeler customers who want to upgrade to a four-wheeler. So the price reduction is up to 1.29 lakhs, which is almost reduction has happened from the tune of 12.6% to 24% across different variants. Alto K10 starts at now 3.69900, and here also the price reduction is to the tune of 1,07,600, and the reduction is up to the tune of 20% as compared to the pre-GST era. Celerio price starts at 4,69,900. Here the price reduction is 94,000, and here also the price reduction on some variants is up to 17%. I would like to just bring in the kind notice of all our media friends that due to the GST, when we reduce it from 29% to 18%, the net effect of GST is 8.5%. But as I'm sharing with you, we have gone for further special offer to our two-wheeler customers so that they can upgrade to a four-wheeler. And Wagoner price now starts at 4,98,900. Here also, the price reduction is to the tune of 14%. Just one point that this is going to be a limited period offer, and we will be reviewing it by the end of this calendar year. Moving to next. To premium hatches and sedan, this is a very nice opportunity for our entry-level customer to upgrade to the premium hatches and the sedan. Here, the Ignis price starts at 5,35,100. The reduction is to the tune of 71,000. Swift starts at now below 6 lakhs, 5,78,900. Reduction is 84,000. Baleno also starts just below 6 lakhs, 5,98,900. Reduction of 86,000 rupees, and Desire is starting at 6,23,800. The reduction is to the tune of 87,700. Now next, we will come to the van and the MPV category. Eco now starts at 5,18,100. Here the reduction due to GST is 68,000. Ertiga starts at 8,80,000. Reduction is to the tune of 46,400. XL6 starts at 11,52,300. Reduction of 52,000. The reduction in price of Ertiga and XL6 is to the tune of 3.5% because the GST correction is happening from 45% to 40%. This reflects to 3.5%. And Invicto, now the price starts at 24,97,400, a reduction of 61,700 rupees. Finally, coming to the SUV segment, which is the most, I think, the hot segment right now in the auto industry. Bronx now starts at 6,84,900, reduction of 1,12,600. Brezza, 8,25,900. Same reduction like Francs. Grand Vitara, 10,76,500, reduction of 1,07,000. Jimny, 12,31,500, reduction of 51,900. And Victoris, we just announced the price 2 days back, starting from 10,49,900. So we thought it is very important to share with your media friends that this is an initiative which is being taken by Maruti to increase the motorization and to increase the flywheel of the Indian auto industry. So thank you so much, and happy to take any questions. Over to you, Raghavi.
Thank you very much, sir, for sharing in detail. First question is from Sharmishta from Economic Times. Sharmishta-san, you can go ahead and ask your question, please. You will have to unmute yourself.
Yes. Hello. Hi, Partha-san. I wanted to check, like, across, like, you have extended benefits over and above what is coming in from the GST cuts. So what would be the range of benefits you're extending in the hatchback category versus SUVs? And secondly, like, when we are seeing a price cut of 1,12,000 on Francs and 1,29,000 on Espresso. Do you think, like, because of the increasing preference we have seen over the last few years for SUVs, like, there could be a chance that people may prefer an SUV-ish model in the small car sub 4 meter segment rather than the hatch?
So I think there were too many questions, Sarmishta. So I will answer one by one. Raghavi told one question, but you clubbed too many questions into one. Thank you for first of all, the question. I think in Espresso, the reduction which we have done is up to 24%.
Okay.
For the GST, the reduction which we are supposed to pass it on is 8.5%, which I explained. But in order to increase the motorization and to allow the two-wheeler to upgrade to four-wheeler, we have come up with the strategic pricing, and we are giving a special offer of price reduction up to 24%.
Okay.
And second question, that which form factor will be appreciated by the customer? I would again like to repeat, being a market leader, it is very important for us to be in all forms, and we need to provide all technologies. So we leave it to the customer to decide, but our endeavor is to increase the pie of the Indian auto industry.
Okay. Okay, sir. Thank you.
Thank you.
Thank you, Sharmishta. Sir, our next question is from Parikshit. Parikshit-san, may kindly go ahead and ask your question.
Thanks, Raghavi. Partha-san, good to see you. I would like to ask you about whether, Maruti Suzuki has an EV launch coming up. Do you think companies will have to give a more compelling price point and maybe some more benefits, value adds to technologies such as EVs, CNGs, and hybrids to now make them more compelling to the customer? Are you doing that already in the portfolio?
I think, Parikshit-san, today is the day to need to talk about how we are going to increase the motorization. So at an opportune time, I will come back to you again to discuss and share with you what we are going to do on the EV. But fundamentally, being a market leader, we are technologically agnostic. We don't believe that we need to promote only one technology. We give all the offerings to our customers to decide based on his need and his preference, he can select the technology, whether he would like to go for ICE, for strong hybrid, for CNG, or for the EV.
Thank you, sir.
Thank you.
Thank you, sir. Thank you, Parikshit. Sir, our next question is from Ronendra from Hindu Business Line. Ronendra-san, please kindly go ahead. Ronendra-san, you will have to unmute yourself.
Yeah, Partha-san, good afternoon.
Good afternoon, Ronendra.
So I just had a query on this extra discount that you're offering. What kind of burden are you bearing on this, and what will be the margins for the dealers, because they are already unhappy about the compensation cess that has been lying with the government, and they've been trying to reach out to the PM also to resolve that issue. So how are you bearing this cost? And going forward, as you said, this will be till the year end only. So going forward, what is the kind of pricing that you want to keep, provided the cost of input cost going up and steel prices also not going down? So what's your perspective on that? Please guide us on that.
Ronendra bhai, I think first of all, we have passed on the full GST, not only in the new car prices, but on the servicing part also. The parts which we are going to do, there also we are passing it on to our customer. So being a market leader, we are going to talk to our customer not only on selling the new car, but the overall total cost of the ownership. Now coming to our channel partners, we are obviously taking care of channel partners. And I think this is going to majorly increase the sales of the car. We, being a market leader, always believe it is the volume which makes a difference, and also to put the Indian customer on four wheels.
So what will happen to the stocks that has been lying since in August and about the cess and all that input credit? How will you manage that with the dealers?
No, with regard to this strategic pricing, we are going to compensate our channel partners. However, the cess part, other thing, as you rightly mentioned, I think different bodies are taking up this matter with the government of India, and I think some solution will be worked out.
Right. Okay, thanks. I'll come back in queue.
Thank you.
Thank you. I'll request everyone to stick to just one question. We'll take you back next time. So now, sir, our next question is from Mugdha from NDTV. Mugdha-san, over to you, please.
Good afternoon, Parthu-san. Sorry, I joined a little late. So I have one question, which is by when will these prices be? The question is, what demand of growth are you expecting post this GST reduction and the over and above discount that you are giving?
So, Mugdha-san, good afternoon. I couldn't hear you properly when you were asking the first part of your question. So, can you repeat it, please?
Sure, sir. I just wanted to know from when will these prices be applicable?
Okay. So, these prices are applicable from 22nd of September. That is the first day which we are going to implement the GST 2.0 reform. And what was your second question, Mugdha-san?
What sales growth are you expecting after this reduction?
I think, Mugdha-san, it's too early to comment on that because there is going to be a pent-up demand. As I think you all know, in the month of August, most of the customer held back their purchase decision. So they all are going to come to the market in the month of October. So we should not be too much reading into the sales in the next 2 to 3 months. But yes, as I have earlier also said, that in the next financial year, we feel that the market is going to bounce back to the earlier CAGR of 6 to 7%.
Market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Take a look at Hang Seng. It is trading lower by almost 0.3%.
He remains united in pursuing our dual mandate goals.
130 is that level for the as far as the support is concerned.
We said HFCL could potentially come out of the F&O ban. Precisely what happened. So that's one stock you keep on your radar.
We hope all success in our long-term journey with BCCI.
About 0.4% higher on the Nifty. That's the Bell, and 25,436.
There are still more downgrades that have happened in the last 1 month since the GST announcements.
Inflation for the RBI is not the issue right now.
Block deal overhang as well as the Form 483 is something that is weighing down on the stock price today.
Today, we are comfortably above 25,400. In fact, we are building onto those gains as we speak.
Mother-son, every 5 years we come out with an audacious 5-year plan.
The steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month.
Markets are off the day's high, so it's a 40-point uptick that we are seeing on the Nifty currently.
Well, it's a quiet day after big rally coming into today's session. So 14 odd points, 25,346, but nothing to worry because broader markets, lots of shooting stars once again, which is going to be the focus here over the next 60 minutes because index-wise, it's quiet. This is Closing Bell. We're coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Prashant Surabhi and Rima here in the studios, and Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon. The start was a lot better, right? We were up in the green. The Nifty had scaled, almost gotten to levels of 25,450. So from that level, we've come off to trade flat.
But I guess we can't really complain much, Rima, because from the lowest point where this rally actually started, we were around 4,500 thereabouts. So it's been about 750, 800 points almost. So maybe today's one of those slight pause days. So not too bad. I mean, for the time being, Nifty is absolutely even, Stephen. Not moving too much. You have some tech on the upside, which is supporting some of the life insurers that were negative yesterday and this morning. They've decided to turn around. You have the consumer side of the market, which is now looking at some profit-taking stocks like Trent, etc. They are slightly lower. Nigel's also with us. Hi, afternoon, Nigel.
Well, that's right. And since it's a Thursday, it's not the Nifty expiry, but it'll be the Sensex expiry. So that as well swings things around a little bit. So we'll have to keep an eye out on that front. But some green, I think you'll have to take that. With the kind of rally that you've seen, at least you're not seeing any big down day. Breadth of the market as well, pretty okay. So par for the course, I would say.
Absolutely. And, 25,350 is now where we are at. So it's a action-packed next 60 minutes. As I said, focus very much on single stocks and what's happening there. Indices and sectors, IT and pharma counters in focus. PSU banks, autos are seeing some selling pressure. Just reversals. PSUs, for example, have had 2 good days. Poonawalla FinCorp, of course, is that big shooting star, which we will address right on the top of the show. Promoters increased stake. We'll also talk about Cohans, where there has, of course, been that large block which has taken place. Those are the 2 stocks that which we'll address in the first 10 minutes, 15 minutes of the show. And of course, we'll have more coming up as we go along through the course of the show. A detailed analysis of financials coming up as well on the program, and Glenmark there in focus. How should you position yourself in the last hour here? And let's get to Mitesh for some help with that. Mitesh, what do you suggest?
Yeah. So, the market, as you're rightly pointing out, has slightly simpler from the others. But again, nothing negative. So maybe we didn't kind of hit 25,500, we were about 50 points lower. And a mild profit booking has happened. But I think, a bit more of decline, and you would even want to explore some longs. Now, the current level where the supports come in is close to about 25,260. And you're at about 25,350. So another 30-40 points lower, I think that's the time when I would want to go long in the index. On the stock side, I have two buy calls from pharma sector. In the pharma, I think is showing good continuation. So buy here with the stop at about levels of 11 or 4, and the target of around 1160, 1155, 1160 can broadly be looked at. And Dr. Reddy is also showing good signs of upward continuation. So buy here with the stop at 1304 for targets of 1360.
Mitesh, anything on the IT charts? The Nifty IT index is holding up in the green, but it's come off from the highs.
Yeah, we have had buy calls on a couple of IT names, Infosys, TCS, and I think yesterday was L&T Maitri. The one which can possibly give you a fresh hook is HCL Tech. It needs to get past 1505 levels, and today I think the intraday high was on 1503. So that the chart is now showing signs of a bottom being made. A breakout or a reversal will happen about 1505. So that's one on the radar. The other one which I like is Naukri or InfoEdge. It's making some kind of a contraction pattern. Again, the breakout happens roughly about the highs of 1400, and I think yesterday the high was 1401.90. So 1402, if it starts clearing trading below that, beyond that, then I think the stock can possibly head towards 1475, 1480.
Okay. All right, Mitesh. Thanks a lot for that. Well, let's focus on one of the big movers today. That's Poonawalla FinCorp. That's buzzing in trade. Gaurav joins us to tell us about the fundraise that was, earlier already had taken place, but now that conversion is there, and now the company receives the money. Gaurav, please take it away.
Well, it's definitely Poonawalla FinCorp is soaring up in trade, and the reason being that promoter has infused 1,500 crores in the business. So let's understand, on July 25th, when they actually reported their Q1 numbers, they said that they will be infusing 1,500 crores at a cost of 452 rupees per share via preference issue, and they have now executed it, and that is the reason why market has taken it as a positive trigger. If we look at the entire transaction, they have issued around 3.3 crore shares at a price of 452.5 rupees, and with this is going to increase the promoter holding from 62.4% to around 64%. Let's also not forget that this transaction is actually book value accretive, because the book value per share that increases almost by 13.5% after this transaction. When we look at some analysis, analysts also believe that the capital adequacy ratio that will also go up to around 24%. And let's also not forget that the timing is also important here, because in Q1 we saw company reported good set of numbers. They gave a guidance of around 35 to 40% AUM growth, and just before second quarter's results they have infused this money. So definitely all these triggers are helping the stock. Currently, as we speak, it has crossed its all-time high level as well.
Okay, all right. Thanks a lot for that, Gaurav. Well, let's welcome Deven Choksi, who joins us on the show. Hi, Deven. Good afternoon. Good to see you in. What's your view? Poonawalla, spiking up on large volumes, and it's a bit of a booster shot that's come in. Tell us more.
And Nigel, good afternoon. Well, in my understanding, I think this is largely helping the company in building the better capital adequacy ratio from close to around 21 to 24. So that is where probably I think the level of confidence one is getting that the company would be expanding faster. If you look at the last quarter result, I think they have probably expanded the AUM faster, and that's probably the reason for which infusion of capital, so that they can leverage their balance sheet further, and in turn, I think size of them can be grown better and bigger. As this point of time, I think the valuation is already at a level at which I think it's sounding expensive compared to the other peers in the industry. They're at around 4.2x kind of a valuation price to book. So from that perspective, if you look at it, I think the upside is largely driven by the news, and maybe I think the balance sheet is fairly priced, or the stock is fairly priced based on the balance sheet valuation at this point of time.
Sorry, Devin, where is it trading at in terms of valuation?
4.25x price to book.
Okay. So in the current context, not exactly cheap, right? There used to be a time when 4-5 times book was pretty, not normal, but acceptable. Not anymore. I mean, if you look at others.
Yeah, true. I think, today, I think last quarterly growth, I think the exceptional growth. Maybe I think if you are comparing on a year-over-year basis, the previous year they had a dent in the performance, and that's where probably I think the results and numbers are much smarter. They definitely indicated for 35 to 40% kind of a growth. Vis-a-vis that, I think they ended up achieving more than 50% kind of AUM growth in the last quarter. And should that sustain, which is likely to be a possibility given the kind of fundraise that they have done, or given the kind of capital infusion that they have done, I think, in the company. So from a perspective of looking at, I think, some possibilities, I think that is where probably market is excited. But as I see it, I think the valuation-wise, the book is fairly priced currently. Maybe the news flow is adding more to the tailwind at this point of time.
Devin, afternoon, Indian hotels. There were some reports which suggest that Taj is looking to sell their NYC property, the Pier, for about $2 billion. They haven't responded to the CNBC TV18 query, but is this a material development for IHCL, and generally, what's the view on Indian hotels?
So as such, Rima, good afternoon. As such, I think the asset-light model which they want to pursue, and I think any capital unlocking exercise, I think, would be more than welcome for this company. Largely with the fact that I think the asset-light model particularly, I think, is working well as far as I think their all operating parameters and the ratios are concerned. In my viewpoint, I think the company remains absolutely convincing from the point of view of in next 3 to 5 years. The room keys that they want to add, I think, is significant. And that is where probably asset-light model would make a lot of sense. If they monetize this money, I think by way of selling this hotel, maybe I think one will have to see how exactly they get deployed in some other properties and growth of the business. But yes, I would accept it. Yeah, I think the money received would be, I think, far more significant because the size of the money is somewhere around $2 billion.
Okay, that's Indian hotels in focus today, on the back of a possible divestment of that New York property. Devin, hi, good afternoon, good to have you in. Interesting moves on a couple of consumer stocks today as well. Not the obvious FMCG names, but I'm noticing some of the other movers. Let's pull them up. There's Bajaj Consumer. That stock's up about 9% as we are speaking from the house of Bajaj. Decent move over there. There's Heritage Foods, the dairy company, which is up about 7%. And then there is Restaurants Brand Asia, QSR being that segment, 6% up on Restaurant Brand Asia as well. So plenty of new names on the consumer basket coming through. Just very quickly, Devin, any interest in any of these names? Any thoughts?
See, the GST impact, I think, is definitely going to be felt by this company. And that's why market is justifiably excited. I'm not too sure immediately, I think, whether the companies which we are talking about would immediately show some kind of a distinctly different results. Maybe I think the test will come in October to December quarter, wherein including the pent-up demand for the business that they have lost in this particular month of September and thereafter. I guess I think it's October to December quarter with the festive demand coming in. We'll have to wait and see how exactly these companies perform. As of now, they're fairly optimistic. Many of the FMCG companies are talking about valuating this entire business by not changing the price, but by increasing the volume in the pack that they are talking about. So certainly, I think the business conditions suggest better improvement for them. Let's see, but I'm relatively more confident than before that I think consumer companies are showing better performance in the second half of the financial year.
Devin, stay on. Cohance Life Sciences is in focus. The company saw about 8.9% of the equity exchange today in the morning. In fact, the block deal got upsized. Such was the demand. But separately, the stock is also being weighed down because the US FDA has issued some observations for the company. Ekta joins in with the Twin News. Ekta.
Well, yes, there is that large block which happened, and there was an upsize which took place with regards to Cohance. Separately, one of their facilities has received 6 observations from the US FDA, and hence that particular the stock is in focus on account of that as well. Though we don't know how what the reply of those observations would be, and the way forward with regards to that particular facility. But separately, just a little bit about the company. Remember that it was formerly known as Suven Pharma. Advent bought the company, bought 50% stake in September 2023 for around 6,300 odd crores. It was rebranded as Cohance in May of 2025, and then there was an amalgamation of multiple companies which resulted in the entity formed. Now, a couple of drivers include the fact that it is present in the ADC market, and the ADC market, which is basically a type of cancer therapy, is expected to grow to around $4 billion by 2029 from the current $1.4 billion. And it is the China +1 as well as the European +1 market, which is expected to be key drivers, along with the Biosecure Act, which actually might come into play. So a lot going in terms of Cohance, in terms of the long-term drivers, but obviously the 6 observations would be something that the street would be watching out for, and a near-term overhang.
Okay, all right. Cohance on the radar as well today. Ekta, thanks very much for explaining that to us. That's Cohance. Since we're talking about the healthcare space, Devin, I don't know if you've had a look at this company. Do share your thoughts, if any. Otherwise, anything else interesting from the pharma space for you?
Honestly, Sulbi, I think most of the companies, including in the CDMO space, including in the API space, are adequately priced. These 2 areas, I think we continue to like. I think generic space in particular, the companies which are specialty generic companies, some of the larger ones like Ciplas and Pharma, etc., they remain relatively, I think, more sure compared to the other peers, I think, who are comparatively weaker on the prospects. So, but at this point of time, from the valuation perspective, I think most of things are being priced. Unless you see some kind of a corporate action happening in those companies, you may see some kind of a different price regime. But otherwise, I believe that I think most of the pharma companies are well priced at this point of time.
All right, Devin, I wanted to ask you about Tega. You know, they're raising closer around 2,000 crores odd. If I got the number right, the promoter entity is putting closer around 150 crores. And I think this is one of the single largest preference issues, you know, to investors. It's not warrants, it's a preference issue. So I think, you know, in recent memory, I think this is one of the largest. It could be potentially one of the largest in history as well. They're looking at something very, very big. But the problem is, in the near term, there's going to be a lot of debt in the books, which always makes the street very nervous. What's your view on this name? They were waiting by for the equity fundraise. Now we have the names as well, some notable names in there. But your view?
Nigel, I think haven't looked at this company and definitely not the plan that they have at this point of time. So would refrain from putting any answer. Maybe some other day I can come back.
Devin, you know, auto companies have been very quick to announce price cuts, courtesy GST. But stocks have already been running up since 15th of August. M&M has done very well, and so have the other two-wheelers. Is there still an opportunity? And if yes, which one?
Yeah, I think you mentioned two-wheelers, and I believe that I think Bajaj Auto in particular, I think may be interestingly positioned. The company, yes, of course, I think the price has moved up, but I think some correction in the price definitely could possibly lead to the better prospects, both in electric vehicle portfolio, three-wheeler electric included, along with, I think, the newer vehicle launch that they have done. Probably, I think this company deserves to be looked at afresh from the growth perspective, including from the export market, where they today have now 50% revenue contribution coming in, along with the NBFC activity that they're carrying out in this company. So overall, I think this company in two-wheeler space remain interesting. Tata Motors, I think, trying to correct, I think, whatever the electric vehicle related challenges that they're facing, they're trying to correct that situation. And the last month numbers have been quite inspiring. So maybe, I think, once this demerger of commercial vehicle and passenger vehicle business is completed, I believe that I think Tata Motors should be looked afresh, I think, from investment perspective.
Okay, all right. Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure, as always, having you here on the program. You know, what we're going to do is take a quick commercial break here. Just leaving you with some sound bites of Conrad Saldana from New Berger Bourbon. They manage a large sum of money here in India. When we spoke with him, first on the Fed, of course, etc., he thinks that the dollar weakness backdrop is pretty good for EM flows, and they remain invested in what they like, which is largely manufacturing as a theme. Listen and take that break. We're right back.
25 basis point cut. If you ask most economists in the US, this should be in a string of cuts coming through. I feel that Chairman Powell, while he's opened the door, hasn't given a super dovish view or max dovish view on this. Given that the dollar has started to weaken, it does give a positive backdrop to emerging markets and a lot more policy relief from an external source to countries such as India. I think you still got some pain over the next couple of months, you know, potentially this quarter, and maybe into the end of the year with the Diwali season that starts to bottom out and starts to turn again. I think that is probably more structural for me versus trying to pick, do people rush out and try to consume? It comes down to job creation and, importantly, wages. I don't see that structurally turning. It does help in terms of the stimulus, but we'll have to wait and see. I would think into the festival season, that's going to be much more a bigger driver than seeing that people rush out on GST and any of these cuts and start to spend. That's my view from afar. It's just practical looking through markets, different markets and cycles. But it comes down to, can you see that in the revenues? And importantly, can you see that in earnings? Because the market is not cheap as much as it might have underperformed. You're not looking cheap particularly, and I think you need to see that earnings growth come through.
Welcome back. It's time now to put the spotlight on individual stocks. Harmis is now joining in. Harmis.
Well, the markets may have cooled off, but some stocks in the broader markets have definitely not. IRM Energy is one of them, and the stock was up 20% yesterday, building onto those gains now, 14% higher today as well, almost now 40% in the last two trading sessions. And today's volumes are already the highest on record. Now, almost well over 2 crore shares have changed hands in today's session. The 20-day average here is only 1.5 lakh
half. So volumes on IRM Energy, and today's turnover for IRM Energy is well over 650 crore rupees. That is 42% of its overall market cap, and already higher than its free float market cap. The stock, despite this outperformance over the last two sessions, is well below its IPO price, which is 505 rupees. Shalimar Paints has sprung up in the list of gainers today, the biggest single day gain since December of 23, and today's volumes are already the highest since January of 24. We have already had over 33 lakh shares that have been traded on Shalimar Paints. The 20-day average is only 85,000 shares. Now, it broke above its 50 DMA earlier in the day, and the next level on the upside is the 100 DMA, which is at 90 rupees. Now, despite this, the stock is still down 32% this year, was down last year as well, so it's lost significant value over the last 2 years. Pipe stocks continue to make headlines. We spoke about high-tech pipes earlier in the week on Bazaar. Now continues to build onto those gains. Another 10% today. Now it's up well over 30% in the last 7 trading sessions. And today's volumes are already the highest on record for high-tech pipes. Over 3 crore shares have changed hands today. 20-day average is only 18 lakh shares. And it has broken and sustained above its 200-day moving average of 111. So now above all of its key moving averages. And since its migration to the main board in 2018, the stock is up over 4x in value. And a stock that saw a bit of a spike in the second half of the session is TVS Electronics. Now 20% higher on the stock, the biggest since September of 2019. And it was around about 1 p.m. when the volume started to move on the higher side as well. And today's volumes are already at the highest since June, where over 10.5 lakh shares have changed hands. The 20-day average is only 25,000. So it shows the kind of volumes that you have had. And so far this year, the stock has been up 15% and positive returns every year since 2020 for TVS Electronics.
All right, Hormoz, thank you very much for that. So it's an interesting collection of names which Hormoz highlights every day. Jigar Mistry is with us, co-founder at Buoyant Capital. Jigar, good to have you with us here. Thanks very much for your time. I just want to start with whether you think new highs are coming. And by Diwali, by the way, there's a time limit to it. Or do you think there is and maybe even bigger gains? Nothing is changed per se, except, I mean, the markets, of course, at the end of the day, about perceptions and self-fulfilling prophecies, and sometimes about outright valuation gaps, which I don't think is the case now. But maybe the former too. What's your sense?
Hi, Prashant. Normally, there is a gentler warming into the show. This time I'm just bringing it on. But yeah, very difficult to say. See, what has changed at the margin? I think two things. One, Fed essentially coming on and cutting. You have seen the rupee move very differently vis-a-vis the dollar index. Right? In the past 20-odd years, you have not really seen dollar depreciate as much as 10-11%. And rupee depreciating against the dollar. So that's quite against the run of the play, so to speak. That happened because sort of India-specific RBI, NDF shorts that got built out. And rupee has depreciated almost from 83 to 89 levels now. And that seems to have done. So if you continue believing that dollar will depreciate over the few months to come, then the incremental emerging market flows, which has gone to China, Taiwan, and South Korea, can possibly come to India as well. You add that to the fact that your domestic flows continue to remain very strong, but despite that, we are only a little over 5% of household savings coming into equities. Now, most developed markets are upwards of 20%. US is, in fact, upwards of 40%. So if that is the trajectory we are going to follow, then possibly each Diwali we can talk about newer highs coming through.
All right. Hi, Jigar. Good to have you on the show. Jigar, cash is still at around 13.5%. You're not as convinced as my co-anchor Prashant with his interactions with all the top fund managers that the new highs are around the corner. Will you be looking to deploy that money?
Yes, Nigel. So for us, the cash is also a proportion of sort of the flows that come in. It's a bit technical, but we don't run a model portfolio. And therefore, you will have sort of median accounts at a certain cash level and the fund account at a certain other cash level. And when flows are slightly high, then those two numbers can be a little different. So cash as an asset class is something that we don't believe in, but that essentially runs down to 5-6% on a normal basis. But see, it is an interesting space because earnings per se, on the first quarter numbers, we are tracking like 6-7% growth. Now, this is a time when the base was a lot better, right? April, May, June last year were peak election season. And if on that base we are growing at 7%, arguably in the festival season, the base normalizes. And this quarter will have at least a month lost or month pushed back because of GST announcement versus implementation. So we'll have to wait till January results to see how corporate India is reacting to the pivotal shifts of the government. Right, 4.5 to 5 lakh crores, that's almost 1.3% of GDP being pushed into the hands of people should have a meaningful impact. But countries that have tried doing that before have seen some amount of lag between sort of announcement and implementation. And everyone is keen to see how that plays out in corporate India. So unless flows change, and I would argue, in fact, the other way around, that had the flows not been these strong, you would have seen markets arguably at a slightly lower level than what they are right now. So yes, waiting for chances to deploy and bring it to a slightly normalized level, but it's not as high as the headline numbers do suggest, Nigel.
All right, what about FMCG? You're at around 4.5%. That's been a relative underperformer in comparison to an underperforming market as well. Growth has not been coming about, but now everyone's talking about this big consumption boost. You have the tax rate cuts, more money in the hands of the consumer. You have, RBI rate cuts as well, and now GST 2.0. Will you be looking at upping the ante out there?
So almost entirely all of this was built over the past 3 months, Nigel, for us, because since budget, when we sort of came through, we argued that there is a pivotal shift that's happening away from capex, both at the state center level and into consumption. So we're building that out as sort of things picked up, right? So GST 1.5 to 2 lakh crore is sort of the final cadence to the entire sort of song. The song started with, states actually announcing very large freebies. And at one point, if you took all the announcements, and we did for the 16 states that went into elections, the announced freebie bill was higher than the capex bill. What they've provided for, thankfully, is only half of what they have announced, but that has still meant that the state capex has grown at a negative 4% level. Center initially, forego about 1 lakh crores in taxes, and now 1.5 to 2 lakh crores in GST. So all of this, when handed to consumer, and there are different housing, right? Like what the states have foregone versus what the center will give out are two different income housing categories. And to that end, it will impact things differently. Our base case still is that it impacts discretionary consumption a lot more than staples. I don't think people will go out and buy more oil or soaps, but consumption can play out. Like the last time I was on the show, we did discuss cement as being one of those. Secondly, automobiles can be interesting. The third part is sort of, a lot of these exhibition houses can be interesting. So we need to sort of see how this plays out. And therefore, we were keen to get a clearer picture from the quarterly numbers rather than high frequency data, because high frequency data tends to be a little more anecdotal, doesn't give you a really good picture about where the transition is at what stage.
What about autos? You said it looks interesting. The GST rate rationalization is a big tailwind, yet you're underweight. Your exposure is just 1.2%. The expectation is that it's going to be a good festive season. Companies have passed on the benefit with rate cuts. So what makes you cautious?
No, Rima. So this weight was close to 0% until a few months ago, right? So the way we run this fund is not really benchmark hugged in any way, shape or form. So if things look interesting to us at the margin, then that's where weights go to. Historically, we did mention that the way we have played this has been auto ancillaries, because most of those businesses were fairly expensive. And what GST cuts do is end up sort of, incentivizing production and incentivizing sales rather than, growing margins in a material fashion. So at the margin, I think things are looking reasonably decent. There are still pockets, I would say, of embedded value, right? Because the PE and VC firms have still sort of sprayed and prayed for the EV ecosystem to play out. I don't think there is a huge play in any of those companies where the embedded value is a large part of your total market valuation. But at the margin, I think some things are getting a little more interesting.
Jigar, hi, good afternoon. Good listening into you so far. I'm just wondering if you're willing to buy platform companies, including the new listing at 100 PE. What thoughts on consumer tech, internet, whatever you call it, this class of companies?
Right, Surbhi. So they say, right, PE is a state of mind. So,
is it?
It can be. So no, frankly, it's not something that. One thing sort of it does matter is that whenever you are discounting a lot of these businesses, the terminal value matters a lot. So it's not as much as the business that is changing today, as much as it's the belief that the terminal sort of US rates might still end up looking way lower. And given that India is now, 100 basis, so prior to the cuts yesterday, the policy differential was only 100 basis points. So repo and the Fed fund targeted at the upper bound. That I think gives room to RBI to cut as well. And when you discount this high duration cash flow streams, right, even by a very small margin, then the valuation looks way higher. So I think today most of these businesses are sort of responding to how the interest rate movement is rather than really a business change per se.
Jigar, very, very quickly, I know you have a theory on why the dollar has fallen. But why is the rupee fallen against the dollar and how that connects to foreign flows? If you can run us through that.
Hey, Prashant. So see, sort of what happens is that between 22 and 25, you had rupee relatively stable. And you had a situation where, the RBI may have thought that the FI flows, which started in September, could be contained at a narrower gap. So the shorts in the NDFs, the non-deliverable futures market, increased to between $80 and $100 billion. And they had to sterilize all of that through domestic liquidity crunch. So the LAF window went almost a 3 lakh crore negative number. And I think that sort of has been caught out in a meaningful manner. Then US sort of situation came in and FI, FDI continued to remain very bad. So net, I think the 1.5% depreciation we saw played out over the course of the past few months for 3 years compounded. And I think rupee may have sort of hit its high or depreciated the most it would in the next sort of few months. So things should start looking better from here. And, we have put out a fact sheet which said that every time dollar has appreciated, developed markets do well. And when it depreciates, emerging markets do well for the past 35 years. That has happened, except it hadn't come to India, which I think could change over the next few months.
Okay. All right. So worse of the rupee depreciation in that sense behind and lesser depreciation from here on. Jigar, thank you very much. Good conversation as always. And look forward to speaking with you on our next interaction. 90 points, by the way. Actually, as Jigar was talking and we were putting up a lot of intraday charts, they all look like this, the Nifty on your screen now. Nifty is basically picked up sharply in the last 20 minutes, basically, since from the point that we started. And maybe, after a break, we'll run through a bunch of these names, but they all have gone vertical, some a little bit, some a little bit more, but it's showing up on the index as well, 25,421. Take a break. AI is the flavor of the season, and Tech Mahindra's CEO and MD Mohit Joshi has backed the technology for its various sector-agnostic use cases. Listen into Mohit, the rare voice, but we had him on CNBC. Step into that break. See you on the other side.
I think obviously it is a very transformational technology, right? And I feel it has really the potential to deliver very significant benefits for all enterprises. The way we think about AI is that it is slowly moving from the lab. So you hear a lot of people talking about proof of concepts, but now large companies have actually figured out that if they really want to implement them in their core systems, it requires a lot of work to build out your data estate, to simplify your application estate. So it is going to be a journey. But at the end of the day, from the journey, you will get benefits in terms of productivity. So you have higher productivity. People talk about the contact center, but you also have developer productivity, back office productivity. So if you think of it in terms of an insurance company, this probably means that you can sell the policy and service the policy a lot cheaper. Then you've got the ability to deliver transformation, right? So if you're able to understand your customer landscape, for instance, you're able to sell more products to the same customer, right?
Welcome back. So quite a day on the street today. Let's figure out what's been happening in the F&O market. Nigel's, looking at the details over there. Nigel, what's going on?
Well, the markets was a little bit jittery. The one that got a lot of shots into the system was on the Nifty bank. And just take a look at that. As the markets have gained momentum, those shots are getting squeezed out there. So the Nifty bank is trading higher in today's trading session, but the open interest is sharply lower. I think close to 6% shedding is what we've seen in terms of open interest, clearly indicating there's a bit of a bounce taking place out there. Now, the Nifty bank has been trending up. Now it's in that congestion zone. From the high, it's come off a little bit. This 50 and the 100 DMA, if you just pull up the chart, you'll see they're out there. We're facing some kind of resistance. So a couple of 100 points, if the Nifty bank can move up from here, then we could possibly see a bigger short covering bounce. That's the range that you're looking at. In terms of the options data, there's a lot of activity both at the 25,400 call and the 25,400 put. Now, on the call side, there is a mix of activity that's taking place out there because the premiums ballpark close to around 100 rupees or thereabouts. So there is some writing as well that we're seeing at that level, which tells you that the 25,500 level is going to be an extremely important resistance mark. However, on the downside, there's clearly writing being seen at around the 25,400 put, and the premium is getting eaten too, which tells you that at around lower levels, 25,250, 25,300, that's where the nearest possible support is at, looking at the options data. Moving to the Reliance industry stock, well, that's more or less flattish today. That as well as getting into that vicinity with that 50 and the 100 DMA, which is close to around 1.5 to 2% away from current levels. It's seeing some kind of resistance out there. So you'll want Reliance Industries, which is almost an index by itself in the Nifty, a large constituent out there. You'll want it to get past that mark. Moving to stocks then. You have Eternal. That's coming for a bit of a short covering bounce. The stock is currently at the high point of the day, and open interest is a little bit lower. However, there is some fresh buying seen on a couple of new entities, which we normally don't talk about. So on the stock future space, whether you look at KFin or Mankind Pharma, both of them are higher with a good amount of open interest built up. So we'll keep an eye out on both those two stocks. Now, two stocks by the end of today, you'll have to keep a very close eye on, and both of them are in the F&O band. One is RBL Bank. That stock, it appears, it's at around 80.5% approximately. That's open interest as a percentage of MWPL. And the other one is Oracle. That as well is in that vicinity of around 80 to around 81% or thereabouts. It needs to close below that in terms of open interest as a percentage of MWPL. So I'll keep an eye out on both these two stocks. It's, on the border. Either they come out of the F&O band today or potentially tomorrow as well could be the day. But both those two stocks, that's the file you're looking at towards the end of today. Back to you.
Okay. All right. And we'll get an update tomorrow as Nigel usually does. Thanks very much for that, Nigel. Mitesh is with us with what to buy or sell today for a reverse trade when we come back tomorrow. Mitesh, what do you have?
I have one more pharma name. I think dollar slab was Midday, right? So that's looking a good BTST kind of thing. Making a fresh eye as well. So we will start at about 9.5, look for 9.35 kind of a target. So, and the other one is Glenmark, which after pullback also is again moved up strongly. So BTST there. We can stop at 2094 for targets of 2130.
Okay, all right, got that. Mitesh, thanks very much for the update. We'll see you again with the market tomorrow. You have a good rest of the afternoon. Let's move on. We've got some more pharma stocks in focus today. Ekta is back with us to tell us about Glenmark Pharma. A couple of updates coming in over there. Ekta?
Well, yes, Glenmark is in focus because the biotech company Astria Therapeutics has announced a positive initial result from the Phase 1A healthy subject trial of a molecule under development, STAR-0310. Now, the results were announced at the European Academy of Dermatology and Venerology. Now, why exactly is Glenmark in focus? Because Glenmark's arm, Ignis Sciences, had entered into a licensing agreement with Astria in October of 2023, and the agreement was to develop a portfolio of monoclonal antibodies which are targeting a certain segment, OX40, for inflammatory and immune diseases. So basically, this particular molecule was out-licensed by Glenmark's arm to Astria Therapeutics, and now they've announced positive Phase 1A results from this particular molecule. Now, Ignis, remember, had received upfront payments of $320 million based on potential milestone payments plus low-digit royalties. Now, Astria had gained worldwide rights to the drug, and this means that if in case they are successful in terms of the further phases going forward, then Glenmark could potentially gain if in case this particular molecule does meet the certain milestones that they've come in contract with, or in terms of any kind of double-digit royalty opportunity. So positive news for Glenmark based on this particular molecule that they had out-licensed in 2023.
Okay, all right, Ekta, thanks for explaining that to us. Glenmark up 3% this afternoon in news today. Let's quickly move on now. The Reserve Bank of India has tightened payment aggregator and payment gateway guidelines. What does this mean for some of the listed entities? Let's find out. Gaurav is here. Gaurav, explain what this means to us.
Well, first let's understand what RBI has said. The guideline says that the payment aggregators shall aggregate funds only to merchants with whom it has contractual relationships. So let's understand with an example. Earlier, via payment aggregators, you could pay bills, electricity bills, mobile bills, and at the same time, you could also pay rent. Now, what's the catch here is that the rent was also paid using credit card, and now with these new regulations, rent cannot be paid using payment aggregators, specifically via credit cards. In fact, RBI says that they have to be onboarded as a seller or merchant. It is not just about KYC, but it's also about the category that they are falling in. Is it something new? Well, these restrictions were imposed 2 years ago, but there were some grey areas because of which the payment aggregators were still able to offer services to pay rent via credit cards. But now with these new regulations which are very clear, all these activities has to stop. In fact, we have seen payment aggregators like Cred, they have completely stopped such activities. Other than that, let's also take an example as how it is going to impact the listed players like SBI Cards. For SBI Cards, if we go back 2 years back in time, they said that from the retail spends that they have seen, almost mid-teens was the contribution of the rent payment as the spend for their card. In fact, they also used to charge around 200 rupees for each rent which was paid via SBI cards. And now with this move, this will stop completely. bank, the SBI Cards company earlier said that the growth has been moderated a lot, but at the same time, the analysts believe that EPS is going to get impacted going ahead because this has now stopped completely. It could be somewhere in the range of 2 to 3%. It is difficult to quantify right now, but definitely that is something as an impact what we can see on the companies. As of now, we do not have any number. We will be definitely watching out on how companies going to address this issue, but we can actually see some kind of negative impact on the companies like SBI Card because of this move.
Thank you very much for that. We'll wait by to see what the company has to say about the potential impact. For now, it's time for a break. As we do that, let's listen in to opinion coming in from Goldman Sachs Global Emerging Market Equity Strategist Sunil Kaul and his view on the Indian markets, the impact from the GST rate rationalization and the sectoral picks.
I think obviously the second quarter reporting season was generally pretty decent. The bar was low, but I think we got the underlying earnings growth of around 12%. Our full year number for calendar 2025 is about 11% earnings growth, and we think we are kind of on track to meet those. We have started to see in the last couple of weeks sort of earnings upgrades in the consumption space, notably in staples, in discretionary. And so I think the sentiment is starting to improve. When you look at the broader market, there are still more downgrades that have happened in the last 1 month since the GST announcements. Then we have seen upgrades, which means the net sentiment is still sort of in the red zone. Our sense is that in general, it could improve India's earnings by 1 percentage point. It sort of looks a bit low, but it's because it's concentrated in consumption, and large parts of the other markets do not really benefit from GST. But net, that should be accretive for underlying earnings. We haven't raised the numbers a lot because some of that gets shaved in because of lower growth on the infrastructure side and the continued uncertainty around tariffs. So net, we still think overall there is a net positive earnings impact from the GST overall for the market. As I mentioned before, even after the personal income tax cuts that we saw through, we already had positioned in terms of liking the consumption sectors over investment sectors. And so we are overweight staples that should benefit from the GST cuts. We are overweight autos. We do pick up some of the QSR and the tourism and the internet names through the overweight in the internet or the TMT sector in general. We also are overweight financials. So I think financials and consumer sectors are where we have our sort of most positive views on. On the other side of the ledger, we are underweight infrastructure, excluding defense, which is a structural theme, but the rest of the infrastructure pack, we are underweight pharma. And so we have a clear preference of consumption over investments there. We are neutral IT, realizing that it has come off a little bit, but we think it may be a little bit too early to position there.
Welcome back. Well, markets are doing quite well, currently moving back to the high point of the day, and it's turned, from a sell on rise market to a buy on dips market. You need to build positions as the market sees some kind of profit taking on an intraday basis, and then we are seeing that the markets do recover. So that's the way things have turned. Sid Khemka, Head of Research, Wealth Management, Motilal Oswal, joins us on the show. Hi, Sid. Good afternoon. Good to see you. Let's talk about Biocon. That's a stock that's in focus today. They have gone ahead. They have secured the US FDA approval for its biosimilars, Prolia, as well as denosumab. What's your view on the stock? We'll be speaking to the management tomorrow, but your view?
Hi, good afternoon, Nigel. Glad to be on the show. I think within the pharma space, the biosimilars, that has been consistently doing well. And specifically, if you look at Biocon, consistently now they have been getting the regulatory approval first for the Malaysian plant, then for the Bangalore plant, and then back-to-back US FDA approvals for some or the other products. So what we are seeing is that they are definitely scaling up their capabilities in terms of approvals, the plant capacities, and they are targeting to the 50-60 ton demand surge. So in-house manufacturing aims to de-risk the supply risk and positions Biocon as a key supplier, especially in the GLP-1 APIs. And with significantly lower manufacturing costs than compared to some of the innovators, we believe Biocon is now pursuing both the CDMO as well as the front-end models for the semaglutide formulations. The injectable forms, that is something that has been picking up well. The product pipeline for biologics remains promising. Plus, it's within its subsidiary, the Syngene subsidiary, that is expanding in the CDMO capabilities to meet the rising demand. So overall, we see a strong revenue growth, margin improvement, and that driving a very high growth in the net profitability over the next 2 years. So we remain very positive on Biocon. We have a buy rating and a target price of 410.
What could be providing this boost to the Indian markets in late trade is that statement. Some growing optimism about a potential resolution to the ongoing US-India trade tensions. V. Anantha Nageshwaran, the Chief Economic Advisor, has spoken at the Bharat Chamber of Commerce in Kolkata. And what he says is that perhaps we could see a resolution at least of that punitive 25%, the extra penal tariff of 25%. He says, I don't have any inside information, but my personal confidence is that in the next couple of months, if not earlier, we will see a resolution at least of the extra penal tariff of 25%. So that perhaps is the heart of what, the up move that we've seen in the markets in the last, 30 minutes or so, because the Nifty has suddenly spiked up close to about 100 odd points. He says, my hunch is that in the next 8 to 10 weeks, we will see a solution to the penal tariff imposed by the US on the Indian goods. So that, it's just a statement to be taken on board. Again, giving credence to growing optimism that we will see some relief to the tensions between US and India. Siddharth, there is also a lot of optimism surrounding IT. One, the dollar index, has slipped. I mean, I know the rupee is also underperformed. It's depreciated, but generally the dollar index is down 10% on a year-to-date basis. We've, the potential rate, we've already seen one rate cut. The Fed is guiding for 2 more in the next 12 months. Is there any stock which is a buy for you in the IT pack?
Yeah, Rima, I think that's definitely a welcome step, not only the rate cut, but the positive commentary from US Fed. I think 2 more rate cuts in this year. I think that is something that the street is very excited. A rate cut in US straight away gives a lot of room of or clarity for at least increasing spending for the IT discretionary companies, which have been reeling under the uncertainty with regards to the growth in the developed markets on the backdrop of the tariff war. So definitely, I think this gives us positive sentiment. Nonetheless, the Q2 numbers are ahead of us, and that could be a kind of a dampener, at least in the near term. But I think that will only give us an opportunity for the investors to get into a sector which has consistently done well. We have seen very strong cash flows, dividend payouts, and now the Infosys buyback. That is only trying to indicate that the management believes that the downside from here is limited. Hence, we believe that this could be a good play to see the recovery in the global sentiments, especially in the US markets after the series of Fed rate cuts. What we like, we definitely are in favor of the mid caps where we see stronger earnings growth, niche presence, and a lot of efforts that is going into the other new age AI-led transformational services. So what we like, Coforge is something that we like, is one of our preferred picks, consistent earnings growth. For this year, we are seeing a strong earnings growth of about almost 60-70%. Next year, a 25% earnings growth. Valuations, although a little bit on the higher side, but we still believe that the stock could see a good, decent upside. We have a target price of 2,200 on Coforge. That's the top pick from the IT space.
Okay. Siddharth, thanks very much for all the advice today. Well, we just have 2 minutes to go before the day closes out. And actually, it's turned out to be yet another good day. You know, Rima was complaining when we started the show that it's very quiet, not too much is moving. The Nifty said, hey, Rima, don't worry. I'll give you another 100 points today.
And back to where we started.
And yeah, at least back to where we started. So it's not a bad session at all. Nifty is again incrementally put on almost 100 odd points, inching its way towards the 25,500 mark. Let's talk about the gainers. The platform companies are definitely in focus. Eternal actually going home as the Nifty winner, 3% higher on Eternal. Let's just pull up Urban Company and Swiggy as well to see what the others have done. Swiggy has been up about 1%. Urban Company also has notched up another 2% sort of again. So platform companies definitely in favor. The life insurers, HDFC Life and even SBI Life, they've started seeing some traction now. Sun Pharma, after Citi's positive commentary, gaining 2% today. Some of the IT names recovered, helping the overall market. So Infosys, for instance, going home with a gain of about 1.3%. There are other big boys as well. HDFC Bank, ITC, HUL. So plenty of different legs to this move today. Aisha Motors from the Auto Pack also looking pretty good. On the flip side, Coal India, Bajaj Finance, Trent, Tata Motors. These were some of your losing stocks on the Nifty. So that's the large cap tally. Mid caps also had a great session, actually just under 0.5% up on the mid cap index. And today's fast movers include names like Poonawalla FinCorp, 13% up on Poonawalla. Tata Investments, 6% higher. Names like Subros. And then some of the consumer companies, like I was pointing out earlier, Restaurant Brands Asia, Bajaj Consumer, gains between 7-8% on many of these names. So overall, plenty of traction and excitement in the mid-cap market as well. Well, the bell has gone, the day has come to a close, and the Nifty has made its way towards the 25,421 mark. On that note, we take your leave on this edition of Closing Bell, but do stay tuned. All the market action continues. Up next is Markets Forward.
Nifty and Sensex gain 0.25% each to rise to its highest level since early July. Nifty holds 25,400. IT and Pharma gain the most. Broader markets rise in line with the blue chips.
Cohance Life Sciences falls after promoter Advent Private Equity upsizes its stake sale to 8.9% from 5.1% earlier. Vari Energy also falls after it's set to offload 61 lakh shares of Indosolar via an offer for sale.
Finance Minister Nirmala Sitharaman says the government has delivered on the ease of doing business and that PM Modi has never ignored wishes of the industry. Given this, she expects industry will now not have any hesitation to invest.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. We'll also recap today's trading action. I'm Reema. With me is Ekta. Hi Ekta. It started off well and things got very quiet around, midday and towards the end of the trading session. But then we had that spike and we closed up well.
Hi, Reema. Yes, absolutely. It was a good day in terms of trade. The steady gains and the slow and steady pace of the markets continue on the upside. The mid-caps picked up pace because that was consolidating mostly for the most part of the day. But there seemed to have been a pickup towards the close of trade. And as you can see, it ended at the high point of the day for the mid-caps. The small-cap index, however, did not see as much buying. So that ended flat in today's trading session, or just about higher by around 0.3%. What stood out was the Nifty Bank, which has now gained around 1.7% on a week-to-date basis. So the Nifty Bank seems to be outperforming at this point in time. Let's see whether that sustains. But overall, a good day for the markets.
Indeed, and it's always helpful when the twin engines of IT and banks both fire for the market. And lots of individual, movers, both on the way up and both on the way down. We'll discuss them. Let's quickly tell you what we've lined up for you on our show. We start with the top movers and shakers with Hormuz. Cohance Life Sciences under pressure after promoter, private equity player Advent sold about 8.9% stake. Meanwhile, Biocon Glenmark gained on the back of regulatory approvals. And then finally, we'll get you all the key market events to watch out for in tomorrow's trading session. But first up, it's over to Hormuz now to apprise us of all the big movers of the day.
Well, indeed, some interesting moves seen, particularly in the pharma names towards the close of the trading session, both on the upside and the downside. But start off with the gainers, of course, with Biocon after the drug approval, Glenmark as well having a good day today, 3.5% higher, Natco Pharma, Laurus Labs, Mankind, all of them seeing healthy gains in today's session. Lots of newsmakers, including a pharma stock here as well, with Cohance, with the block deal taking place, 6% lower, started off 6% lower, ended at the same quantum as well. But Poonawalla FinCorp was the highlight, and 12% higher on that stock after promoters increasing their stake post the fund infusion. The next level, of course, to watch is 520, which is the record high. Tega after the fundraise, Page Industries with a negative brokerage note from HSBC, and another lower circuit today for Dream Folks. As Ekta was mentioning, the broader markets picked up pace, and look at the moves seen in a lot of these broader market names. Shalimar Paints, IRM Energy, Prism Johnson, Deccan Gold, all of them seeing at least 10 to 15% of gains, and High-Tech Pipes continuing to move higher as well, 9% higher on that stock. And lastly, stocks that ended at a 52-week high. It was another good day for Bajaj Consumer and on very strong volumes as well in today's session. Banco Products, another day, another high for the stock. Ramco Systems, Eternal was at a record high today at 337. A positive note coming in from Goldman Sachs today, and Hyundai Motors too continuing to build on to strength from its IPO price. Back to you guys.
Okay, all right, Hormuz. Thanks very much for that. So those were the top stock movers. Let's go across to our guest now. Siddharth Khemka from Motilal Oswal Financial Services and Somal Mehta from Mirae Asset Sher Khan join in. Evening, gentlemen. Well, Siddharth, I'll come to you. It seemed to have picked up pace, especially for the broader markets towards the close of trade. What's your sense in terms of a couple of stocks that you would pick from the space and the momentum to continue?
Yeah, hi, good evening, Ekta. So I think if you look at, there is definitely some tailwinds that are gathering pace apart from the earnings recovery. Now there are talks of a US-India trade talks, plus the Fed rate cut that is also kind of supportive. So I think the first sector that comes to mind is the NBFCs. I think with the consumption picking up the consumer lending space, that is something that is getting interesting from the large cap, definitely Bajaj Finance, but from the mid cap space, stocks like a Poonawalla FinCorp or even an IDFC First Bank. I think these are some of the interesting names from the consumer financing names. The broader market, again, as you rightly said, some of the names that we are liking is the new age companies, including the likes of Swiggy, Zomato, and especially if you look at delivery. I think with the kind of, again, festive season coming in, we are seeing a lot of these e-commerce big billion days that could lead to strong demand for a company like delivery. Numbers are improving, and the consumption boost could benefit a company like delivery as well.
Got that. Somil, how would you assess today's trading action? Are you encouraged by the recovery towards the end? And how does this position us for tomorrow?
Absolutely. Good afternoon, everyone. The recovery has been very good today. I thought it would keep consolidating, but it was a sharp recovery. Very constructive move. I'll be expecting the move to continue. This is the third positive weekly close for the markets, which is very great, very good for the markets. Positive sign. Momentum indicators on the higher degree time frame, which is weekly and monthly, have come into buy side very recently, and higher top, higher bottom formation on the higher time frame, which is great signs for the market. I'll be expecting a target of 25,650 levels, which is the previous swing high, and once that crosses, I think the all-time highs would be the next target in the medium-term outlook. Overall, buy on decline should be the strategy, and right now, pharma and metals are looking great at this point of time. Even mid-caps, IT is looking great.
Okay, all right. Well, let's talk about pharma a little bit more. Biocon and Glenmark were in focus. This is after Biocon received an approval from the US FDA for 2 biosimilars, while Glenmark's partner, Astria Therapeutics, announced positive results from their phase 1A healthy subject trial of a particular molecule which is under development. So I'll start with Biocon, which was in focus. They received US FDA approval for the biosimilars Prolia as well as Xgeva. The combined market size for both of them is around $4.5 billion. The revenue potential for Biocon is estimated between $100 to $150 million. It is expected to be competitive because it's going to be an 8-player market. Biocon is the 5th to gain approval. 3 players have already launched and 3 more are still awaiting clearance. Interchangeability, which they've received, is a positive and it should boost market share. But overall, when exactly can they launch? Possibly after they settle with Amgen, because Amgen has litigated against a couple of companies, and Biocon is expected to possibly launch these drugs once they settle with Amgen. Glenmark, Astria Therapeutics, has announced positive results for one of the molecules under development, phase 1A results, that is. So that is, the molecule is called Star 0310. Now, why is this important is because Glenmark's arm, Ignis Sciences, had entered into a licensing agreement with Astria in October of 2023 and out-licensed this particular molecule to Astria Therapeutics. So the molecule that they've received phase 1A positive results from is the molecule that was out-licensed by Glenmark to Astria Therapeutics. One will have to see what the progress of this particular molecule is, considering it's phase 1, but nonetheless, positive news which has come in for Glenmark as well. Siddharth, any views on both of them?
I think Biocon, we have been having a very positive view. They have consistently been on the right side of the regulatory hurdles. Earlier, they got the US FDA approval for the Malaysian facility, and then the Bangalore facility also got the approval. Over the past few quarters, we have also seen a lot of product pipelines that are getting approval. We continuously, what we see is that Biocon is proactively scaling up its peptide API capacity ahead of the semaglutide March 26 patent expiry in India. And is targeting to capture a huge part of this additional demand that is going to come in. With their in-house manufacturing capabilities, they aim to de-risk the supply chain and become a key player in the global GLP-1 API supplying. What we also see is that in the overall product pipeline, the biosimilars, that has a better acceptability, with the injectables being more promising compared to some of the oral medicines. Plus, with their subsidiary, which is your Syngene, that is expanding in the CDMO capabilities, and hence, as an overall package, we believe that there could be a strong growth with margins improvement over the next few years. So Biocon has been one of our preferred picks. We have a buy rating and a target price of 410.
Okay, all right. Well, Cohance Life Sciences was in focus. It fell over 5% after its promoter, Advent Private Equity, decided to upsize its stake sale plan. The promoter is also looking to sell around 8.9% of equity from 5.1% earlier. Vivek is here with the details on this, as well as the US FDA Form 483, which was issued to one of their facilities. Vivek.
Well, that's right. Like you mentioned, so Advent Private Equity, which now owns both the CDMO businesses, which have now been go ahead and consolidated into one single entity, Cohance Life Sciences. Both Suven Pharma and Cohance now operate under Cohance Life Sciences. So last evening, they launched a block deal to go ahead and sell close to 5.1% stake. We understand that the demand was quite strong, which gave the company enough confidence to go ahead and upsize this particular stake sale to close to 9% of the total equity. That particular deal happened in today's trading session. And what we understand was the total size of the block was close to $350 million. The floor price was at 900 rupees a share, close to 7% discount to yesterday's closing. Now, additionally, in August, the company's facility in Telangana was visited and inspected by the US FDA. They issued 6 observations. Looking at the observations, they mostly appear to be procedural in nature. Doesn't appear that there are any data integrity issues. 6 observations, let's have a look at them. Failure to review discrepancies. The second one was written drug record complaints were not fully followed up. Quality control unit procedures were not fully followed. The fourth one, equipment and utensils were not maintained. And also, test method accuracy was not established. You did see significant pressure on the back of the large block deal that happened in the session today.
Thank you very much for that. Back to just getting a fundamental check on Cohance before we get a technical view also. Siddharth, Cohance is right in the middle of CDMO and there is so much excitement surrounding it. But first, your view on the promoter, private equity player, selling down nearly about 9% stake. Is that a big negative, or is this dip a buying opportunity?
So first, the disclaimer, we don't have active coverage on Cohance, but I would have a general view that we generally see some of these private equity players having a timeline to their exits, and I don't see that as a big negative. Overall, CDMO is a space that we have been very positive on, and I think this could be an opportunity given that a large block is being sold at a discount. So definitely view this as a buying opportunity.
Okay, all right. Well, Somil, any view with regards to a couple of these CDMO players on the technicals? We have Piramal Pharma, we have Cohance Life, and a couple of others such as Newland and Divi's.
I think Cohance, let's talk about Cohance. Cohance has been in the downtrend for a little while, low top, low bottom formation, but the downtrend has been very slow, and it has been struggling below 200 daily moving average, which is not a very good sign for a stock at this point of time in the very short term. But very, very crucial supports around 830, 850 levels. And if that level comes in, then it'll be a screaming buy at those levels. And I'll be expecting a good, basing out pattern at those levels, and then a good rally on the upside. But at this point of time, revisit at 850, 830 levels and avoid at this point of time. Davis Lab has been one of my very favorite picks for a very long time. Davis Lab definitely looks good here, and a small triangle pattern has been forming right now exactly at 200 daily moving average. And now I think it is starting picking up the momentum. I'll be expecting a good rally here with a stop loss of 5,890. That will be the stop loss. And the target would be around 6,550.
Okay, thank you. Let's move on now to the other stocks making headlines today. Poonawalla FinCorp surged to a 52-week high. This is after the promoter completed a 1,500 crore fund infusion, increasing the stake in the company. Tega, on the other hand, remember it's in the news on account of the large Molycorp acquisition. The board approved a 2,000 crore rupee preferential issue Gaurav is here with the details on these two.
Well, yes, when we talk about Poonawalla FinCorp, now this stock is up in trade, and the reason being that they have infused 1,500 crores. So the promoter has infused it via preferential issue. It was known earlier on 25th of July. They had already said that board has given an approval to infuse around 1,500 crores, and they were going to do it via preference shares at a price of around 452 rupees. They have now issued 3.31 crores shares to promoters, and with this, the promoter entity's holding has gone up from 62.4% to 64%. Let's not forget that this is actually book value accretive deal. So the book value per share that goes up almost by 13.5%. And as a result, if we look at the stock performance also, it is up more than 12%. If we compare it with the valuations, it was trading at a valuation of 4.2 times yesterday. And currently, given the 12%, more than 12% move, it is currently again trading at the same valuation. So we could say that valuation wise, we are seeing that market is actually appreciating the fact that 1,500 crores were infused by promoters. On the other hand, Tata Industries, here also we are seeing that now board has approved issue of 1 crore shares to raise around 2,000 crores for the company. But the catch here is that the issue price is going to be around 1,994, which is at around 6% discount to the current market price. And as a result, we are seeing some kind of pressure in this counter. And also as a result, we saw the stock actually ended in red today.
Okay, all right. Stay with us though, Gaurav. Tell us about the Reserve Bank of India's recent guidelines for payment aggregator and payment gateway guidelines. How does this move impact platforms like PhonePe, Paytm and credit card companies?
Well, yes, let's understand what RBI has said first. They are saying that the payment aggregators shall aggregate funds only to the merchants with whom they have contractual relationship, and payment aggregator business shall not carry out marketplace business. Now, what has happened is that earlier we usually pay electricity bills, mobile bills via payment aggregators like Paytm, Cred, and at the same time, these guys, they also allowed us to pay rent via these applications. And the catch here is that the rent was, we were able to pay rent via credit card as well. Now, with this will stop rent agreements and the rent payment via payment aggregators. Now, this will stop, and that is the reason why we may see some kind of impact on stocks. Now, is it something new? It's not actually new. In fact, the regulatory restrictions were placed 2 years ago, but there were some gray areas, and that is the reason why we saw some players like Cred, they were still offering paying rent via these platforms. In fact, we saw channels like Amazon Pay, Paytm had suspended these activities as early as March 2024, and banks were also not promoting. In fact, SBI Card, Bank, all were actually imposing some charges on these transactions to actually restrict or moderate the growth. What about the impact? Now, there will be impact in two cases. First is that for payment aggregators, the impact will be on the fees that they collect, and at the same time, same impact can be seen on credit card companies because the fees that they were charging, they won't get that fees anymore. Let's take an example of SBI cards. Earlier, SBI cards 2 years ago, they said that the payment to rent actually contributes around 14 to 15% of their total retail spends that they have seen, and they charge around 200 rupees per rent that the user were paying. In fact, when we talk about the recent days, although they said that there has been moderation in the growth of rental payments via credit card, but at the same time, now analysts believe that the EPS is going to get impacted, and the reason being that these transactions will stop completely. As a result, the 200 rupee fee that was earned by SBI cards, that will stop, and as a result, we may see some impact on fee income. So definitely, it is difficult to quantify how the numbers are going to be. We will be watching out on how the management is going to address this. But as of now, some concerns around companies like SBI, and also we will also watch out on the companies like Paytm, how they are giving their guidance as well as some commentaries on this issue, or rather new development as we call it today.
Okay, all right. Thanks, Gaurav, for that. Well, Siddharth, quickly, would you have a view on a couple of these credit card companies?
I think, yes, with the government, especially the RBI, in lowering a lot of these regulatory hurdles, and that is improving the overall sentiment. And with the expected uptick in consumer spending, I think some of these credit card companies can start doing well. Definitely, there is a case of competition from the new age UPI payment aggregators and all those kind of things. So I would say that it's better on a holistic level to look at an NBFC having a much more diversified play rather than only focusing on a credit card business. But nonetheless, given the current setup, I think in the next 1 or 2 quarters, we could see good improvement in the financials for the credit card companies.
Gentlemen, thank you very much for joining in. Need to get into a break. On the other side, top corporate voices and the big events to watch tomorrow. Stay tuned. Welcome back. These are the top corporate voices of the day. First up, Apollo Tyres. The company, remember, recently replaced Dream 11 to become the title sponsor of the Indian cricket team's jersey. This is a 3-year deal worth 580 crore rupees. The management stated it is looking at a long-term association like it has been with Manchester United. Also for Apollo Tyres, India remains the main market, but association with Indian cricket team will give them equal amount of exposure in the international market. That's not all. The management lauded the GST rationalization. It said GST rate cut is a move in the right direction and the company is all set to pass on the benefits to the consumers.
Next up is Tata Steel. Tata Steel maker stated it's well on track to achieve its FY26 growth targets of a back of Kalinganga plant expansion and capacity ramp up. The management added that the global environment for steel industry is challenging. However, due to strong domestic demand, impact on Indian steel makers is not that much. Tata Steel is optimistic that India-US trade deal will benefit their customers. On EU's carbon border adjustment mechanism, the steel maker said it has requested Indian government to create fund and support the producers to pay carbon tax locally, and that the rules always provided for deduction of carbon price paid in India.
Meanwhile, KEC International said despite the GST cut, the company has witnessed an impact on capex, particularly in the water segment. Order flows currently stand at 8,900 crore rupees with several large L1 positions in place. The firm has set a full-year target of 30,000 crore rupees, expects additional 3,000 to 4,000 crore rupees in terms of orders by second quarter. They maintain their revenue growth guidance of 15%, margin guidance at 8 to 8.5%.
And the management of Motherson Group revealed that they have unveiled a 5-year plan and that they are upbeat about achieving those targets. Further, the group has received many queries from car makers asking them to produce cars in niche areas. The auto component maker stated they have no problem making cars since they have been assembling machines and components. The group, which has acquired 44 companies till date, stated acquisitions are better than joint ventures. The group revealed many companies have lined up for demerger and the company will come out with the name soon.
And before we wrap, let's get you the key market events to watch for tomorrow. Ria standing by.
Well, yes, let's take a look at the key events to watch out for tomorrow. We have the core retail sales data coming out of the UK, and we also have the forex reserves data for India. D Development Engineers is going to hold a board meeting to consider a fundraise tomorrow. Satvik Green Energy's 900 crore IPO also opens for subscription tomorrow. A lot of stocks are going to trade ex-dividend. These include NSDL, Gulf Oil, Mazgon Dock, LT Foods, Bharat Dynamics, Nalco, NLC India, as well as Bajaj Healthcare. Apart from on this, the Supreme Court Registry has assigned September 19th as the date of hearing for Vodafone Idea's AGR plea. Three other key events to watch out for. We have the Eurogroup meeting of the Eurozone finance ministers. US President Donald Trump will speak with President Xi of China on Friday, the 19th of September, to confirm the TikTok deal. And lastly, Commerce Minister Piyush Goyal will continue his two-day visit to the UAE.
Okay, all right. Thanks very much for that, Ria. On that note, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. Stocks rise across the world after the US Fed cuts rates by 25 basis points. Also signals 2 more cuts this year and a rate cut next year. Gold sees some profit booking. The Sensex and the Nifty close in the green after a range-bound session. The Nifty reclaims 25,400. Financial stocks lead the rally today.
I hope there's no more hesitation for industry to invest further, to expand capacities.
With 4 days to go for GST cuts to take effect, Finance Minister Nirmala Sitharaman exhorts that industry must increase investments quickly. Says the government hopes there is no reluctance to increasing capacity and manufacturing. Marauti Suzuki passes on the GST cut benefits, cuts car prices by up to 27% with effect from the 22nd of September, also offers additional discounts, clarifies the discounts will last only for a limited period.
We are a not yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it.
The Motherson Group is unperturbed by tariffs or any other headwinds, says the chairman Vivek Chand Sehgal. Adds every segment is showing growth and the group is ready to enter any sector where it sees customer demand. That's an exclusive. Apollo Tyres pads up as the new lead sponsor for BCCI signs a 579 crore rupee contract. Managing Director Neeraj Kavar tells CNBC TV18 they are in it for the long term, says he's not worried about the so-called sponsor jinx. Heavy rains lashed Uttarakhand, at least 10 people missing after landslides flattened several houses in Chamoli district. Around 2,500 tourists are stranded in Mussoorie as the road to Dehradun remains closed for the second day. Rahul Gandhi makes fresh allegations against the Election Commission, claims irregularities in addition to the deletion of voters across the country, accuses the Chief Election Commissioner of protecting those responsible. The Election Commission calls the charges incorrect and baseless. Pakistan and Saudi Arabia sign a mutual defense agreement. Aggression against either country will be considered as aggression against both. India's External Affairs Ministry is studying the implications and reiterates its commitment to national security. Israeli tanks patrol the streets of Gaza City as Tel Aviv presses ahead with its ground offensive. Reports say the Israeli army continues to force thousands of Palestinians into the overcrowded south and central Gaza. Israel's far-right finance minister calls Gaza a potential real estate bonanza, says he's actively engaged in talks with the US and how to divide it up. President Trump meets UK Prime Minister Keir Starmer at Chequers Estate. This comes a day after a royal reception at the Windsor Castle. Tech investments, steel tariffs and geopolitics topped the talks as part of the agenda. Facebook's parent Meta launches new smart glasses in partnership with Ray-Ban. The glasses will cost $800 and come with an inbuilt display. Is it worth your money? A product review coming up. Well, let's start with the global market action. Stocks gaining across the world after the US Fed delivered that widely expected rate cut for the first time in 9 months. China's Shanghai Composite was an exception, though, as investors booked profits there. Now, the Fed's quarter percentage point cut takes the rates to the range of 4 to 4.25%. Recently appointed Fed Governor Stephen Moran, backed by President Trump, was the only policymaker who advocated for a 50 basis point cut. The Fed also penciled in 2 more cuts before the end of the year. However, Chairman Jerome Powell warned of signs of weakness in the labor market. The S&P 500 ended a little changed on Wall Street at closing bell, so the markets had already priced in that 25 basis point cut. But on the large street, the Sensex and the Nifty closing at the highest level since July after what was a range-bound session. The Nifty reclaimed the 25,400 mark. That's where it finally closed for the day. The Sensex also closing about 320 points higher. The Nifty IT index up by over 300 points, and Pharma putting on about 1.5%. So strong moves coming in there for the IT and Pharma stocks. In the money market, the rupee weakened against the dollar. $1 costs more than 88 rupees as things currently stand. The dollar index regained some momentum from the 7-month lows after the commentary from the US Fed hinted at some caution on potential rate cuts. But the top story this evening, the GST rate cuts are set to take effect in the next 4 days. Finance Minister Nirmala Sitharaman encouraging industry to boost investments. Speaking at a symposium of the Indian Foundation for Quality Management, the Finance Minister said the government has delivered the ease of doing business. It now hopes that there won't be any reluctance to increase capacity and manufacturing. Here's the Finance Minister.
I hope there's no more hesitation for industry to invest further, to expand capacities, produce more in India. And what else is required by the government to do? Spell them out. You have a Prime Minister in this country who you have known for decades, from his days as Chief Minister of Gujarat. And he's never relented on reforms, nor has he ignored the wish list of the industry.
If India is to achieve its goals of economic, social, infrastructure and inclusive growth, the main purpose of Viksit Bharat, then we need to be working closely with the vision of the Honorable Prime Minister in multiple dimensions. And we are doing this at a time when the world is going through several challenges in terms of macroeconomic stability.
Globally, for the steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month. And oftentimes at prices at which they themselves don't make money. So it's very difficult for anyone to compete with that. But luckily for the Indian steel industry, the demand growth in India has been strong. So we've been less vulnerable to what's happening in the global markets. The additional capacity that many of us have built in India are being fulfilled, being taken care of from the demand that there is in India. But if we were to export, yes, it would be challenging.
Well, that's the Finance Minister's message to India in Get On With It. Meanwhile, India's largest car maker, Marauti Suzuki, has announced price cuts of up to 1.3 lakh rupees. The new prices will come into effect from Monday, which is the 22nd of September, when GST cuts come into play. The company has called it a limited period offer. That is as far as the discounts are concerned. The discounts, of course, will be reviewed by the end of the year. Sudarshan is here with the details of what Marauti has put on offer on the back of the GST cuts, plus the added discount. Sud.
It's a big price cut that biggest car maker of India, Marauti Suzuki, has announced. The price cut is as high as up to rupees 1.30 lakh, or say up to 27%. It's much more than the GST rate cut because most of its cars have come into 18% slab from the earlier slab of 28%, and that's the reason it has given the additional discounts also, and saying the additional discounts that it's providing, it will be for the limited period, and company will review again by the end of the year. And the cut is maximum for the entry-level segment, where it's in the range of 12 to 27%, while for mid-level cars and SUV cars, the cut is in the range of 2 to 14%. Why the big cut has been given for entry-level segment? Company is saying there is need for compelling offerings to upgrade two-wheeler customers to four-wheelers, and that's the reason it has given the bigger discount. And the impact, company is saying that for the next 2 months, sales should not be seen, but going forward, or say by the next year, it believes that market will bounce back to the CAGR of 6 to 7%. We'll have to see how the next few months pan out, but most of the brokerages after the recent GST cut have increased the growth outlook.
Sid, many thanks. On to a CNBC TV18 exclusive. The Motherson Group's chairman, Vivek Chand Sehgal, has said that he is unperturbed by tariffs or any other headwinds. Sehgal also said that every segment is showing growth and the group is ready to enter any new sector where it believes it sees customer demand. Sehgal also added that Motherson is a not-yet company. Here he explains why.
More than 450 plants all over. So I don't need to export, otherwise I'll be taking all the export awards. We are a not yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it. So we're an open-minded company. We go for those particular challenges which the customer poses to us. We've done 44 acquisitions up till date. And we think it's a better way than joint ventures because you own the technology, the patents and everything come to you.
A not-yet company, says Vivek Chand Sehgal there of the Motherson Group, as they get ready to possibly deliver cars as well. Assembling cars is something that the company has spoken of getting into. The head of Boeing in India says aircraft maker is still assessing the impact of tariffs. Speaking with Parikshit, Salil Gupte of Boeing says he remains optimistic that India and the US will find a way forward to resolve the current tariff issue. Take a look.
We remain optimistic that because the U.S.-India relationship has been so strong and has gone from strength to strength over the last 20 plus years, that the two countries will find a way forward that enables trade to continue and collaboration on the industry front to continue. And we see the two leaders, President Trump and Prime Minister Modi, giving some positive signals about that over the last few days. We believe that Boeing is extremely well positioned to do that because of our engineering capability here in India and our supply chain here in India that allows us to pursue those deals. So whether it's more aircraft coming over like the P-8, which is a foreign military sales deal, so that's between the two governments, or co-development and co-production, we're here to support.
Well, that's Boeing. The vice chairman of Apollo Tyres says he's confident the company will break the so-called sponsor jinx when it comes to the Indian cricket jersey. Remember, past sponsors like Byju's, Dream 11 and Sahara have had a terrible innings. Neeraj Kaur of Apollo Tyres has told CNBC TV18 the firm has very strong foundations and it's ready for the long haul. This comes after Apollo Tyres signed a 579 crore rupee contract with the BCCI to be the jersey partner for a 2.5-year period till March 2028. The deal covers both the men's and women's jerseys across all formats.
So I don't look at a 3-year span, I look at it a much longer term, because whenever Apollo has tied up with someone, for instance, and the writing is on the wall with Man United, this is our 13th year with United. So it's been a long journey with Manchester United. So that's a real live example to tell you that once Apollo collaborates with such a big brand, which gets a nation the pride, Apollo will stay. It's a long term, it's a century, and centuries to come.
Well, that's Apollo Tyres there on breaking the jersey jinx. On to the latest developments in the Dharavi redevelopment project in Mumbai. Setlink Group, which lost out to the bid to the Adani Group, has launched arbitration against the Maharashtra government in the United Arab Emirates. Setlink has also moved the Supreme Court in India, challenging the government's decision to award the contract to Adani. Ashmit joins us now to take us through what has transpired in this matter. Ashmit, now the initiation of arbitration proceedings?
Well, the big-ticket Dharavi project that was awarded by the Maharashtra government to the Adani Group continues to see fresh legal disputes. Seychelles-based Setlink, a consortium of developers which was competing with Adani for the very same project, now we understand has initiated arbitration proceedings. And these arbitration proceedings are aimed at the Maharashtra government. They've been instituted in UAE, and Setlink, as a part of these arbitration proceedings, is essentially saying that they were shortchanged as a part of this entire bidding process. Bear in mind, there was a first round of bidding done in 2018 where Setlink had emerged as the highest bidder with a bid of over 7,000 crore rupees. However, that bidding process was scrapped entirely. The conditions were changed. The conditions were tweaked. There was a second round of proceedings that were done in 2022. And in 2022, Adani emerged as the top bidder with a bid of 5,069 crore rupees. Now, that is something that Setlink has objected to, saying that this would be a first case where a state government is willing to settle for a lower bid, saying that their bid was much higher, that even now they're willing to go higher and go beyond 8,600 crore rupees. Also mentioning that this entire reason there was tweaking of conditions was done specifically to suit Adani, that this was done at the expense of Setlink, and that there are extraneous reasons why the Maharashtra government seems to be supporting Adani as far as this redevelopment project is concerned. Nonetheless, Adani has defended its position, saying that above and beyond their bid, they also have obligations which add up to over 3,800 crore rupees. So this essentially marks twin proceedings now regarding the same project. The Supreme Court proceedings continue to be underway, where Setlink is challenging Adani's bid. That's one. And now fresh arbitration proceedings in the UAE.
Ashmit, many thanks for joining us. Israeli tanks and military vehicles have entered Gaza City's most crowded residential districts. This comes on the second day of Israel's ground offensive aimed at occupying the area. Israel has said the operation aims to free hostages and defeat about 3,000 Hamas fighters. The overall death toll in Gaza has now crossed 65,000. President Trump met UK's Prime Minister Keir Starmer at the Chequers estate. Talks are expected to be on areas like tech investments, steel tariffs and geopolitics. Trump's visit came a day after he was received at the Windsor Castle. At dinner, Trump said the ties between the US and the UK will endure. King Charles also commended Donald Trump's personal commitment to solving world conflicts. We will head into a break, but coming up next, Facebook's parent Meta gives its Ray-Ban smart glasses an upgrade. Details when we return. Rahul Gandhi has made fresh allegations against the Election Commission. He claims irregularities in addition and deletion of voters across the country. He also accused the Chief Election Commissioner of protecting those responsible. The Election Commission has called the charges incorrect and baseless. The BJP has accused the Congress of trying to malign democratic institutions.
Targeted deletions हो रहे हैं. कांग्रेस पार्टी पर आनंद में अटैक किया. टॉप 10 बूथ्स जहां सबसे ज्यादा कांग्रेस की स्ट्रेंथ थी वहां टारगेट किया. और 2018 में पिछले इलेक्शन में 10 में से 8 बूथ कांग्रेस पार्टी जीती थी. और इन 8 में से इन्होंने 6000 लोग उड़ाने की कोशिश की. ये कोइंसिडेंस नहीं था, ये प्लान था और ये सेंट्रलाइज तरीके से किया जा रहा है.
आज की प्रेस कॉन्फ्रेंस में हाइड्रोजन बम फोड़ने वाले थे, फुलझड़ी से काम चलाना पड़ा, वो भी फुस हो गई. क्या हो गया? इलेक्शन कमीशन ने बड़ा स्पष्ट कहा है कि नो डिलीशन ऑफ एनी वोट कैन बी डन ऑनलाइन बाय एनी मेंबर ऑफ पब्लिक. ऑनलाइन किसी भी वोट को नहीं काटा जा सकता.
Doctors across Maharashtra under the Indian Medical Association on a 24-hour strike. The protests are against the state government's decision to allow the registration of homeopathic doctors who have completed a certificate course in modern pharmacology in the State Medical Council. However, all emergency and critical services are largely unaffected. Santhya joins us now with more. Santhya, a one-day strike being called. Take us through what is at the heart of this.
Right. So on 5th of September, the Maharashtra government issued a GR Shireen and instructed the Maharashtra Medical Council to start registering homeopathic practitioners. This move will allow them to practice allopathy after completing a one-year course in modern pharmacology. These practitioners will be permitted to prescribe allopathic medicines ranging from your anti-HIV, your anti-TB drugs to steroids, supplements, abortion pills, postpartum medications, IV saline and many more. The issue began in 2014 when the Maharashtra government amended the Maharashtra Homeopathic Medical Practitioners Act and the Medical Council Act. 11 years later, the state government has now instructed the Maharashtra Medical Council to register homeopathic practitioners, effectively allowing them to prescribe allopathic medicines. The Indian Medical Association IMA and protesting doctors argue that a one-year modern pharmacology course does not qualify homeopathic practitioners to practice allopathy, especially in treating serious ailments like HIV, TB, postpartum complications and other critical conditions. They point out that the way pharmacology is taught to MBBS students is very different from how homeopathic practitioners complete their this one-year course, which involves just 2 classes a week.
By just doing a theory course and not going to the wards, not seeing patients, not even applying those medicines to patient care. In our curriculum, when we learn this subject of pharmacology in second year, we are then seeing its application, learning its application to medical patients, surgical patients, ophthalmology, ENT, gynecology, pediatrics. All these specialties have different drugs. The drugs, the medicines can have interactions. So who is going to learn this? Do you think these homeopathic patient people are going to be able to treat them?
On the other hand, homeopathic practitioners argue that they are just as qualified as allopathic doctors to pursue this course, as it is open to them only after completing a BHMS degree and gaining 20 years of practice. They claim that the BHMS curriculum already includes basics of allopathy taught by allopathic doctors, so the one-year course is not their first introduction to allopathy.
It is not a one-year course because Maharashtra government amended this course in 2014 in assembly that 4 and 5 years BHMS course along with 1 year internship completed doctors and having more than 20 years practice experience are eligible for this CCMP course in MBBS college for 1 year. That's why it is a 5.5 years BHMS along with internship along with 20 years experience. And then we get the course CCMP course for 1 year in MBBS college. That's why it is not a 1 year course.
Well, doctors are on a one-day strike there. The AI chip race is heating up. Huawei has unveiled a new generation of AI chip technology aimed at challenging NVIDIA's dominance. The company says its Atlas 950 supercluster is capable of supporting over 5 lakh of its Zen chips and could be launched as soon as next year. Huawei has touted it as the world's most powerful AI chip cluster. It also plans to roll out 3 new versions of the Ascend chips by the end of 2028. Facebook parent Meta has launched the Meta Ray-Ban Gen 2, which is an improved version of its AI smart glasses. The starting price for this is $379, but is it worth your money? Shibani Gharat sends us her review from California.
Now, I'm at Meta Connect, as you can see, and Ray-Ban Meta Glasses Gen 2 were launched here. I'm wearing it right now. Now, I have been using the Gen 1 of the Meta Ray-Ban glasses for past year almost to take my calls, listen to music and capture videos even during my runs and commute. So, when Meta dropped the Gen 2 today, I had to check them out, and honestly, these are some of the upgrades that I have been waiting for. So first up, what's improved? Battery life. Now, Ray-Ban Meta Gen 1 lasted up to 4 to 5 hours. Gen 2 can give you up to 8 hours plus 50% charging, just 20 minutes. The case carries extra 48 hours. So great for your commute, work commute, travel, and even more. Next, video. Now, I loved my point of view clips on Gen 1 whenever I shot them, but they max at 1080p. Gen 2 brings 3K Ultra HD at 60 frames per second with HDR. Also, later in the fall, companies promising hyperlapse as well as slow-mo on these models. Then, audio plus AI. Still, it's open ear, so you don't have to put anything in the ear, and AI has become more conversational. Live translation is now available in 6 languages, even offline. So hence perfect for travelers. Style-wise, still the iconic Ray-Ban Wayfarer, Skyler and Headliner, plus new colors like Cosmic Blue, Mystic Violet. Some of the colors that I really love. They look like actual glasses and not gadgets. That's like a big plus for me. The price, it starts at $379.
Well, that's Shibani with her Ray-Ban Gen 2 from Meta, clearly enjoying them. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment with more.
A Fed rate cut has just been announced and 2 more are likely this year. In India, a massive indirect tax cut, GST cut, goes into effect on Monday. More rate cuts in India too may come. To parse the impact of so many tumultuous changes on Indian markets and macros, the JP Morgan Brain Trust is with me. Sanjay Mukim, the head of India Equity Research, and Sajid Chinoy, head of Asia Economic Research, JP Morgan. Welcome, guys. What a great time to have your JP Morgan 10th Annual Investor Summit. I mean, such a crucible of changes. Sanjay, therefore, to start with you, September 22nd, your conference day coincides with the GST cut going into effect. So I just wanted to ask you, you all must have parsed the impact by now. Yep. After the Q1 earnings, you may have a forecast. Have you upped or changed any earnings?
We haven't yet, and it's great to be on. Thank you for having us, Lata. So it was not by design that September 20th. That's a week we do it every year. Okay. But I would argue to that point you made that expectations in India have actually been cut, quite a bit, and quite early in the fiscal year. So normally what you get, typical sell-side behavior, is that earnings are cut towards the second half. When nobody cuts earnings in the first quarter because, there's 9 months to go and we'll wait it out. But because we've got such cautious feedback from corporate India in general, that there's been a significant amount of earnings cuts in the 1 quarter already in the year. And therefore, you're starting off the second half with a very supportive base. And while it's still early days to say how much of an upgrade or if we get upgrades at all, but the base for earnings now looks far more favorable. Whereas on the other side, you've got the support to consumption from the tax cuts in February and these GST cuts which have come through. And of course, remember that the Indian market has got far more interest or far more representation on consumer-facing companies than capex-facing companies.
Yes.
So overall, you are likely to see support to earnings. Expectations being low is a good start for looking at equity.
But has it pushed you overweight on, anything, consumption, discretionary, financials?
We are overweight, India in the EM context, and we are overweight discretionary in India as well, right? Because there is a clear shift in policy preference to try and drive the consumer part of the economy a little out of the rut it has been in, let's say, for a few years.
I have lots to ask Sajid on consumption, but before that, the big event that is just behind us, the Fed rate cut. From an India standpoint and from a global growth standpoint, what are the takeaways?
So a couple of things, Lata. First, the 25 base point cut was no surprise. I think 2 things I was looking at was that it was important that there was only one dovish dissent, which was Miran. So 2 governors, as we know previously, voted with the consensus. And that actually is the more important takeaway, that the independence of the Fed is being prioritized more than personal ambition. I think that's an important takeaway.
And that's why the dollar didn't fall further.
Exactly. So you had both, Bowman and Waller, who had previously voted against the consensus, now joining the consensus to say the Fed's very much behind their chairman. The other takeaway for me was that the chairman described this cut as being an insurance cut. And that's not a surprise because we've been arguing for a long time that tariffs and immigration are both stagflationary shocks. They simultaneously hurt growth and push up inflation. So the Fed did this dilemma at this point where the labor market has slowed meaningfully and the worry is that the US may slip into recession, but at the same time, core inflation is firming and firming and firming. Exactly. So the way we see it is if the labor market were to crack, then the Fed will have a very long easing cycle no matter where inflation is because they will presume that a recession is very disinflationary. But if the labor market, if this is a head fake and the labor market stabilizes, it's important to realize that the break-even rate may be lower in the US now because of all the anti-immigration efforts. Okay. If this is a head fake and the labor market stabilizes, then this could be a much shorter easing cycle because this is purely insurance. Okay. The implication for EMs is not very much. The point is, unlike previous cycles, the dollar has weakened so much in the run-up to the Fed meeting over the last 6 months. That's what matters for EM central banks. So even without the Fed moving, in the last few months in Asia, for example, we've seen a series of cuts across the board. Thailand, Indonesia, Korea, India, the Philippines. So EMs now don't need to wait for the Fed necessarily in the wake of a weaker dollar.
Serious Asian disinflation. I'll come to that. I tend to get carried away by these topics. But, the one question I would have asked Sajid, nominal GDP, while the real GDP is very good at 7.8, reminiscent of the 2004 times, at 8.8, does that, impinge on you when you are doing an earnings growth forecast?
It will. And this is something that we've been highlighting to our clients as well. If you roll back, Lata, let's say to FY23, there were several quarters where nominal GDP growth was north of 20%.
Yes.
And when that happens, your 1,000 stocks in the market, the median growth will be high double digits, right? And everything looks great, and you straight line those growth forecasts, you double the multiple, and the market's a multi-bagger. Now, we are single-digit nominal growth, and we will probably stay around the vicinity of 10% for the next 3 years. So we'll have this fallacy of composition in equity earnings forecast, because every analyst will bottom up say, my company can grow 15%, but with the nominal GDP at 9, 10, only a handful of companies will deliver double-digit growth, right? The median growth of earnings in the market will be a multiple of that 10%, probably a low multiple, right? And therefore, we will have this phenomena where growth from corporate India will get concentrated into the few that can deliver double-digit growth. In our framework, the ones that deliver growth will still command those premiums and will still command the multiples, but investors will need to be careful in assuming that almost everything under the sun will have double-digit growth because it is India.
Oh, absolutely. But Sajid, what is the inflation trajectory
Yeah.
for India itself? Because the GST cut will take away a little bit from prices. But the RBI had forecast 4.9 as 12-month ahead for the second quarter next year.
So inflation is very benign even without factoring in the GST cuts. If you look at the full year as a whole, because each quarter will change. FY26, year ending March 26, our average is 2.8%.
That's the market consensus.
Extremely soft. Now, if you add on to that some fraction of the GST cuts, I mean, the RBI should look to the GST cuts. These are one-time price changes. This isn't disinflation. But you're looking at about, 3%. I think the issue for the RBI is that we've already kind of bottomed out. And if you look forward, base effects have an important role to play. Base effects depressed inflation this year in the middle of the year. Base effects will push up inflation in the first half of the year. First quarter looks above 4%. Second quarter could be close to 5%, but that's coming on a base that was 3% in this year. So you have to average these things out. So I think inflation for the RBI is not the issue right now. I think from the central bank's perspective, I would think that they have front-loaded their easing. They're very focused now on monetary policy transmission. We're seeing good transmission in the banking sector on fresh loans. Bond yields have gone the other way, but financial conditions more generally are easy. And I would say that if the Trump tariff shock persists, my own advice is to take a more surgical approach. This is a sectoral hit on certain sectors. We have an example from COVID before. When there's a sudden demand shutdown, we know what to do. And I think a combination of liquidity support, regulatory forbearance, and targeted fiscal support, I think, will be more efficacious, even as the RBI waits to see how things pan out globally and domestically and holds its any gunpowder.
Very quickly, rate cut October?
Not in October.
But you expect one more?
Well, I think it'll depend because 30 seconds, Lata, you've got the headwinds of the Trump tariffs, which are very clear, but you've also got some building domestic tailwinds in terms of higher consumption, monetary easing, direct tax cuts, indirect tax cuts, lower inflation, good monsoon. So the RBI and a good strong GDP print. I think the RBI will wait and see, like the Fed, how is growth panning out? Low inflation allows the RBI to cut in the future, but they'll want to see what the growth trajectory looks like.
Fair point. But, how is the FII interest in your conference? Because we are so clearly the underperformers. Is it reflecting in interest?
Interest is very strong, Lata. And I was worried.
Ulta. Okay.
Ulta. I was worried that given the market's been flat and other parts of EM are actually doing well, that you might see subdued participation this year. This is the 10th conference we're doing consecutively. It's the 80th year for JP Morgan in India as a firm. This is the strongest ever, the largest ever conference we've organized. We have 1,200 participants coming in. We are overwhelmed by the vote of confidence that we've got from our client sets. And again, content-wise, participation-wise, there is absolutely no sign of any waning of interest in Indian equities from both domestics, of course, but even foreign investors.
What are investors waiting for? What are the highlights, if I may ask?
I think let's think of the setup for Indian equities as well. The underperformance has been very stark, especially if you measure it in dollar terms. It's north of 20% YTD. Okay, on multiples, India is now trading at, let's say, a 10% discount to the S&P. Now, we've written research on this quite often to say that India's multiple tends to track S&P more than it tracks EM. So I said earlier, our earnings have already been cut, so expectations have been right-sized to a degree, and we are trading at a 10% discount. And now we've got these domestic catalysts that Sajid just talked about. So the setup looks great for a bit of a catch-up.
Inflection.
That's right. And what people are waiting for is signs of that inflection. So everybody is here to talk to corporates, to talk to people on the ground, to figure out, are we seeing any now, or are we likely to see any during Diwali or in the December quarter, right? Okay. So to build confidence in what is currently theoretical, but likely to happen, I think that's what's driving everybody to participate.
And you have a lot of corporates representative of consumption.
That's right.
Okay, just a word on financials. Sajid says at some point in time there can be one more cut, and that's kind of the feeling I'm getting, that no, people are not expecting in October, but they see the space. So does that make financials still something you're worried, not financial so much as banks, because there'll be more margin pressure?
Yes.
Or are you happy that they will be seeing credit growth?
So it's two stories there, Latza. One, of course, is that there will be margin pressure, and the charts are very, very clear. Lower rates do drive NIMs for most large banks down. Okay, it becomes difficult to manage that. However, the hope is that that is the catalyst that drives further lending into the economy, right? If you do the math on how much it now costs you to buy an entry-level car, right? So you build in the GST cut, and you build in the lower rates, and you look at the delta in the EMI a middle-income family has to pay to buy their first car. That's a very material delta on the loan.
Yes.
Right? And therefore, the argument is that all of these are significant changes and should be a catalyst for volumes. So yes, the margin comes under pressure, but the hope is that over the next 2 or 3 years, for the bank's financials, the volume outlook starts to improve as a consequence of what is happening.
Okay.
And that should therefore be good for the sector.
You know, I spoke to Dixon a few days ago, and they are so bullish on, you know, a 10% fall in the price of a 32-inch plus television, according to them, is going to make a very big difference. But, you know, I have to run into a break. Give me just 2 numbers. What is your GDP growth for this year, nominal and real?
Yeah, so I think real will be somewhere in 6.5 and 7.
Really?
Because on the back of a nearly 8% first quarter.
Real GDP 6.5
to 7. Nominal could be between 8 and 9. And therefore, it's important for investors, when they look at nominal variables, credit growth, GST collections, tax collections, we have to be realistic. It's not possible to get 13, 14% credit growth if nominal is going to be 8 or 9. That has to be your anchor on which you forecast earnings, credit, taxes, GST collection, which could be high single digits or very low double digits.
Okay, well, actually, even now, although the credit growth is 9.9 or whatever, under 10, if you count the bond market borrowings, then credit to the commercial sector is 13%. So probably we are managing 1.5x credit growth for the kind of nominal GDP. Okay, hold on to that thought, guys. I have to take a quick break, but the more important questions on where is the market headed? New highs after Diwali, before Diwali, very soon. All those questions after the break. Welcome to a special Market Masters with the JP Morgan Brain Trust, Sajid Chinoy and Sanjay Mokim are with me ahead of the 10th annual investor conference of JP Morgan. Gentlemen, thank you for your patience and thank you also for dropping into the studio.
Pleasure.
Okay, what are you underweight on, Sanjay?
So we are careful.
You told us you're very positive on consumption.
That's right, we are. We are underweight currently on the IT and pharma space. I think it's a fairly obvious sort of stance.
Global.
That's right, because there is heightened uncertainty on these large sectors, given not just the tariffs, Lata, but also the fact that growth elsewhere is outside of India is likely to come under pressure from everything that's happened. So a combination of these uncertainties plus a weaker growth outlook. The tailwind is a weaker rupee, but you can't be investing just on that hypothesis, is my argument. And therefore, we are clearly underweight the IT and pharma sort of spaces.
Okay. Well, actually, your article in the Indian Express, Sajid, you're clearly highlighting some big fears from the global piece for Asia. Even after the kind of tariffs look settled, you think those headwinds remain?
So I think emerging markets outside China will really bear the brunt of the risks in this cycle because there are three big things happening, Lata, and we tend to forget that when we're stuck in the weeds. One is that exports have still been the lifeblood and lifeline of emerging market growth over the last 30 years. If you draw a chart of emerging market ex-China growth and you draw a chart of global trade volumes, it's the same line. Right? So if in a world which is becoming more protectionist, and this started even before Trump, when non-tariff barriers went up, around the world, and now you've got Trump tariffs, US tariffs are the highest since the 1930s, where will emerging markets find those exports growth? But there's in Asia a second element that compounds the problem, which is, and you alluded to this, all this Chinese excess capacity. China is sitting on mountains of excess capacity. There's lots of deflation. And with US tariffs in China at 42%, that excess capacity is being redirected somewhere else. Guess what? It's coming to ASEAN, it's coming to India, it's coming to Latin America, North Africa. So an emerging market now, A, you're going to struggle to get export growth in a more protectionist world, but B, you have to play defense because now you have to kind of, in a way, confront these cheap Chinese imports that will threaten your manufacturing sector. So I think the outlook, is a little bit more worrying than you would believe. And I think this is a time where EMs have to double down on reforms. I think the premium on being more competitive has never been higher, both to boost your exports and to protect your domestic sector vis-a-vis Chinese imports.
And the premium to be protective. To be both competitive and protective is becoming important because you could have a Chinese onslaught.
30 seconds there, we have to be very careful. The oldest rule in trade is an import tariff is the same as an export tax. So there's a fine line between preventing Chinese dumping but not becoming more protectionist because we've seen that movie before in India for 80 years and we know how it ends.
No, I take your point. It's not, I'm not surprised industrial policy has returned because things are very tricky. The one area we are not discussing because it's not fitting into our main consumption capex is e-commerce in India. We just saw Urban Company list at such a fantastic premium, and it's we are almost outsourcing home management, so to speak. So, are those favored sectors despite their high PEs?
So, we do believe that there is a runway for growth, Lata, right? And these are credible businesses. Whatever skepticism people might have had of sort of a flimsy nature or a fanciful participation, I think those have all been dispelled. And these are cash flow generating businesses will continue to grow. Where we break this up is that in the India household has to be divided into a set of people who will pay for convenience and there's a set of people who will pay for value, right? 80% of Indian households, give or take, make zero monthly savings.
Yes.
Right? And they have no room to pay for convenience. So the challenge in evaluating these companies is when you start extrapolating this growth, you have to be sure that at some point it will hit a tap.
No, you're extrapolating 10% of India's growth.
That's right. So let's say food delivery. It's still growing because the people who pay for convenience are growing, that set is growing, but that growth has slowed down from the initial burst when food delivery was a new thing in the market. So similarly, let's say for quick commerce or anything else online, there will be this burst of great growth, but then it starts settling into mid double-digit growth as you start hitting the tap. So I think there is growth to be had, but investors need to be sure that they don't get carried away in the excitement of what is happening now. and start straight lining the growth into for the next 5-7 years.
Actually, I think an under-researched area is the amount of jobs also these are creating. I mean, we don't even have an urban wage index. And our unemployment numbers are still very survey-based. But, you know, companies like L&T and KEC International tell us they don't get enough labor. So there is something which is under-researched, and maybe there is a consumption kicker over there. Sajid, you know, when we last spoke before the monetary policy, you said growth is going to be two halves. It will be very good in the first half because of base effect and because of front-loading capex and exports, but it will be bad in the second half. Are you feeling a little better now because of the consumption boost?
Yeah, I think, Lata, what we haven't spoken about is there's still this Damocles sword of the Trump tariffs hanging over, right? So we focus very much on the domestic, but look at the external sector. We did not.
That's only 1.4% of.
So it's still one. So the domestic value add is 1% of GDP. But I think focusing on that is sometimes not appreciating the fact that these sectors are highly labor intensive.
Yes.
Right? Are highly labor intensive, and so if the tariffs go on for some length of time, you then begin to worry about the viability of these small enterprises in these sectors. You know, it's gems and jewelry, it's leather, it's textiles, we know it, it's footwear. And then there'll be knock-on effects on consumption. And then the third element is if this goes on for much longer, you worry about the fact that animal spirits gets impeded because India was supposed to be the beneficiary of China +1, but if tariffs remain at these levels, you are at a competitive disadvantage. So for me, I think any growth outlook is clouded by the fact that domestic supports have these external headwinds. The good news is the negotiators are back in India. If we can resolve this in the next 4 weeks, 8 weeks, this will come across as a blip. If this stays on for several months, I think it'll cast a darker shadow on the outlook. August trade numbers were much more benign because the pressures will start in September. What you saw in August is the front loading to the US has now reversed in August, but I think the pressure of the tariffs will show up from September. So I think that's going to be a key driver of the outlook.
Yeah, September is going to be a bad month. You know, people are not consuming domestically for GST and our export advantage runs out. You should have shipped on August 25th to reach on September 17th, I was told. So we are going to have that double whammy only for September. Let's hope October is different. Sanjay, the most important question for the market reserved for the end. What is the Nifty target or, you know, possible target you're looking at? Today we were hearing noises that new high by Diwali and stuff like that.
Well, we do have a base case target of 26,500 in the next 6 to 9 months.
Okay.
So there is, like I was saying, our multiples are at a discount, earnings have been cut, and there are domestic catalysts. If, like Sajid said, the trade deal also happened, that big relief to the equity markets as well. So I would agree that there's, I mean, whether by Diwali or not is to be debated, Lata, but there does seem to be a very nice setup in equities for a bit of a catch-up to where global equities.
Okay, at least in 25 also we may expect.
Yes. The risk, I would say, is a global equities correction. This assumption that we are immune because we are domestic and we have demographics, that never works out in the short term. If you see S&P take a leg down, a noticeable one, or EM, then Indian equities will also come under that pressure. So outside that global risk, the Indian standalone setup for equities looks actually favorable to me.
Fortunately, not showing any signs of.
And I'll just say 30 seconds. A lot of this is just AI growth. Because I now look at Asia, you can just look at the surging Taiwan exports. This is all AI driven by the hyperscalers in the US. We know that in the last 3 quarters, 40% of US growth has come purely from tech equipment investment. So you could have this dichotomy in the coming quarters where printed GDP growth in the US is strong. It's still 3% in this quarter because you're getting all these AI investments, but they're highly capital intensive and there's no spillover from this to the labor market. So you could have a jobs market recession where consumption is very weak, but there's a lot of equipment tech investment, and so the GDP numbers are very strong. And I think that's what's driving the pressures.
Seems to be the case.
Yeah, exactly.
Seems to be explaining all the numbers.
Exactly.
Quick, one sentence, difficult question to both of you. Have you heard FIIs turning their view?
I would say that the tone of bearishness that we lived through in three months ago has dissipated. Right, so nobody is overtly bearish and say, okay, look, I have no time to spare. But
Sajid,
cautiously optimistic on the domestic
fund. You heard them say that?
Cautiously optimistic, still waiting for resolution on the external trade deal.
Okay, so that's everyone's looking at the trade deal. Well, that's an interesting, a very enlightening 360-degree perspective of markets and macros. Thank you very much, Sajid and Sanjay, and hope you have a great conference out there.
Thank you.
Thanks very much.
That's it on this special Market Masters. Thanks for watching.
Hello and welcome. You're watching News Center and I'm Parikshit Luthra. With 4 days to go for the GST rate cuts to take effect, Finance Minister Nirmala Sitharaman has urged the Indian industry to shed any hesitations and boost investments quickly. Speaking at the symposium of the Indian Foundation for Quality Management, the Finance Minister said the government has delivered ease of doing business and it hopes that the industry won't be reluctant to increase capacity and manufacturing. She emphasized on the need to address human resource gaps, adding that the private sector should partner with the government on skilling initiatives.
I hope there's no more hesitation for industry to invest further, to expand capacities, produce more in India. And what else is required by the government to do? Spell them out. You have a Prime Minister in this country who you have known for decades, from his days as Chief Minister of Gujarat. And he's never relented on reforms, nor has he ignored the wish list of the industry.
If India is to achieve its goals of economic, social, infrastructure and inclusive growth, the main purpose of Viksit Bharat, then we need to be working closely with the vision of the Honorable Prime Minister in multiple dimensions. And we are doing this at a time when the world is going through several challenges in terms of macroeconomic stability.
All right, let's move on and get you a CNBC TV18 exclusive now. Samvardhana Motherson Group's chairman Vivek Chand Sehgal has said that he's unperturbed by tariffs or any other headwinds. Sehgal also told me that every segment of the company is showing growth and that the group is ready to enter any sector where there is customer demand. According to Sehgal, the Motherson Group is a not yet company. And the reason why he said so was that whenever they are asked whether they are in any sector, and if they're not, they always say not yet, because they're always open for future challenges. I began by asking him about the Finance Minister's appeal to India Inc. on increasing capacity and increasing investments.
I think all these things are very welcome, and we are grateful that these particular thoughts are coming into the government's mind and they're taking action on it. So I think it's going to augur very well for the Indian industry, I'm sure.
Right. Now, in terms of the Motherson Group, you've laid out a very ambitious 5-year plan of $108 billion in revenue by 2030. What are going to be the levers or the pillars of that growth?
I think India is going to fast propel into a 5 trillion economy, as the Prime Minister has laid out. The group per se is going to focus on the issues that are at hand. What all we need for our group to achieve its target. You see, in Motherson, every 5 years we come out with an audacious 5-year plan. And of course, everybody is very excited about it. People tell us that it's not possible, but we make it possible. I think every 5-year plan, right from 95, when we just listed our company, from $2.14 million as turnover, we've gone to now 25.7 billion. So I think the idea to dream, the eyes open, and then go for it. I think the levers are many. We have automotive by itself. It's going to be a big thing. People are wanting more and more alternatives. And I think one of the key things that we have announced this thing is that a lot of the car makers are asking us to set up manufacturing plants for them. But manufacture not in a sense of big numbers or something. These are niche areas where they want the car to be produced. And so why not? We can assemble machines, we can assemble the components, we can assemble a car, why not?
So when would you be looking at starting the assembly or manufacturing of cars?
The moment the customer gives us this thing, we'll go ahead.
So you're ready to start as soon as possible?
Yeah, whenever. Why should it take time?
Okay. Any announcement there which is on the horizon?
No.
Not immediately. How are you navigating these global headwinds? The US tariffs, 50%. There is, of course, trade negotiations going on with Europe as well. But how are the trade uncertainties impacting you?
So Motherson has been very focused that if we are exporting more than 10% of our turnover, then we will go into that country. We will stop the exports. We want to export, we want to make it in that country. So we're in 44 countries. We have more than 450 plants all over. So I don't need to export, otherwise I'll be taking all the export awards.
Right. You've often said that you prefer acquisitions than joint ventures because it gives you complete control on the technology and running the company. Could you give us a sense of the future acquisitions that you may be looking at? What sector or what aspect of the automotive or manufacturing industry would you like to focus on? Because today Motherson is not just into automotives, you're into aerospace, you're into semiconductors and other sectors as well.
I think, first of all, we are a not yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it. So we're an open-minded company. We go for those particular challenges which the customer poses to us. I think it's very important to understand what does the customer need. And the customer decides and tells us and we go for it. Same in acquisitions also. We have never got up in the morning and said, today I'll buy this guy and that. No, that's not us. We wait for the customers to tell us they want a particular thing to be made and to top quality. So we do that. So we've done 44 acquisitions up till date. And we think it's a better way than joint ventures because you own the technology, the patents and everything come to you. And the first thing we do is to bring one part of it, that company into India so that we can have a global offering to all our customers over there.
Right. You're targeting an increase of more than 4x in gross revenue by FY30. If you can help bifurcate between the auto and non-auto contribution to this.
Why should I? The thing is, whoever is growing, every company, every segment is growing. Right. So why should I give a boundary to them? It's an open target. Go for it.
Right. If I ask you about your investment plans over the next 5 years, when you have these ambitious targets, could you give us a sense of the kind of capex that you're looking to deploy and how do you plan to use it?
Watch the show. Ibtida'i ishq hai, hota hai kya? Aage dekhiye, hota hai kya? So I think we had a investor conference. We actually laid out what the thing was. I think you guys were also there. So they know that there are a lot of segments in the Motherson group. They will come out. They will arrange for money themselves. Why not? So more companies, more excitement on the cards.
Right. Any other demerger that we can expect? You've spoken about value creation with companies like Motherson Wiring in the past.
Yeah, I think that was a very important experiment that we did in the last 5-year plan. Taking a company out and then understanding how the ecosystem works on that was very exciting. And we have many companies which are already in the line to demerge. So not taking too much out of the excitement of the future, but you just watch. It will all unfold very quickly.
Right. My final question to you, sir, would be about how do you think the industry is poised to grow from here? What are some of the near-term challenges and the near-term tailwinds, according to you, which the industry needs to address?
See, I don't know about the industry. I think everybody is taking care of what their need is. But Motherson is not worried about challenges and all that because every time a challenge has come, like Lehman crisis, we doubled our turnover. You have anything that's going wrong, today people are talking about tariffs and things like that. We think these are opportunities. You have to take the ability to take the wind into your sail. That's the way to go, I think.
And speaking at the same event, Tata Steel MD and CEO TV Narendran said that the global environment for the steel industry remains challenging. However, he added that the demand in the Indian steel industry has been comparatively less vulnerable. Joining us right now is the Managing Director of Tata Steel, Mr. TV Narendran. Mr. Narendran, thank you so much for joining us. Could you give us a sense of whether Tata Steel is well on track to achieve its growth targets for FY26 in terms of both revenue and production?
Yeah, I think we are, because key to that was the Kalinganagar expansion, which is pretty much completed. We are ramping up as per plan. So I think we are well on track for that.
Right. In terms of the global headwinds, how does the export picture look like right now?
Globally, for the steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month. And oftentimes at prices at which they themselves don't make money. So it's very difficult for anyone to compete with that. But luckily for the Indian steel industry, the demand growth in India has been strong. So we've been less vulnerable to what's happening in the global markets. The additional capacity that many of us have built in India are being fulfilled, being taken care of from the demand that there is in India. But if we were to export, yes, it would be challenging.
Right. I would also like to ask you, while the Steel Secretary has also said that the impact of US tariffs on India has been minimal as far as the steel industry goes. But overall, what is your expectation and wish list from the trade negotiations in order to protect the interests of the domestic steel makers?
I think, like the Steel Secretary said, India does not export much steel to the US because US traditionally has been a difficult market to export into simply because of the trade actions that they take. You know, so for instance, we used to export steel 30 years back to the US and they're very quick on anti-dumping and safeguard duties. So you don't see much steel exports going from India there. But I think there's a lot of engineering exports which goes there. Steel consuming sectors export into the US. So when we look at the trade negotiations, we are more interested to see what is the benefit it brings to our customers and hence the indirect benefit it can, that can come to us.
Right. On the EU negotiations, they're looking to conclude negotiations by the end of the year. The EU in its vision document, which has come out yesterday, they said that EU is simplifying the CBAM and any carbon price paid in India will be deducted under the CBAM final adjustment mechanism. Do you feel that this will address the worries around CBAM to a great extent?
I think this mechanism was there and I honestly think that is what we should leverage because asking Europe to remove CBAM becomes very difficult because they are only, charging importers the same carbon tax that they are charging on domestic players. So for them, it's not just a trade issue, it's an industrial policy issue. And we should recognize that. So they can't just address it through removing it for trade because then they have to take action for steel producers in Europe. But this is a mechanism which is available saying that if you are paying a carbon tax in your host country, then you can take the credit for that. So that's a suggestion in the past we have put up to the government saying that if you were to then do that, and you can create a fund which companies can draw into for transitioning into green or do various things with it, rather than pay the tax in Europe, pay the tax here and use the tax for the benefit of the Indian industry.
Right. My final question to you, would you have any asks from the government at this point in order to safeguard the interests of Indian steel makers?
See, Indian steel industry goes to the government only when we see very unfairly priced imports because, it's only when steel comes into India at prices at which the suppliers don't make money do we say that it's unfair, right? Otherwise, Indian steel industry is very competitive. We have some of the latest steel plants in the world. It's not just Tata Steel, all our peers as well. So I think from an Indian steel industry point of view, the ask of government is continue to spend on infrastructure, which they're doing, address the cost and ease of doing business, which they're doing, and give us some support whenever we see unfairly priced imports, because we should recognize the fact that the steel industry is been one of the leaders of private sector capital investment. I think between us and our peers, we are investing at least 40,000-50,000 crores a year, which is more than most other sectors. So it's an industry which I think needs to get nurtured. India is blessed with a lot of iron ore, and we need to see how to add more value to that iron ore, create jobs, create investments, and I think that's what the steel industry has for.
All right. Thank you, Mr. Narendran, for joining us.
Thank you, sir.
All right. Time now for a short break, but up next, an exclusive conversation. Salil Gupte, the president of Boeing India and South Asia, spoke to me about the AI 171 crash investigation and also Boeing's endeavor to deepen the manufacturing partnership and sourcing partnership with India.
Sources are indicating to CNBC TV18 the broad intent in the government is to reducing the rates, and it is likely to propose to keep as many as commonly used items in the 5% slab. What we are given to understand from sources is the fact that the industry has written to Finance Ministry seeking some key changes in the GST structure to expand the tax base. Well, in what could be a major overhaul of India's indirect tax regime, the government is likely to propose a simplified three-rate structure in the GST regime in the upcoming GST Council meeting, potentially eliminating the 12% slab.
The government is considering GST relief for a slew of sectors, including textile and the medical sectors.
GST Council meeting on 3rd and 4th of September will have to give an approval paving way to what PM mentioned to a two-slab structure, that is 5% and 18%, and a special rate of 40%. Well, the upcoming GST Council meeting on 3rd and 4th of September is likely to see a major GST overhaul, especially trying to give a consumption boost to the domestic economy. Firstly, a unanimous decision moving from a four-slab structure to a two-slab structure and a special rate, 5%, 18% to kick in from 22nd of September.
I'll give you this number which is important. 99% of all the goods and services which are touched by GST are now either in 0 or in 5 or in 18.
Welcome back to News Center. The head of Boeing in India says the aircraft maker is still assessing the impact of tariffs. Speaking to me earlier today, Salil Gupte said he remains optimistic that the India and the US could find a way forward to resolve the tariff issue. I began by asking him about the latest on the Air India crash probe and also the suit that has been filed against families of the victims of the crash against Boeing and Honeywell for negligence.
Certainly, the AI-171 accident was heartbreaking for all of us at the Boeing family and, of course, our customers at Air India as well. And during this period, we've been actively supporting Air India, our customer, and supporting the investigation. Because we're an active participant in the investigation under the United Nations ICAO rules, it's very, very specific that only India's Aircraft Accident Investigation Board can give updates and comment on how the investigation is going. And so we expect that the AIIB will continue to do that.
Right. To ask you about the current geopolitical situation and how it's impacting Boeing, especially your operations in India, what's the way out of the tariffs? What's been the impact so far?
Well, we're certainly continuing to assess the impact and potential mitigants, but what I can say is that we remain optimistic that because the U.S.-India relationship has been so strong and has gone from strength to strength over the last 20 plus years, that the two countries will find a way forward that enables trade to continue and collaboration on the industry front to continue. And we see the two leaders, President Trump and Prime Minister Modi, giving some positive signals about that over the last few days. You know, as it relates to aerospace, and this has been true throughout the world in aerospace and defense, regardless of what the various tariff regimes are, we have always advocated for what we call zero for zero in terms of tariffs. That in aerospace and defense, zero tariffs are the path forward because aerospace is such an important part of both infrastructure and national security. And whether you look at some of these other deals like Europe and the US and other nations in the US, you've seen that. And so we hope that that continues to be the case between the US and India as well. And so we'll see what happens in the weeks to come.
Right. But what's been the impact on the business so far as a result?
Well, certainly right now, you know, in terms of financial impact, that continues to be under assessment. But in terms of decisions on what we are going to do from a sourcing and industrialization standpoint of India, we are more adhering to the joint statement of Prime Minister Modi and President Trump from February, where the two leaders came together and indicated that it is in the interests of the U.S. and U.S. industry to continue to grow industrial base in India, that is helpful to U.S. national security, and that is helpful to both countries. And the reason for that is that Boeing is America's largest exporter, right, and we are especially a significant exporter and a significant part of overall trade between the U.S. and India, with several $1 billion per year of exports in terms of aircraft and other services to India. At the same time, we have a significant industrial base here in India that we have developed under the auspices of the joint statement support between the U.S. and India. So as a result of that, we're a good example of synergy between the U.S. and India in terms of how we can create a win-win situation. We're going to continue to pursue that and then hope that the two countries can work out the tariff situation in the next few weeks.
Right. Just to ask you about the defense partnership, we learned that a Boeing team was here in India to speak about the sale of more P-8I maritime surveillance aircraft. Could you give us a sense of the defense partnership between India and US and whether we could see a significant impetus for this in 2025?
Well, certainly the defense partnership between the U.S. and India has blossomed over the last 15 years. You've got the foundational agreements that enable the two militaries to work together and interoperate more closely. You've had participation in joint exercises over the years. And of course, you've had almost $25 billion US, almost 2 lakh crores plus of acquisitions from the U.S. By Indian Defense Services. All that being said, we believe there is an opportunity to do more, and we know that the expectation of India is that U.S. companies like Boeing participate in co-development and co-production. As I mentioned, the joint statement of this past February between the two leaders supports U.S. companies taking part in co-development and co-production. And we believe that Boeing is extremely well positioned to do that because of our engineering capability here in India and our supply chain here in India that allows us to pursue those deals. So whether it's more aircraft coming over like the P-8, which is a foreign military sales deal, so that's between the two governments, or co-development and co-production, we're here to support.
All right. My final question to you would be your plans to probably grow your sourcing, your manufacturing in India, and also if there were certain reforms or asks from the government, what would be your recommendation?
Well, certainly on sourcing, as I mentioned, we are here to support the co-development and co-production goals in India. And so our sourcing will largely be aligned with those goals and those deals that we will pursue. And so we have a number of things that we've announced already with Indian partners. For example, our pursuit of semi-submersible maritime patrol equipment, and this is in the unmanned space, where we've announced a partnership with Sagar Defense under the auspices of the National Security Council of the U.S. that was here earlier this year. Those kinds of things we will certainly industrialize. We've led the way so far. We believe we will continue to do that here in India. As it relates to what more can be done, certainly we're all very pleased to see the reforms on GST just in the past couple of weeks. There's an opportunity for more there. For example, air turbine fuel or jet fuel, as it's known throughout the world, we believe that can be brought under GST next. That would give a huge fill-up to the aviation industry and enable our customers, the airlines, to be globally competitive in the long term. So that's a terrific example. Additionally, incentive schemes for manufacturing and research and development for MSMEs and other Indian companies will allow that supply base to serve not only India's needs, but the needs of the global supply chain. So we think there's a lot of opportunity.
All right, Salit. Thank you so much for speaking to us. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
You're watching us here on a very special conversation. His first ever television interview. We have Praveen Someshwar, who is obviously the MD and CEO of Diageo India. Praveen, thank you so much for joining in. And before I speak about Diageo, I have to ask you, what is it about PepsiCo leaders who make such a big dent in the world of consumers? I mean, there are so many right now. You have Varun Berry, there's Sunil D'Souza, Pratik Pota, all of them. What is in the water of PepsiCo?
First, lovely to be on your show, talking to you. PepsiCo is, you know, as I say, it's not only India, it's global. It's a factory which brings out great talent. And what they do, I think, wonderfully well is they get talent in and shape them constantly and reshape them so that when you leave PepsiCo after, and typically most of these leaders would have spent 15, 20 years within the organization, they've gone through every phase and therefore build it out.
And now, you know, you're here at Diageo. Speaking about Diageo itself, you know, look at the previous leader tenures. You have Anand Kripalu. At the time when he took over, you obviously had to, you know, move away from the legacy issues of Diageo. So there was a lot of course correction that took place during his tenure. Thereafter, there was Hina Nagarajan. During that time, the margins improved. The policy environment was fairly benign as well. Now comes Praveen Someshwar. The question is, at a time when competition is high, regulatory environment is uncertain, and at the same time there is, you know, this overall macro trend of people wanting to move away from alcohol. What is your strategy going to be over the next, say, 3 to 5 years?
You spoke about Anand and Hina. Absolutely great lineage. I think they've done wonderfully well for the organization. And you can see the momentum in the organization. You know, it just speaks to volumes about how Diageo has embedded the business in India and how these leaders have done phenomenally well. So that's my first point. So I think they made my task easier. That's how I put it. And therefore, they have future-readied the organization to embrace competition, to embrace the regulatory landscape so that we can... The way I look at it is, look, there are 3 key pillars as you build out businesses. And if I were to look at Diageo India, equally exciting. One is, how do you future shape our portfolio so that we can win come what may, given with the consumer? That's number one. Number 2 is, how do you embed Diageo in society and therefore win with society at large versus winning only as Diageo? And 3, how do you create an organization of the future and constantly look at it? India will be the consumer market of the next decade, as I see it, okay? It's got its ducks in a row. In spite of everything going around the world, look at the demographic of the country. Look at how the middle is growing. Look at GDP growth. And that's a great place to be running a business. That's my first. Second, look at Diageo's portfolio within the country. Powerful portfolio, 3,000 crore brands, 500 crore brands, 400 crore brands. Wow, you know, 7 million case brands. This is of scale. We are amongst the top 10 equity brands. We have 5 of them within Diageo. That's a powerful space to be in. And finally, it's about innovation. Okay, how we are embedding innovation within the organization. You can see us investing in our R&D, investing in talent around it. So it gives me, a clear, opportunity for us to unlock the future portfolio.
So 5 years from here, if you look at Diageo, what do you think could some of the parameters be? I mean, how would you look at or measure your success? Would it be the number of cases that you sell? Would it be revenue? Would it be margins? Would it be the profitability?
Look, when you started speaking to me, you spoke about PepsiCo.
Yeah.
Okay. The way you remembered PepsiCo is not about the scale of brands, not about the growth engine.
Also because it's not listed in India, so Diageo, you have to think about
that. But it's about the people.
Yeah.
I think how do you, the core for us is how do we embed ourselves in society and participate in Viksit Bharat, okay, as we unlock this magic. And if we were to participate there, you need to grow double digit at minimum. You need to obviously do it in a profitable manner. You need to obviously create a portfolio of the future, which therefore builds on the occasions as the Gen Zs as well as millennials start growing up on. If I were to look at it at 2030 and look back, we'll need to measure ourselves against each one of them. And we'll look back and say, wow, there is more talent coming out of Diageo. There is more growth coming out of Diageo. There are more consumer occasions owned by Diageo. That's what will make it exciting.
5 years from now, you're saying double-digit growth that comes by. I suppose 64 million cases is what you did last year. If you go double-digit over the next 5 years, you're not too far away from over 100 million cases. Would that be a goal? And your margins, obviously you spoke about high teens having been achieved. Large part of that is also capped because of the 10% BIO margins. So I suppose around high teens, maybe touching 20, 21%. Would that be a goal for you?
The way I'd look at it is, I think premiumization is real in India.
So then do you look at volume growth or do you look at revenue growth?
I constantly look at value because the way I look at it is consumer in occasions. How do I get a share of the occasion? And how do you grow that share of that occasion? And that occasion share, I would love to see volumes and therefore consistently grow. But more importantly, how do I keep premiumizing and grow, look at value? So I would look at value growth constantly. That's been my yardstick in whichever business I have been.
Got that.
So I am looking at double-digit revenue growth. Got it. Absolutely. And yes, as we grow margins ahead of revenue, you will see that inching upwards. I'm not going to say is 20 good or 21 good or 19 good, but what I'm very, very clear is double-digit revenue growth in our P&A segment so that we are consistently winning and our margins improving further than that. And that's going to become, we are already roughly $1.5 billion in terms of revenue. At a double-digit growth CAGR in 5 years, that's an exciting proposition.
There could be some speed bumps along the way. The speed bumps would obviously be from the regulatory environment. And let's go state by state, and let's do this as rapid fire as we can. Maharashtra, 30 to 40% price increases. How do you deal with something like that? And what's your plan here?
India is 25 different markets. In each of these states, the framework is a little different. And we've seen over a 3 to 5 year cycle, each of the state goes through some exciting tailwinds and some headwinds. Right now, yes, Maharashtra, we've seen some regulatory action, which has resulted in roughly a 30 to 35% in an increase in price. Our duties have gone from 300% to 450%. But look, this is the reality. It's been roughly to today, what was the date? Yeah, roughly around 70 days from the new regulation.
Yeah.
And we've seen 40 days of the new pricing in the marketplace. We've seen consumer spend grow by mid-teens to high teens.
Not that.
What it tells you is that, look, we took a 30 to 35% increase. Our brands are strong enough for consumers to start up pricing and up paying up. To be revenue neutral or volume neutral, you need to grow consumer spend by 30 to 35%. Yes. We're still some distance away. But in the normal course, mid-teens to high teens is an exciting space. I would take that any day. So it tells me that, look, in terms of we seeing growth, we're not seeing translation into volume growth as yet. But every day ahead, I see this improving. And I see in the next 6 months, people from Maharashtra wanting to start to trade up. I am very, very optimistic. I know it's not a rapid fire answer.
No, that's absolutely fine.
But that's how I see overall Maharashtra in balance.
Wonderful. Let's go across to the tailwinds then. UP, I mean, the number of outlets have nearly doubled. So has that reflected in the kind of sales, or have your sales grown faster than the number of outlets that have come by?
There are lots of markets which have seen tailwinds. There's UP. There's Jharkhand.
Yes.
Okay, I can keep going on.
Please
and
keep
on.
going on.
Okay, that is Madhya Pradesh, which has Jess on. There is Rajasthan, where there's great momentum. There's Orissa, where there's great momentum. There's Karnataka, which did some rationalization last year, and therefore we are seeing. So there are lots of tailwinds, and that's the exciting part. Yes, in each of these states, different portfolios are. So India is very uniquely positioned, as I say. They are very different markets. And within that market, as I say, there are 3 Indias. So depending on which state, what triggers it, we're seeing different levels of value growth. And so UP, yes, access has doubled, and that's exciting, I think. And therefore, we are seeing our business grow. But we are seeing our business, we are constantly, even in rural UP, we are starting to see premiumization come into play.
Got that.
That's exciting to me. And as we look at it, we are constantly not looking at volume, as I say. We look at value, and we are seeing very, very healthy value growth.
Let's speak about Andhra for a bit, because the policy change obviously caused a lot of tailwinds, and now as we move towards anniversarization of that, we'll watch out for how that pans out too. But is it more than just this policy that has changed? Crown feelers suggest that they're a lot more amenable now, they're a lot more willing to listen, and it's a lot more favorable than what it ever was?
Look, like any other market in India, when you start unlocking policy, you start seeing the consumer respond. And we are seeing the same thing in Andhra Pradesh. People look back at Andhra Pradesh a year back and say, oh, you got your growths because the market opened for you, because there was policy change. Absolutely right. But if you see it between last October to this July or this August, we are seeing a tailwind of growth of brands. To begin with, it was at the lower end, but now, because you have democratized access, you made sure that our larger portfolio is available, you're starting to see premiumization come into play. And that tends to say that what you'll be surprised, as you said, at the end of a year, will you continue to see growth? And I could see the hidden question around it. I think you will see very robust growth in Andhra Pradesh as we go year on year, because the premiumization journey is kicking in as policy has become more progressive.
I ask this from an investor's lens right now. If you're looking at the entire Alcobev sector, you had a couple of listings in the recent past. People who've raised money from the markets, etc. They've been showing good growth. There has been a big deal as well. Imperial Blue was bought over by Tilaknagar Industries. So obviously there is that tailwind coming in for that stock. If you look at some of the other wine players, they are looking at some of the assets which are there outside of wine in the brown space, which is 85% of the category. And then I look at Diageo. Yes, it's the market leader. Yes, it's got the largest share in that space. Yes, it's got the highest margins. But at the same time, it's also got the highest PE multiple. So for you to justify that PE multiple, you obviously have to grow faster than the market on that high base with margins which are already at higher than everyone else in the industry. How do you continue to hold that edge?
So, the way I look at it is, are you growing the category? Is the category in momentum? The great news is, yes, we are growing the category is in momentum. Within that, do you have the portfolio to unlock the category space? Yes, we do have the portfolio. Are we now getting higher share of the occasions where our consumers are? Yes, we are consistently starting to get higher shares of our. Are we innovating to build the portfolio of the future? Yes, we are. If each of these are in play, then the virtuous flywheel is in play. So we are in a good place. We feel absolutely excited, and we believe the double-digit growth, which we will see, keeps us ahead of the pack on a sustained basis. There will be quarters when someone else will grow faster or we may go a little slower. But in a reasonable period of time, you will see that we are consistently delivering above market.
So consistency over excitement is what you would bet on?
Consistency is any day something I would sign up for versus one excitable quarter and then. So I would take consistency any day. It's like, the way I'm made up, okay? I don't wake up one fine morning and say, I need to, for the next 10 days, do 2 hours of workout. I will do every morning a 45-minute breakout, and I'll be consistent with it. I'll be careful with what I eat, and that's what keeps me healthy as I see it.
Wonderful. So it's the Rahul Dravid school of thought as against, someone who's just a flash in the pan sort of.
I love the flamboyance, but I would sign up for consistency. As you said, Rahul Dravid is clearly an inspiration.
Speak about Rahul Dravid, the RCB. That is another asset in your portfolio, a very strong, loyal fan base. And thankfully, after a long wait, you guys went ahead and won the championship as well. How valuable is that asset in your overall portfolio?
It's an exciting asset. It's clearly something which is absolutely exciting because cricket is the lifeline of the country. And within cricket, IPL has a play. And therefore, it's an exciting asset. But that has nothing to do with our core Alcobev business. If I get back to, Diageo is about Alcobev. And as I get to it, that's exciting. This was an extension at a point of time. And Royal Challengers became Royal Challenger Bangalore. And therefore, an extension which has now got to scale. And that's an exciting part, as I see.
Not the core part of your portfolio. So do you at some point look at unlocking the value of that non-core portfolio?
Well, I wouldn't get to saying unlocking or unlocking. It's certainly not core. There's no doubt about it. Alcobev is our core, and that's where we focus on our business, and that's exciting. This is an exciting extension, and that's important, and therefore overall.
You can't deny the marketing synergies that RCB gets.
That's why I said exciting and integral to our brand, and therefore an important part of our overall business.
And 15% of your SOTP, sum of the parts valuation of the Diageo share.
Is that right? I didn't know that.
No, but to be very honest, there are murmurs. So
now you're starting to tell me that I need to comment on murmurs. No, we wouldn't.
Perfectly. Take that point. Let's get back to the core business. Then let's talk about your raw material inflation. You said that, there would be some disruption in glass bottles over the next couple of quarters, but over the longer period of time, it is pretty manageable. And you guys are looking at, alternates to that as well when it comes to packaging. But ENA, that's on a structural uptrend. And the new policy, everyone's talking about 20%. At some point, it becomes 30% as well. How do you navigate through that? And what is your view on the raw material inflation in the very near future, medium term and long term?
Look, inflation is real first. Okay, we will see some inflation. Okay, however, we saw inflation over the last 3 years. Look at our productivity machine. Look at our premiumization journey. Look at our innovation. Each of these has added value back. So we have an engine of productivity which is very well oiled, and it's not a one-year proposition. It's a multi-year scenario, and we're constantly creating multi-year productivity programs so that we are ensuring that we negate inflation. But what is more exciting for me is the premiumization journey, and that is unlocking new revenue and therefore margins and our innovation. All of this is helping us grow our margins ahead of our revenue and therefore negate inflation. That's how I would see it. I think inflation is real, but we are well oiled to take care of it through each of these steps over a period.
Let's speak about the whites. Whites, obviously, smaller part of your portfolio, just the way it is a smaller part of the category, but growing very, very fast. I mean, what's the path of growth here in whites, and what are the spirits that are picking pace right now? Because earlier it was gin, then there was tequila, which was picking pace. What's exciting in whites right now?
Look, I think across whites, if you see, there is healthy momentum. Okay, we had a smaller play. We are now starting to expand our play. Okay, very, very clearly. But whites is not only about gin and vodka and tequila. It's about that overall space and playing it as a portfolio, because repertoire is absolutely imperative to the new consumer. But the other exciting part, in my mind, is also about craft brands.
Yeah.
Okay, local provenance and craftsmanship is starting to play out. You are seeing, I just came back from, I was traveling to Guwahati yesterday, and I was seeing some amazingly new, Chirapunji was one of the brands I saw. I saw its packaging and I said, wow, that's nice packaging. So what it's telling you is local craft across the country is starting to. How do we participate in it? And that's what we've done is we've gone and invested in Good Craft Co., which is about innovation, which is about partnering with local startups, which is about partnering with local craft players.
So there are more acquisitions likely on in the craft side?
Look, as I say, partnering is a way of life. I come from PepsiCo, where I constantly partnered. It was constantly saying, how do I multiply the impact on consumer, because you partner with them. What it takes is how we will look at it. But right now, we're building a small ecosystem of way to partner with local craft, which can become future.
Do you have a number in mind, say 5, 10, 15, X% of my portfolio would be from partner brands, say, in the next?
I have a number in mind on innovation.
Which is that?
Which is, over a period of time, I'm constantly looking at whether 1/3 of my growth at least comes through innovation. And that's what I will over a period of time. We are still a little distance away, but as we work on between product, between packaging, and between new trademarks, we have to make this business grow, and that is about percentage of growth through innovation.
All right, final question. 20,000 crore revenue, 20% margins by when?
Oh, I never see it like that. I see it as, hey, double-digit growth and margins ahead of double-digit growth. If we can do that, our stakeholders, and if we can embed us in society, our stakeholders will be excited. Stakeholders are the regulators, stakeholders are our shareholders, stakeholders are our consumers. I look at it 360, so I don't look at it only at 20,000 crores and 20%, but I think it's sooner than later we'll be there.
Perfect. Thank you so much. Always a pleasure speaking with you.
Thank you. Thanks, Mangalam. Wonderful to catch up with you.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. Stocks rise across the world after the US Fed cuts rates by 25 basis points. Also signals 2 more cuts this year and a rate cut next year. Gold sees some profit booking. The Sensex and the Nifty close in the green after a range-bound session. The Nifty reclaims 25,400. Financial stocks lead the rally today.
I hope there's no more hesitation for industry to invest further, to expand capacities.
With 4 days to go for GST cuts to take effect, Finance Minister Nirmala Sitharaman exhorts that industry must increase investments quickly, says the government hopes there is no reluctance to increasing capacity and manufacturing. Marauti Suzuki passes on the GST cut benefits, cuts car prices by up to 27% with effect from the 22nd of September, also offers additional discounts, clarifies the discounts will last only for a limited period.
We are a not yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it.
The Motherson Group is unperturbed by tariffs or any other headwinds, says the chairman Vivek Chand Sehgal. Adds every segment is showing growth and the group is ready to enter any sector where it sees customer demand. That's an exclusive. Apollo Tyres pads up as the new lead sponsor for BCCI signs a 579 crore rupee contract. Managing Director Neeraj Kavar tells CNBC TV18 they are in it for the long term, says he's not worried about the so-called sponsor jinx. Heavy rains lash Uttarakhand, at least 10 people missing after landslides flattened several houses in Chamoli district. Around 2,500 tourists are stranded in Mussoorie as the road to Dehradun remains closed for the second day. Rahul Gandhi makes fresh allegations against the Election Commission, claims irregularities in addition to the deletion of voters across the country, accuses the Chief Election Commissioner of protecting those responsible. The Election Commission calls the charges incorrect and baseless. Pakistan and Saudi Arabia sign a mutual defense agreement. Aggression against either country will be considered as aggression against both. India's External Affairs Ministry is studying the implications and reiterates its commitment to national security. Israeli tanks patrol the streets of Gaza City as Tel Aviv presses ahead with its ground offensive. Reports say the Israeli army continues to force thousands of Palestinians into the overcrowded south and central Gaza. Israel's far-right finance minister calls Gaza a potential real estate bonanza, says he's actively engaged in talks with the US and how to divide it up. President Trump meets UK Prime Minister Keir Starmer at Chequers Estate. This comes a day after a royal reception at the Windsor Castle. Tech investments, steel tariffs and geopolitics top the talks as part of the agenda. Facebook's parent Meta launches new smart glasses in partnership with Ray-Ban. The glasses will cost $800 and come with an inbuilt display. Is it worth your money? A product review coming up. Well, let's start with the global market action. Stocks gaining across the world after the US Fed delivered that widely expected rate cut for the first time in 9 months. China's Shanghai Composite was an exception, though, as investors booked profits there. Now, the Fed's quarter percentage point cut takes the rates to the range of 4 to 4.25%. Recently appointed Fed Governor Stephen Moran, backed by President Trump, was the only policymaker who advocated for a 50 basis point cut. The Fed also penciled in 2 more cuts before the end of the year. However, Chairman Jerome Powell warned of signs of weakness in the labor market. The S&P 500 ended a little changed on Wall Street at closing bell, so the markets had already priced in that 25 basis point cut. But on the large street, the Sensex and the Nifty closing at the highest level since July after what was a range-bound session. The Nifty reclaimed the 25,400 mark. That's where it finally closed for the day. The Sensex also closing about 320 points higher. The Nifty IT index up by over 300 points, and Pharma putting on about 1.5%. So strong moves coming in there for the IT and Pharma stocks. In the money market, the rupee weakened against the dollar. $1 costs more than 88 rupees as things currently stand. The dollar index regained some momentum from the 7-month lows after the commentary from the US Fed hinted at some caution on potential rate cuts. But the top story this evening, the GST rate cuts are set to take effect in the next 4 days. Finance Minister Nirmala Sitharaman encouraging industry to boost investments. Speaking at a symposium of the Indian Foundation for Quality Management, the Finance Minister said the government has delivered the ease of doing business. It now hopes that there won't be any reluctance to increase capacity and manufacturing. Here's the Finance Minister.
I hope there's no more hesitation for industry to invest further, to expand capacities, produce more in India. And what else is required by the government to do? Spell them out. You have a prime minister in this country who you have known for decades, from his days as chief minister of Gujarat. And he's never relented on reforms, nor has he ignored the wish list of the industry.
If India is to achieve its goals of economic, social, infrastructure and inclusive growth, the main purpose of Viksit Bharat, then we need to be working closely with the vision of the Honorable Prime Minister in multiple dimensions. And we are doing this at a time when the world is going through several challenges in terms of macroeconomic stability.
Globally, for the steel industry, things continue to be challenging simply because China continues to export 9 to 10 million tons of steel every month. And oftentimes at prices at which they themselves don't make money. So it's very difficult for anyone to compete with that. But luckily for the Indian steel industry, the demand growth in India has been strong. So we've been less vulnerable to what's happening in the global markets. The additional capacity that many of us have built in India are being fulfilled, being taken care of from the demand that there is in India. But if we were to export, yes, it would be challenging.
India's largest car maker, Marauti Suzuki India, has announced price cuts of up to 1.3 lakh rupees. The new prices will come into effect from the 22nd of September when GST cuts come into effect. The company has also offered additional discounts. It said that these discounts are for a limited period and the prices will be reviewed by the end of the year. Sudarshan standing by to take us through what Marauti has put on the table. Sud.
It's a big price cut that biggest car maker of India, Marauti Suzuki, has announced. The price cut is as high as up to rupees 1.30 lakh or say up to 27%. It's much more than the GST rate cut because most of its cars have come into 18% slab from the earlier slab of 28%, and that's the reason it has given the additional discounts also, and saying the additional discounts that it's providing, it will be for the limited period and company will review again by the end of the year, and the cut is maximum for the entry-level segment where it's in the range of 12 to 27%, while for mid-level cars and SUV cars, the cut is in the range of 2 to 14%. Why the big cut has been given for entry-level segment? Company is saying there is need for compelling offerings to upgrade two-wheeler customers to four-wheelers, and that's the reason it has given the bigger discount. And the impact, company is saying that for the next 2 months, sales should not be seen, but going forward or say by the next year, it believes that market will bounce back to the CAGR of 6 to 7%. We'll have to see how the next few months pan out, but most of the brokerages after the recent GST cut have increased the growth outlook.
Sid, many thanks. On to a CNBC TV18 exclusive. The Motherson Group's chairman, Vivek Chand Sehgal, has said that he is unperturbed by tariffs or any other headwinds. Sehgal also said that every segment is showing growth and the group is ready to enter any new sector where it believes it sees customer demand. Sehgal also added that Motherson is a not-yet company. Here he explains why.
More than 450 plants all over. So I don't need to export, otherwise I'll be taking all the export awards. We are a not-yet company. That means if you ask me, are you producing this? And if I'm not, I won't say no, I'll say not yet. Because some customer or somebody will ask me to produce it. So we're an open-minded company. We go for those particular challenges which the customer poses to us. We've done 44 acquisitions up till date. And we think it's a better way than joint ventures because you own the technology, the patents and everything come to you.
A not-yet company, says Vivek Chand Sehgal there of the Motherson Group, as they get ready to possibly deliver cars as well. Assembling cars is something that the company has spoken of getting into. The head of Boeing in India says aircraft maker is still assessing the impact of tariffs. Speaking with Parikshit, Salil Gupte of Boeing says he remains optimistic that India and the US will find a way forward to resolve the current tariff issue. Take a look.
We remain optimistic that because the US-India relationship has been so strong and has gone from strength to strength over the last 20 plus years, that the two countries will find a way forward that enables trade to continue and collaboration on the industry front to continue. And we see the two leaders, President Trump and Prime Minister Modi, giving some positive signals about that over the last few days. We believe that Boeing is extremely well positioned to do that because of our engineering capability here in India and our supply chain here in India that allows us to pursue those deals. So whether it's more aircraft coming over like the P-8, which is a foreign military sales deal, so that's between the two governments, or co-development and co-production, we're here to support.
Well, that's Boeing. The vice chairman of Apollo Tyres says he's confident the company will break the so-called sponsor jinx when it comes to the Indian cricket jersey. Remember, past sponsors like Byju's, Dream 11 and Sahara have had a terrible innings. Neeraj Kanwar of Apollo Tyres has told CNBC TV18 the firm has very strong foundations and it's ready for the long haul. This comes after Apollo Tyres signed a 579 crore rupee contract with the BCCI to be the jersey partner for a 2.5-year period till March 2028. The deal covers both the men's and women's jerseys across all formats.
So I don't look at a 3-year span, I look at it a much longer term, because whenever Apollo has tied up with someone, for instance, and the writing is on the wall with Man United, this is our 13th year with United. So it's been a long journey with Manchester United. So that's a real live example to tell you that once Apollo collaborates with such a big brand, which gets a nation the pride, Apollo will stay. It's a long term, it's a century, and centuries to come.
Well, that's Apollo Tyres there on breaking the jersey jinx. On to the latest developments in the Dharavi redevelopment project in Mumbai. Setlink Group, which lost out to the bid to the Adani Group, has launched arbitration against the Maharashtra government in the United Arab Emirates. Setlink has also moved the Supreme Court in India, challenging the government's decision to award the contract to Adani. Ashmit joins us now to take us through what has transpired in this matter. Ashmit, now the initiation of
government to the Adani Group continues to see fresh legal disputes. Seychelles-based Setlink, a consortium of developers which was competing with Adani for the very same project, now we understand has initiated arbitration proceedings. And these arbitration proceedings are aimed at the Maharashtra government. They've been instituted in UAE, and Setlink, as a part of these arbitration proceedings, is essentially saying that they were shortchanged as a part of this entire bidding process. Bear in mind, there was a first round of bidding done in 2018 where Setlink had emerged as the highest bidder with a bid of over 7,000 crore rupees. However, that bidding process was scrapped entirely. The conditions were changed. The conditions were tweaked. There was a second round of proceedings that were done in 2022. And in 2022, Adani emerged as the top bidder with a bid of 5,069 crore rupees. Now, that is something that Setlink has objected to, saying that this would be a first case where a state government is willing to settle for a lower bid, saying that their bid was much higher, that even now they're willing to go higher and go beyond 8,600 crore rupees. Also mentioning that this entire reason there was tweaking of conditions was done specifically to suit Adani, that this was done at the expense of Setlink, and that there are extraneous reasons why the Maharashtra government seems to be supporting Adani as far as this redevelopment project is concerned. Nonetheless, Adani has defended its position, saying that above and beyond their bid, they also have obligations which add up to over 3,800 crore rupees. So this essentially marks twin proceedings now regarding the same project. The Supreme Court proceedings continue to be underway, where Setlink is challenging Adani's bid. That's one, and now fresh arbitration proceedings in the UAE.
Ashmit, many thanks for joining us. Israeli tanks and military vehicles have entered Gaza City's most crowded residential districts. This comes on the second day of Israel's ground offensive aimed at occupying the area. Israel has said the operation aims to free hostages and defeat about 3,000 Hamas fighters. The overall death toll in Gaza has now crossed 65,000. President Trump met UK's Prime Minister Keir Starmer at the Chequers estate. Talks are expected to be on areas like tech investment, steel tariffs and geopolitics. Trump's visit came a day after he was received At the Windsor Castle, at dinner, Trump said the ties between the US and the UK will endure. King Charles also commended Donald Trump's personal commitment to solving world conflicts. We will head into a break, but coming up next, Facebook's parent Meta gives its Ray-Ban smart glasses an upgrade. Details when we return. Rahul Gandhi has made fresh allegations against the Election Commission. He claims irregularities in addition and deletion of voters across the country. He also accused the Chief Election Commissioner of protecting those responsible. The Election Commission has called the charges incorrect and baseless. The BJP has accused the Congress of trying to malign democratic institutions.
टारगेटेड डिलीशंस हो रहे हैं. कांग्रेस पार्टी पर आनंद में अटैक किया. टॉप 10 बूथ्स जहां सबसे ज्यादा कांग्रेस की स्ट्रेंथ थी वहां टारगेट किया. और 2018 में पिछले इलेक्शन में 10 में से 8 बूथ कांग्रेस पार्टी जीती थी. और इन 8 में से इन्होंने 6000 लोग उड़ाने की कोशिश की. ये कोइंसिडेंस नहीं था, ये प्लान था और ये सेंट्रलाइज तरीके से किया जा रहा है.
आज की प्रेस कॉन्फ्रेंस में हाइड्रोजन बम फोड़ने वाले थे, फुलझड़ी से काम चलाना पड़ा, वो भी फुस हो गई. क्या हो गया? इलेक्शन कमीशन ने बड़ा स्पष्ट कहा है कि नो डिलीशन ऑफ एनी वोट कैन बी डन ऑनलाइन बाय एनी मेंबर ऑफ पब्लिक. ऑनलाइन किसी भी वोट को नहीं काटा जा सकता.
Doctors across Maharashtra under the Indian Medical Association on a 24-hour strike. The protests are against the state government's decision to allow the registration of homeopathic doctors who have completed a certificate course in modern pharmacology in the State Medical Council. However, all emergency and critical services are largely unaffected. Santhya joins us now with more. Santhya, a one-day strike being called. Take us through what is at the heart of this.
Right. So on 5th of September, the Maharashtra government issued a GR Shireen and instructed the Maharashtra Medical Council to start registering homeopathic practitioners. This move will allow them to practice allopathy after completing a one-year course in modern pharmacology. These practitioners will be permitted to prescribe allopathic medicines ranging from your anti-HIV, your anti-TB drugs to steroids, supplements, abortion pills, postpartum medications, IV saline and many more. The issue began in 2014 when the Maharashtra government amended the Maharashtra Homeopathic Medical Practitioners Act and the Medical Council Act. 11 years later, the state government has now instructed the Maharashtra Medical Council to register homeopathic practitioners, effectively allowing them to prescribe allopathic medicines. The Indian Medical Association, IMA, and protesting doctors argue that a one-year modern pharmacology course does not qualify homeopathic practitioners to practice allopathy, especially in treating serious ailments like HIV, TB, postpartum complications, and other critical conditions. They point out that the way pharmacology is taught to MBBS students is very different from how homeopathic practitioners complete their this one-year course, which involves just 2 classes a week.
By just doing a theory course and not going to the wards, not seeing patients, not even applying those medicines to patient care. In our curriculum, when we learn this subject of pharmacology in second year, we are then seeing its application, learning its application to medical patients, surgical patients, ophthalmology, ENT, gynecology, pediatrics. All these specialties have different drugs. The drugs, the medicines can have interactions. So who is going to learn this? Do you think these homeopathic patient people are going to be able to treat them?
On the other hand, homeopathic practitioners argue that they are just as qualified as allopathic doctors to pursue this course, as it is open to them only after completing a BHMS degree and gaining 20 years of practice. They claim that the BHMS curriculum already includes basics of allopathy taught by allopathic doctors, so the one-year course is not their first introduction to allopathy.
It is not a one-year course because Maharashtra government amended this course in 2014 in Assembly that 4 and 5 years BHMS course along with 1 year internship completed doctors and having more than 20 years practice experience are eligible for this CCMP course in MBBS college for 1 year. That's why it is a 5.5 years BHMS along with internship along with 20 years experience. And then we get the course, CCMP course for 1 year in MBBS college. That's why it is not a one-year course.
Well, doctors are on a one-day strike there. The AI chip race is heating up. Huawei has unveiled a new generation of AI chip technology aimed at challenging NVIDIA's dominance. The company says its Atlas 950 supercluster is capable of supporting over 5 lakh of its Zen chips and could be launched as soon as next year. Huawei has touted it as the world's most powerful AI chip cluster. It also plans to roll out 3 new versions of the Ascend chips by the end of 2028. Facebook parent Meta has launched the Meta Ray-Ban Gen 2, which is an improved version of its AI smart glasses. The starting price for this is $379, but is it worth your money? Shibani Gharat sends us her review from California.
Now, I'm at Meta Connect, as you can see, and Ray-Ban Meta Glasses Gen 2 were launched here. I'm wearing it right now. Now, I have been using the Gen 1 of the Meta Ray-Ban glasses for past year almost to take my calls, listen to music and capture videos even during my runs and commute. So, when Meta dropped the Gen 2 today, I had to check them out, and honestly, these are some of the upgrades that I have been waiting for. So first up, what's improved? Battery life. Now, Ray-Ban Meta Gen 1 lasted up to 4 to 5 hours. Gen 2 can give you up to 8 hours plus 50% charging, just 20 minutes. The case carries extra 48 hours. So great for your commute, work commute, travel, and even more. Next, video. Now, I loved my point of view clips on Gen 1 whenever I shot them, but they max at 1080p. Gen 2 brings 3K Ultra HD at 60 frames per second with HDR. Also, later in the fall, companies promising hyperlapse as well as slow-mo on these models. Then, audio plus AI. Still, it's open ear, so you don't have to put anything in the ear, and AI has become more conversational. Live translation is now available in 6 languages, even offline. So hence perfect for travelers. Style-wise, still the iconic Ray-Ban Wayfarer, Skyler and Headliner, plus new colors like Cosmic Blue, Mystic Violet. Some of the colors that I really love. They look like actual glasses and not gadgets. That's like a big plus for me. The price, it starts at $379.
Well, that's Shibani with her Ray-Ban Gen 2 from Meta, clearly enjoying them. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment with more. this looks like the class of 2025, the graduating class of 2025. All of you in your blazers.
Just a bit older.
Did you think that you'd be here one day?
No. I think, when you start, you're really not thinking about these things. You're thinking about survival this week, next week, maximum next month. I remember Raghav, me and Varun, in our first office, drawing out this, who has how much savings, how long will it last?
Has it sunk in? It was a little bit of an emotional moment. I could see, at least on account of Varun getting teary-eyed, but what was it like for the three of you?
It's a feeling of happiness, but also one of responsibility, humility for all the love we've been getting. We had service partners, employees, ex-employees, family, everybody join us today.
So there's about 100 odd people here in Mumbai for the listing?
There's more than 100. We want to be the operating system for your home, the backbone for your home.
When will we see the next product launch, and what could that potentially be?
At some point in time, we may look at the segment of either cleaning or air conditioning. Anything that we do cannot be run-of-the-mill. So just a run-of-the-mill vacuum cleaner or a run-of-the-mill aircon, that, just to increase revenues, that's not our DNA.
In the near term, is the bulk of the investment going to go into native, etc., or into the core business?
So I think it will be a mixture of investments in core, investments in the newer lines we're trying, investments in native.
We are in 3 geographies outside of India. India is the bulk of our business and continues to be the bulk of our focus. We are seeing healthy growth in each of these 3 markets, north of 50% growth, and we are seeing improving profitability.
One of India's most awaited startup listings has hit the bourses today. Urban Company has listed at a 57% premium on the National Stock Exchange at 162 rupees against the issue price of 103. The company has seen its market cap cross 25,000 crore rupees on listing. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2014 to bring structure and trust to India's unorganized home services sector, Urban Company has today grown into Asia's largest tech-led platform for home and beauty services. It operates across 51 cities, including international markets like Singapore, the UAE and Saudi Arabia, and has expanded into new verticals under smart home solutions for native and home improvement with Revamp. The company closed FY25 with net transaction value of over 3,270 crores, revenues of 1,144 crores, and a transacting user base of 7 million, 48,000 professionals under the Urban Company umbrella today to try and create sustainable livelihoods while also attempting to deliver consistent service quality. Joining me now are the co-founders of Urban Company, Abhiraj Singh Bhal, Varun Khaitan and Raghav Chandra. Gentlemen, it's wonderful to have you join us here. Congratulations to start with. And, from 100 square foot office space in Bikaji Kama Place in New Delhi to Dalal Street today. Abhiraj, let me start by talking to you. Has it sunk in? It was a little bit of an emotional moment. I could see, at least on account of Varun getting teary-eyed, but what was it like for the three of you?
I think it's still sinking in, Shireen. I think it's it has been an emotional day. It is it's a feeling like no other. It's a feeling of happiness, but also one of responsibility, humility for all the love we've been getting. We had service partners, employees, ex-employees, family, everybody join us today.
So there's about 100 odd people here in Mumbai for the listing?
There's more than 100. And I think it was heartening to see everybody so happy. So yeah, I think you never imagine this when you start a company, but we're glad that we're here today.
Urban Company is 11, but the two of you have known each other for 2 decades now, 20 years, and that's a deeper, longer association and partnership. Varun, you got emotional today, but what was the feeling or the memory, the core memory that you had while you were speaking today?
A lot of thoughts running in my mind at the same time. Right from times we spent together in college, when we, after college, decided that we need to get together and do something in the service of India over the next many decades, to the many months the three of us spent the streets of Delhi trying to really identify what business we should build that will create large impact in the lives of millions of Indians and be a company that they will look forward to, a company that will make a difference to their daily lives. And then, like a fast forward of the last 11 years, while I was trying my best trying to hold emotions back.
Well, Raghav, you've known them for 11 years as well, and you've of course been part of the Urban Company story from its inception. As you stand here today, what would you say has been the biggest factor for success at scale so far?
I think as a team, we have been known to showcase very strong ownership. In fact, while we were on the stage talking through, it just reminded me how all facets of Urban Company kind of come together, be it our internal teams showcasing ownership when it comes to just doing their best, going beyond what's needed, or our partners who kind of go to customers' homes, just own up the brand, own up the experience. I think that's probably what our decade of building has been at its core.
Well, talking about the decade of building, but now importantly talking about the decade ahead, the kind of reception that you've got from the Lal Street clearly is an exemplification of the fact that people are believers in this story and believers in the fact that there is potential headroom for growth. I know you said that you've got a very strong balance sheet, but you also said that you want shareholders to be patient. Public market patience and private market patience are entirely different things, Abhiraj. So, what are the levers that you're going to exercise now to get to profitability as you've promised?
I think for us, Shireen, long-term growth and long-term profitability is very important. We see our business in parts. There is the very profitable core in India, which is growing well. It has been profitable for the last year or so. It had a 3% adjusted EBITDA margin as a percentage of NTV last year. That went up to about 4% in the first quarter. And I think that core will have to continue to compound well, grow well, and continue to compound profitably. The new segments where we are, which is InstaHelp, Native, I think these are the areas where we will invest. And at the right time, hopefully either in the first or the second earnings call itself, we will come out very, very clearly to investors with how long will that investment phase last, what is the capital we would like to deploy.
But give us a sense of what we are talking about in terms of investments. And let me contextualize this, because what we've seen with other listed entities, now Eternal, Swiggy, and so on and so forth, they're all having to diversify into new distinct businesses. Eternal with Blinkit, and now District, and Swiggy similarly with Instamart and a few other offerings. Is that now a go-to for platforms like yours to really build out these new distinct verticals, these new distinct offerings to keep growth going?
I think for a platform like ours, at our core, we think of ourselves as a home platform. Anything inside your home is definitely relevant for us. The user trusts us to enter their homes, and we don't take that trust lightly. We understand that that trust comes with a lot of responsibility. I think today we are playing in many services, but not the end state of everything we can do. So in the end state, any service in the four walls of your home will very much be part of our ambition and our playing ground. And similarly, we are imagining a connected ecosystem inside your home of devices which have a strong affinity with our service ecosystem and our platform. So more than a services company, we think of ourselves as a home platform, and that's what we're building. It's hard to see it today, but I think over the next 10 years, this will play out. And we want to be the operating system for your home, the backbone for your home.
The operating system for your home, that's a nice tagline that you've given us there, Abhiraj, as far as Urban & Company is concerned. But Varun, let's talk about what shareholders would want more clarity on, the kind of investments that you intend to make in your new businesses, whether it's Revamp or Native, to build out this home operating system that you spoke of. And again, I'll contextualize this with what we've seen happen with Eternal, Swiggy, etc. I mean, Eternal over 3 lakh crores in market cap, Swiggy 1 lakh crores in market cap. You've got a 25,000 crore starting point. What is the runway for growth? What is the aspiration that you see for yourself over the next few years?
As Abhiraj was saying, we think of ourselves as a consumer company. We started by building our services full stack one by one. Now a composite of services is what we call our India home services business. We're adding InstaHelp to that as a new service category because we see phenomenal opportunity there and a big consumer need. Similarly, in Native, we saw a big gap in terms of the durability of existing devices and the life cycle experience that consumers were having. And we do internally discuss and deliberate a lot before we start these new initiatives. We start them in pilots and then build onto them in stages. And our focus across these verticals is going to be to continue to invest in the core building blocks. So in the services business, it is going to be in training and quality of our service professionals, in technology and in continuing to build the brand. In Native, it is going to be on really high quality products, great supply chain, and final end consumer experience in terms of installation and how we take care of the entire 10-year plus that we imagine our devices to be used. And same goes for revamp. Each of them we identify core pillars and keep building on.
What does the product pipeline for Native look like at this point in time? I mean, water purifiers is where it all started, but what could we be talking about? I mean, what could potentially the product pipeline look like as far as Native is concerned, and what kind of investments will you make there?
I think in Native, Shreen, I think we're just getting started. If you think about your home and the potential for an ecosystem of connected devices in your home, which have a strong affinity to our brand, our platform, I think water purifiers and smart electronic door locks are potentially only 2 or 4 or 5 such products that we could build. We will be calibrated. We recognize that this is a new turf. Even though it is related diversification, it's a new territory for us. We have to get it to scale. We have to make it profitable. But if I take a 10-year view, I don't think we will be limited to only water purifiers or electronic door locks. Native, as the brand name says, we want it to be natively integrated into your home, into your life. And also reflecting on your original question, right? I do think as a company, we're only getting started. Like, we're still a small company, Shri. In the scheme of things, that's not lost on us. And, our scale is tiny. It's certainly not enough to satisfy Varun, Raghav, and my ambition. We want this to be one of the most important companies for the Indian home, for the Indian consumer, 10, 15, 20 years out. So while I can't give you very short-term guidance, I can tell you that
you're going to have to get used to giving short-term guidance now, though.
I can tell you that, look, we're we're going to be hard at work, and we're not going to be satisfied until we're at least 30, 40, 50 times larger
So
than we are today.
when will we see the next product launch, and what could that potentially be?
I think for the next couple of years, we will have our heads down on these two only. At some point in time, we may look at the segment of either cleaning or air conditioning.
Getting into manufacturing, air conditioners, vacuum cleaners, all of that, that's potentially the landscape that we're talking about?
I would say if anything that we do cannot be run-of-the-mill. So just a run-of-the-mill vacuum cleaner or a run-of-the-mill aircon, that, just to increase revenues, that's not our DNA. When we want to do something, we want to do something that is distinctly different from what's out there. Otherwise, we'll choose not to do it. The reason we entered water purifiers was we were very clear that we can launch a product that is smart, that is new age, and that needs no servicing for 2 years, unlike how the industry operates. If we don't see that play, we will not just get into a service because we can sell it through our app and increase. That's not our DNA. Our first promise is to the consumer of great services and great solutions at home, or none at all.
And all of that is backed by technology, Raghav, and you're going to have to deliver on that promise as you expand and grow into different verticals. What's the big challenge that you see there, particularly today?
So all our business lines require a fair amount of investment, and the backbone of how things work inside is through tech, where we are codifying, helping us scale. So be it native, InstaHelp, India businesses, international businesses, as we are pushing, innovating, constantly they'll require investments in upgrading how training works, improving how quality has to be assessed, how do you help partners on the job. There's a whole wave of Gen AI solutions which we can use across all facets of a business. And these are things which we plan to be working on through the year.
So in the near term, is the bulk of the investment going to go into native, etc., or into the core business?
It'll be a mixture. So once we codify something, it's there to stay. So as we push the boundaries of a core business line or try to experiment things in the new stuff, all of that kind of goes into our tech teams where they'll be working on. So I think it'll be a mixture of investments in core, investments in the newer lines we are trying, investments in native.
Abhiraj, you want to run us through what the prospects are like as far as investing behind each of these businesses are concerned, because that is something that shareholders would like clarity on.
So I would say on the core India services business, which is already profitable, we will continue to invest. There's no question behind that. In training, in marketing, in user acquisition, and in technology. But those investments will not be in line with revenue growth. And as a result, we should be able to see contribution margins, which are very healthy in our core business in India, almost 20% of NTV. We should see a meaningful percentage of that contribution continue to flow into the bottom line. So margin expansion is something that we will be committed to in the core business in India. It may not happen every quarter, but on an annual basis, when we take a step back, I think it's fair to assume that every year the company should show some improvement in margins, even while it continues to grow. I think that's something that we're committed for. I think as far as native is concerned or InstaHelp is concerned, these are very young businesses. InstaHelp is 6 months old.
Yeah.
When I was writing the DRHP, it was not launched. So I had to actually make edits last minute to the DRHP to include InstaHelp. Yeah. Native in itself is about 1.5 years old. So I think these will need investments. This is where I've requested shareholders to show some patience. At our end, we recognize that we have to be clear as well. We have to be clear in terms of how long they will take to break even and what is the capital that will get deployed. That's only fair. And if I was a UC shareholder, I would expect that clarity. That's clarity that we should come out with very soon, hopefully in our first earnings call. And in general, we are committed to very, very transparent disclosure, Shireen. We believe in telling the story as is, exactly how we're seeing it. Shareholders should make judicious decisions. We love the company we are building, and we don't want to oversell the picture or undersell it. We want to tell the truth and let people decide if they want to partner with us.
So let's talk about the story as is in your words. And one of the risk factors in the DRHP, of course, is the competitive landscape, where we do now have new players getting into the business, as well as incumbents who are now looking at getting a piece of your pie, so to speak. So how do you look at the competitive landscape, and what could that potentially mean for you?
I think in terms of the competitive landscape, we're only getting started. So I totally expect this to heat up further. That being said, all of us put together, Urban Company and the tens of other competitors we have, vertical and lookalike, do not add up to even 1% of the industry.
Yeah.
99% is offline. 99% is unorganized and fragmented. So I think, if you ask me, rather than how do we split the pie between each other,
How do you grow the organized
how do
pie?
we become 5, 10, 15, 20%, right? And in that, I would say sometimes when two eat, they eat faster than one.
Hopefully no indigestion on the back of eating as fast as you would like to eat at this point in time. But you know, the international markets and many consumer tech companies from India did foray into international markets, but then decided to pull back and have now decided to focus squarely on the domestic market and the domestic business. Yours is in that way an unusual story because you went out fairly early on in the company's history and you continue to bet on international markets. But is it for now as far as further international expansion is concerned, Varun?
Yes. We are in 3 geographies outside of India, and for the near future, we intend to continue to be in these 3. India is the bulk of our business and continues to be the bulk of our focus. At the same time, we are quite happy with the progress in these 3 markets. We are seeing healthy growth in each of these 3 markets, north of 50% growth, and we are seeing improving profitability in these markets as well. UAE, which is our oldest market, we started in the year 2018, is already profitable, and the other 2 markets are relatively newer, and they seem to be on the right path as well, similar to the path that our India services business took. So we are happy with how things are shaping out in these 3.
In India, we're only in 47 cities today. If you look at food platforms, some of them are in 1,000 cities.
Yeah.
So the opportunity is large here, and I think...
So what's the priority? What could 47 be over the next, say, 12 to 18 months in the near term?
I think the 47 number today, let's start with just these 47 cities. We would not have complete micro market coverage even in these 47 cities. And if I talk about a city like Delhi or Bangalore, where we have a very wide assortment of services, a city number 45 or 46 or 47 would have a very small fraction. So first goal will be micro market coverage and assortment coverage. If you ask me, I think eventually this 47 number should get to about 100 and then 200. I definitely see a market in India in the top 200 cities for an urban company like service.
By when?
Tough to put a timeline to it, but I think it will be a calibrated expansion. Every year, I think we'll keep adding.
How many cities do you believe you can potentially add every year? On the back of what you've been able to do so far?
Yeah. Look, I think sometimes these things may not be very linear. They could happen in spurts. So if you ask me how many could we add, we could even add 50 cities. But would we? That's a question of how many things are we juggling right now? What is the priority? We've gone through phases in the past. So if I talk about the 2022-2023 phase, we added about 30-35 cities in a span of 12 to 18 months.
I want to talk to you about the larger gig economy since that's what it's now come to be known as. And as per the data that the government has last put out, about 10 million people across different platforms, including yours, and that number is expected to go up significantly by 2030. What would you say has been the big transformation that you've seen personally at Urban Company of being able to engage with professional service providers in this fashion? Because one of the things that I've noticed very visibly is almost a destigmatization of what a job could mean. I mean, I have to say, I saw this podcast that was interviewing one of your, cleaners. And the pride with which he spoke, I mean, to my mind, that wouldn't have happened even a few years back. For somebody to say that, look, I do this for a living and as a job. How have you noticed this change, and what does that mean potentially as far as business for you is concerned?
I think I recently came across this post on social media that one of the customers had put up. And he was quoting our service professional, and the service professional said, earlier people used to call me a toilet cleaner. Now they call me an urban company professional. And that kind of summarized for me, the impact that we're trying to bring. Look, I think there's dignity in every work, and urban company tries to champion that. And I think there's a lot of work to be done there. We are very proud of our service professionals. We are very proud of the dignity and professionalism with which they serve millions of consumers. I think a lot goes in the uniform, the certification program, the training, the fact that they're part of mainstream formal India now.
Speaking of uniforms, I mean, as I said, this looks like the class of 2025, the graduating class of 2025. All of you in your blazers.
Just a bit older.
But back at IIT or IIM, I mean, did you think that you'd be here one day?
No. I think when you start, you're really not thinking about these things. You're thinking about survival this week, next week, maximum next month. I remember Raghav, me and Varun, in our first office, drawing out this: who has how much savings, how long will it last, what will we do if it runs out. So it's all about survival when you start, but that's the beauty of it. You put one step forward and then take the next step and the next step, and before you know it, you're going.
So before I let you go, let me ask each one of you, if I were to ask you for a line that would in your mind encapsulate where you believe urban company will be in the next 11 years, since you've done 11, a line that would encapsulate urban company in the next 11 years. Varun, I'll start by asking you.
We'll aim to build a company the country can be proud of.
A company that the country can be proud of. Raghav?
I will cheat and borrow his line that hit hard: the operating system of your home.
The operating system of your home. You're going to have to come up with a new one now. No pressure.
I think Varun ended his speech by saying we want to be known as the company that does the right thing. And I think that would be what we would like UC's legacy to be, the company that does the right thing.
The company that does the right thing, and we hope that you do the right thing by your investors and your shareholders as well as your employees. It's been wonderful chatting with the three of you. Congratulations once again from all of us here at CNBC TV18. We wish you the very best of luck, and we look forward to seeing you quarter after quarter to talk more numbers with you. But thanks very much for your time.
Thank you so much, Shri.
Well, with that, it is time for us to wrap up this edition of the Young Turks Reloaded podcast from all of us here on the team. For now, thanks very much for watching. Do send us your feedback. We always like to hear from you. Goodbye.